party risks the credit and trustworthiness of the other. The 5 components of a typical forward contract are: quantity of the commodity, quality of the commodity, time of delivery, place for delivery, and price to be paid at delivery. Futures. In contrast to forward contracts, futures contracts are exchange-traded obligations. The buyer or seller is contingently responsible for the full value of the contract. A buyer goes long or establishes a long position and is obligated to take delivery of the commodity on the future date specified. A seller goes short or establishes a short position and is obligated to deliver the commodity on the specified future date. If the seller does not own the commodity, his potential loss is unlimited because he has promised delivery and must pay any price to acquire the commodity to deliver. As prices change, gains or losses are computed daily for all open futures positions on the basis of each day's settlement price. Gains are credited and losses are debited for each open position, long or short. All accounts for firms and traders must be settled before the opening of trading on the next trading day. Buyers and sellers benefit from organizations that act as clearinghouses for the contracts. Clearinghouses enable futures positions to be offset easily before delivery. To offset, close, or 370 units 16 types and characteristics of derivative securities. S65_LEM.IN 370 March 15, 2019 10:58 and 49 seconds AM. Liquidate a futures position before delivery. An investor must complete a transaction opposite to the trade that opened, the futures position. The offsetting transaction must occur in the same commodity, for the same delivery month, and on the same exchange. About 98% of futures contracts are offset before delivery. Futures may be highly leveraged. If, at expiration, the settlement price is higher than the delivery price, a long position results in a profit while a short position loses. Conversely, if the settlement price is lower than the delivery price, shorts profit and longs lose. Typically, there are 5 standardized parts to an exchange-traded futures contract: quantity of the commodity, example 5,000 bushels of corn or 100 ounces of gold; quality of the commodity, specific grade or range of grades may be acceptable for delivery, including price adjustments for different deliverable grades; delivery price, similar to exercise or strike price with options; time for delivery, example December wheat to be delivered; location, approved for delivery. Test topic alert. Futures are most commonly used by speculators, while forwards are used by producers. That explains why such a small percentage of futures contracts ever end with delivery. Example 1. Forwards are commonly used by producers, farmers, to hedge the risk of the price of the commodity falling before it is able to be harvested and sold. For example, if a farmer has planted soybeans and wishes to hedge against a possible decline in the spot or cash price at delivery, the farmer could buy forward contracts in a size equal to the amount of soybeans expected to be harvested. B. Buy futures contracts in a size equal to the amount of soybeans expected to be harvested. C. Sell futures or forward contracts in a size equal to the amount of the soybeans expected to be harvested. D. Sell the soybeans for cash today. Answer: C. Hedging a commodity yet to be harvested is done by selling a forward or a futures contract on that commodity. In that way, the price is guaranteed in the event of a market decline. However, the producer is giving up any potential gain in the event the prices rise above the futures/forward agreed upon. 1. Regulation of futures and forwards. Because these are not securities, they do not come under the jurisdiction of the SEC. The SRO that is in charge of regulating the futures markets and their participants is the Commodity Futures Trading Commission, CFTC. Forward contracts are not regulated by any agency. Unit 16. Unit 16 Types and Characteristics of Derivative Securities 371. S65_LEM.IN 371 March 15, 2019 10:58 and 49 seconds AM. Example 1. Commonly traded on a regulated exchange would be any of the following except A. ETFs. B. Forward contracts. C. Futures. D. Warrants. Answer B. A forward contract, choice B, is a direct commitment between one buyer and one seller. This makes each contract different, and lack of standardization makes exchange trading a virtual impossibility. Investing in derivatives. U16L05, identify the costs, benefits, and risks of derivative securities. Using derivatives can be a useful strategy for investors if the circumstances warrant it. There is no cost, per se, to open an options account, although, as we will learn in Unit 18, the account opening procedure is somewhat more involved than opening a regular account at a broker-dealer. For those who buy options, long position, the only cost is the premium to purchase the option plus whatever the brokerage firm charges in commissions. With a very limited, and probably not tested, exception, options cannot be purchased on margin, covered in Unit 22, so, without any borrowed money, no interest is charged. Selling options, short position, brings in money from the sale and the seller receives all of that premium, less the brokerage charges. If the call or put being written, sold, is uncovered, there is a margin requirement, but that is beyond the scope of the exam. The costs to carry forwards and futures is much more complicated, and we are not aware of the topic ever being tested. As with any investment, there are benefits and risks. We'll look at those most likely to be on your exam. Leverage. One of the key benefits to using derivatives is that of leveraging your investment. Because an options cost is normally much less than the underlying stock's cost, option contracts provide investors with leverage. Relatively little money allows an investor to control an investment that would otherwise require a much larger capital outlay. And if you purchase a call and guess right, the potential profit is unlimited. Theoretically, there is no limit as to how high the stock's price can go. Example: an investor can buy the common stock of RST Corporation for $58 per share, investing $5,800, or buy an RST55 call for $6, an investment of $600. If RSTs. 372 Unit 16 Types and Characteristics of Derivative Securities. S65_LM.IN 372 March 15, 2019 10:58 and 49 seconds AM. Price increases to $70. The stock investor will see a 20.7% profit, $12 profit / $58 investment, whereas the option investor, with the call worth a minimum of $15, $70 minus $55, will have more than doubled the investment, $9 profit / $6 investment equals 150%. The opposite is also true. If RST trades below $55, say at $48, when the option expires, the stock investor has a modest loss, but the option investor loses the entire investment. What is the value of an option to buy stock at $55 per share when it is currently available to anyone at $48? Nothing. As you can see from the example, leverage works both ways: great when the stock is going your way, and a possible loss of everything when it doesn't. Of course, if, in the following example, RST had gone bankrupt, leaving the stock worthless, the investor holding 100 shares would have lost the entire $5,800, while the option investor's loss would have been limited to the $600 premium paid. Less risk. When used properly, options can lower an investor's risk. The classic example is the covered call, where the investor owns the stock and then writes a call option on it. Realize that there are only three things that can happen after you purchase a stock. The stock can increase in price. The stock can remain stable. The stock can decline in price. If you think about it, two of those possibilities are unfavorable. Certainly, you don't want the stock to fall in price. Even if the stock remains level, you've suffered from opportunity cost. You could have put it in the bank with no market risk and earned interest. Only if the stock increases by more than the risk-free rate do you emerge a winner. However, if you write a call on that stock, you wind up better for sure in cases 2 and 3, and perhaps even in case 1. Let's look at an example. Meredith purchases 100 shares of ABC at $50 per share. She then sells an ABC 50 call for a premium of $400. If the stock goes down to $47 by expiration date, the option she wrote will expire. Who is going to call on her to sell stock at $50 when it is available for $47 in the marketplace? In reality, though, she hasn't lost $300. Because she received $400 when she sold the option, she is still $100 ahead of the game, even though the stock dropped in price. It isn't until the stock falls below $46 that she begins to lose money, but no matter how far it falls, she will still be $400 ahead of having just bought the stock without selling the option. If the stock price remains the same, the option will expire, and she will still own the shares, but will have $400 in her account from the sale of the option. Only in the first choice is it possible for her to be a loser, but even that wouldn't happen until the stock rose above $54 per share. How is that? If the stock is $53, yes, her option will be exercised and she will have to sell her stock at the strike price of $50. She paid $50 for it, but also received the $4 premium, so the total received on the sale of the stock plus the option is $54. Now, if the stock goes to $60, she would have been better off never writing the option. That is a risk you take in exchange for the chance that you'll win if the stock's price only rises a little, stays the same, or falls. Alternative to selling short. As we will learn in Unit 22, one way to make money when an investor is of the belief that a stock's price will decline is to sell that stock short. At this juncture, to keep things simple. Unit 16. Unit 16 Types and Characteristics of Derivative Securities 373. S65_Allium.in 373 March 15, 2019 10:58 and 49 seconds AM. Selling stock short involves putting up a deposit in a margin account, borrowing stock to sell, and carries with it the possibility of an unlimited loss. When you buy a put, you benefit when the stock's price declines, but all you pay is the premium and, if you guess wrong, that is all you can lose. Having just mentioned the possibility of an unlimited loss when an investor sells a stock short, we would be remiss if we didn't discuss the parallel situation with options. When an investor writes an uncovered, naked, call option, the potential loss is unlimited. Here is how that works. With the market price of ABC at $50 per share, Manny writes a 50 call option for a premium of 3. Manny does not own any ABC, but, as the seller of the call option, is obligated to deliver 100 shares of the ABC stock and receive $5,000 if the option is exercised. We use the phrase, call up, to help us remember our objective when we buy a call. If the price of ABC should go up, the option will be exercised and Manny will have to buy it at its current market price and then deliver it. The question is, how high can it go? Theoretically, and that's the exam view, there is no limit, it can rise to infinity. That leaves Manny having to pay an infinite amount to buy stock for which he receives only the $5,000 strike price plus the $300 premium. Just in case you want to say, but because he receives $5,300, his loss can't be unlimited. Remember, infinity minus any other number is still infinity. We know this is just theoretical, but if you've watched some of the better-known companies over the past few years, some of the price increases have been astronomical. Hedging. In the example of writing the covered call, we showed one example of hedging, protecting a position. In that case, the first 4 points of a market decline were absorbed by the premium received from the sale of the call. There is more to discuss on using options to hedge, and we're going to cover that in Unit 20. Time decay. Have you ever heard an investor say, I'm going to hold this stock until it gets back to what I paid for it? We're not going to debate the logic of that statement other than to say, that doesn't work with options, they ultimately expire, and if the stock hasn't moved in the direction you're hoping for, you will run out of time. Time decay is the concept that, as the time to expiration gets closer, the value of the option decreases. Taxation. In most cases, any profit realized from buying or selling options is treated as a short-term capital gain. As we will learn in Unit 21, those gains are taxed at ordinary income rates, which are much higher than the long-term capital gain rate. Much of what we've shown you here applies to forwards and futures as well, but other than some very basic questions, we don't expect the kind of detail we presented here for options. Here's the type of question that is basically easy, but if you don't read carefully, you will waste time trying to figure it out. 374 Unit 16 Types and Characteristics of Derivative Securities. S65_LEM.IN 374 March 15, 2019 10:58 and 49 seconds AM. Examples. 1. Among the purposes of purchasing derivatives would be all of the following except A. Hedging, B. Income, C. Profits, D. Speculation. Answer. B. Purchase of a derivative, whether an option, a forward, or futures contract, never generates income. Selling one does, but the question refers to a purchaser, and that is why the correct answer is choice B. 2. The term derivative would not include A. Futures on commodities, B. Interest rate swaps, C. Or REITs, D. LEAPs. Answer. C. A derivative is something which derives its value from something else. REITs represent direct investment into real estate. The asset purchase is the actual asset. Choice C. LEAPs are the options with the long-term expiry. Never heard of interest rate swaps? Well, on the real exam, there will occasionally be an answer choice that you've never heard of, but it should not affect your ability to choose the correct one. Unit 16. Unit 16 Types and Characteristics of Derivative Securities 375. S65_LEM.IN 375 March 15, 2019 10:58 and 49 seconds AM. S65_LEM.IN 376 March 15, 2019 10:58 and 50 seconds AM. In the 1990s, financial advisors began introducing their wealthy clients to alternative investments, now generally referred to as ALTs. These included, among other products, exchange-traded notes, ETN, leveraged ETFs, and new, highly sophisticated financial derivatives. One thing that all of these had in common was that they were complex and not easy to understand, for both the investor and the person recommending the investment. Although investing can be complex, standard investments are fairly easy to comprehend. Even new investors understand that stocks have more risk but hold out the chance of superior returns, while bonds generally have less risk with correspondingly lower returns. All investors dream of scoring a touchdown and not getting tackled for a loss. Alternative investments try to do just that. Some are successful, but many are not. Suitability determinations need to be made on a case-by-case basis, considering each customer's objectives, circumstances, and sophistication. Securities professionals must take special care in recommending these complex products to the sophisticated customer and even more so to one with less financial acumen. In addition to alternative investments, the exam will test your knowledge on other more traditional assets, such as investment real estate and commodities, including precious metals. The Series 65 exam will include approximately 4 questions from this unit. Learning objectives. When you have completed this unit, you will be able to accomplish the following. U17L01, identify the concept of flow-through, pass-through, of passive income and loss as it applies to DPPs. U17L02, differentiate between the roles of the general partners and the limited partners in a DPP. U17L03, recognize the characteristics of the pooled investment vehicles that are considered alternative investments. U17L04, describe viatical/life settlements. U17L05, contrast the difference between passive and active real estate investing. 17. Unit. Alternative investments and other assets. 377. S65_LEM.IN 377 March 15, 2019 10:58 and 50 seconds AM. U17L06, identify the different types of commodities and precious metals that are popular investments. U17L07, describe the benefits and risks of alternative investments. Direct participation programs, DPPs. U17L01, identify the concept of flow-through, pass-through, of passive income and loss as it applies to DPPs. This is one class of alternative investment. DPPs, most of which are limited partnerships, allow the economic consequences of a business to flow through to investors. Any income or loss is to the investor is considered passive because the investor does not take an active role in the management of the business, that is the role of the general partner, as you will learn shortly. Unlike corporations, limited partnerships pay no dividends. Rather, they pass income, gains, losses, deductions, and credits directly to investors. Limited partnerships offer investors limited liability. Similar to a stockholder in a corporation, creditors cannot generally come directly to limited partners to collect on defaulted debt. In general, the maximum potential loss to a LP is the amount already invested plus any funds committed for which have not yet been submitted. Take note. In Unit 21, the topic of partnership taxation will be covered in greater detail, but, at this point, we want you to know that any income received by a partner is considered passive, and the same is true for losses. The effect of this is that any passive losses can only be deducted as a loss against passive income. Investors in a limited partnership. U17LO2, differentiate between the roles of the general partners and the limited partners in a DPP. It is important to understand that a DPP is just a different way to invest in a business rather than buying the company's stock. There are certain tax advantages to being structured as a partnership, with the flow-through of income or loss being one of them. That aside, this is merely an investment in a business, whether it be a RALP, real estate limited partnership, an oil and gas drilling program, or a movie production company. Just like any other business, there are those who run the enterprise, management, and those who contribute the capital, investors. For DPPs, those roles are assumed by the general partners, usually referred to as GP, and the limited partners, the LPs. From a legal standpoint, there must be at least one GP and one LP. Investing in a DPP requires analyzing the program just as one would analyze a stock or bond investment, just with a few different parameters. An investor should choose to invest in a specific limited partnership because it is economically viable. The investor can make use of the potential tax benefits. 378 Unit 17 Alternative Investments and Other Assets. S65_LEM. In 378 March 15, 2019 10:58 and 50 seconds AM. The GPs have demonstrated management ability and expertise in running similar programs. The program's objectives match the investor's objectives and do so within a time frame that meets the investor's needs, and the startup costs and projected revenues are in line with the startup costs and revenues of similar ventures. Promoters structure DPPs to meet various objectives. When a promoter's tax stance is too aggressive or is without economic purpose in the view of the IRS, the program is considered an abusive tax shelter. If the IRS judges the program to be abusive, it disallows deductions, assesses back taxes, interest, and penalties, and, in some cases, charges the promoter with criminal intent to defraud. Investors should try to match their current and future objectives with a program's stated objectives. Example: a person seeking current taxable passive income should not invest in an oil and gas exploratory drilling program. Why not? Because these programs drill where oil or gas has never been found before, exploratory, and have a low success rate. Even when they do hit, it may take years before any income is generated. Take note. Because most of these are privately placed, DPPs are considered illiquid, and investors must commit money for a long time. Even those which are publicly traded do not have the liquidity of other investments, frequently requiring authorization from the GP to be able to sell your units. General Partner, GP. The GPs are the active investors in a limited partnership and assume responsibility for all aspects of the partnership's operations. A GP makes decisions that bind the partnership, buys and sells property for the partnership, manages the partnership property and money, supervises all aspects of the partnership's business, and maintains a minimum 1% financial interest in the partnership. Unlike LPs, who have limited liability, GPs assume unlimited liability and are therefore personally liable for all partnership business losses and debts. A partnership's creditors may seek repayment from the GPs and may go after their personal assets. A general partner has a fiduciary relationship to the LPs in that the GP has been entrusted with the LP's capital and is legally bound to use that capital in the investor's best interests. The GP must manage the business in the partnership's best interest and avoid the appearance of improper use of assets and conflicts of interest. The GP cannot borrow from the partnership, compete with the partnership, or commingle personal funds with partnership funds. Finally, GPs do not generally receive any distributions from profits until after a payment has been made to the LPs. Unit 17. Unit 17 Alternative Investments and Other Assets 379. S65_LM.IN 379 March 15, 2019 10:58 and 50 seconds AM. Limited Partner, LP. LPs are passive investors with no management or day-to-day decision-making responsibilities, therefore, they usually are not held personally responsible for the partnership's indebtedness. In fact, if an LP does take an active role, she faces the danger of losing the limitation on liability. LPs may receive cash distributions and capital gains from partnerships. The total yield of a partnership investment takes into account all potential rewards, tax deductions, cash distributions, and capital gains. Units of ownership in a partnership are called interests rather than shares. Example: 1. In a direct participation program, liability for the debts of the business falls upon the A. General partners, B. Limited partners, C. Shareholders, D. Agents selling the program. Answer: DPPs consist of at least one GP and one LP. The liability of the LPs is limited to their investment, including commitments made but not yet fulfilled. On the other hand, the GPs, choice A, bear the liability for the debts of the entity. Issuing partnership investments. DPPs may be offered either as private placements, qualifying for an exemption from registration under state and federal law as described in Unit 4, or publicly registered either with the SEC, the states, or both. In either case, specialized documentation known as a subscription agreement is required from investors. An investor who buys a limited partnership unit must complete and sign a subscription agreement, which includes a statement of the investor's net worth and annual income and a power of attorney form appointing the GP as the agent of the partnership. The agent is responsible to make certain that the information the potential investor provides in the subscription agreement is complete and accurate. U17L03 recognize the characteristics of the pooled investment vehicles that are considered alternative investments. The category of ALFs also includes a number of pooled investment vehicles. Probably the best known is the hedge fund, covered Unit 14, but there are a number of others. The following is a description of the pooled investment vehicles considered alternative investments that are most likely to appear on the exam. Exchange-traded notes, ETNs. Although similar in some regards, don't confuse ETFs with ETNs. It could be said that ETNs are cousins of ETFs. That said, just as with family members, there are some important differences. Most obvious is the difference in their basic structure. While ETNs are registered. 380 Unit 17 Alternative Investments and Other Assets. S65_LM.IN 380 March 15, 2019 10:58 and 50 seconds AM. Under the Securities Act of 1933, ETFs register under the Investment Company Act of 1940. Basically, this means that ETNs are made as debt instruments, while ETFs are looked at as investment companies. ETNs are a type of exchange-traded debt security offering a return linked to a market index or other benchmark rather than periodic interest payments, as is the case with traditional debt securities. These are sometimes referred to as equity-linked notes, ELNs, which is a real misnomer because they are debt securities. Issuers of ETNs issue and redeem notes as a means to keep the ETN's price in line with a calculated value, called the indicative value or closing indicative value for ETNs. This value is calculated and published at the end of each day by the ETN issuer. When an ETN is trading at a premium above the indicative value, issuing more notes to the market can bring the price down. Similarly, if an ETN is trading at a discount, redemption of notes by the issuer reduces the number of notes available in the market, which tends to raise the price. ETN issuers have primary control over the issuance and redemption processes, which can become a conflict of interest. Unlike ETFs, they do not buy or hold the assets replicating the performance of the underlying index. Some of the indexes and investment strategies used by ETNs can be sophisticated and very complex, carrying many different risks. They should be offered only to people who are knowledgeable and comfortable with the risks. Those risks, in part, include credit risk. ETNs are unsecured debt obligations. Market risk. Liquidity risk. Although exchange traded, a trading market may not develop. Call, early redemption, and acceleration risk. ETNs may be called at the issuer's discretion, and conflicts of interest. The issuer may engage in trading activities that are at odds with note holders, shorting, for instance. Leveraged ETFs. These funds attempt to deliver a multiple of the return of the benchmark index they are designated to track. For instance, a 2x leveraged fund would try to deliver 2 times the return of whatever index it is tracking. With leveraged funds, there are no limits by rule or regulation as to the amount of leverage that could be applied to a portfolio. Currently, there are numerous 2x and 3x leveraged funds available to investors. The risk associated with leverage is that it is always a double-edged sword. Volatility is magnified. Therefore, the risk to be recognized regarding this fund strategy is that if the benchmark index is falling, then the fund's returns will be, in theory, the designated leverage amount, perhaps 2 or 3 times the loss. In addition, most of these funds use derivatives products such as options, futures, and swaps to enable them to achieve the stated goal. Because these derivative products are not suitable for all investors, so too can it be said of the leverage fund portfolio containing them. Ultimately, as always, suitability becomes an issue when recommending these products. Inverse, reverse, funds. Inverse funds, sometimes referred to as short funds, attempt to deliver returns that are the opposite of the benchmark index they are tracking. For example, if the benchmark is down 2%, the fund's goal is to be up 2%. As with leveraged ETFs, tools used to achieve the goal are options and other derivatives. In addition, inverse funds can also be leveraged funds, or said another way, 2 or 3 times the opposite of the indice's return. Unit 17. Unit 17 Alternative Investments and Other Assets 381. S65_LEM.IM 381 March 15, 2019 10:58 and 51 seconds AM. Example. A simple example of this would be an inverse fund tracking the S&P 500. If the index were to drop by 1%, the value of the inverse fund would rise by 1%. If this was a 3x inverse fund, then the fund's value would rise by 3%. Of course, if the index were to rise, the performance of the inverse fund would suffer, especially if it was leveraged. Test topic alert. FINRA warns investors that most leveraged and inverse ETFs reset daily, meaning that they are designed to achieve their stated objectives on a daily basis. Their performance over longer periods of time, over weeks or months or years, can differ significantly from the performance, or inverse of the performance, of their underlying index or benchmark during the same period. Therefore, in most cases, these would not be suitable investments for buy and hold investors or those with other than a very short time horizon. For the TVIX, Velocity Shares Daily 2X VIX CEDN, one of the risk disclosures, page 28, PS 28, reads like this. The long-term expected value of your ETNs is 0. If you hold your ETNs as a long-term investment, it is likely that you will lose all or a substantial portion of your investment. Take note. Both leveraged and inverse index funds, leveraged or not, can be traded on an exchange. When they are known as ETFs. If the shares are exchange traded, they are priced by supply and demand, can be purchased on margin, and bought and sold throughout the trading day, like all exchange traded products. For those that are not exchange traded, example, inverse mutual funds, they would be priced, purchased and redeemed like all investment company shares. Neither of these fund types carry any guarantee that they will achieve the stated goal or objective. Structured products. When you need something that doesn't yet exist, what do? You build it. That is the concept behind structured products. They are built, structured, to meet specific needs. In many cases, they involve structuring a debt issue in such fashion as to provide lower borrowing costs to the issuer while increasing potential returns to the lender. The goal is to give investors more reasons to accept a lower interest rate on debt in exchange for certain features. In other examples, options and other derivatives are used to provide possible principal protection or other goals. Needless to say, for the most part these are highly complex products and should be limited to those investors who have the necessary financial sophistication to be able to understand the potential risks. When used properly, they can be useful tools to increase portfolio diversification. 382 Unit 17 Alternative Investments and Other Assets. S65_LEM. In 382 March 15, 2019 10:58 and 51 seconds AM. Structured notes with principal protection. FINRA defines the term structured note with principal protection as any structured product that combines a bond with a derivative component and that offers a full or partial return of principal at maturity. Structured notes with principal protection typically reflect the combination of a zero-coupon bond, which pays no interest until the bond matures, with an option or other derivative product whose payoff is linked to an underlying asset, index, or benchmark. These notes are promises to pay made by the product issuers. That is why any guarantee that the principal will be protected, whether in whole or in part, is only as good as the financial strength of the company that makes that promise. For those who can remember, this is what happened to investors who purchased structured notes with principal protection issued by Lehman Brothers Holdings, which declared bankruptcy in September 2008. Risks of structured products. There are several risks involved with structured products. Because of the customized nature of these products, there is little or no liquidity. Secondly, in most cases, these are structured so that the returns are not fully realized until maturity. As a result, these should appeal to buy and hold investors rather than short-term traders. There is also the matter of credit risk, so it is important to know the strength of the financial institution who is the issuer. Finally, as with most alternative investments, there is a lack of efficient pricing. That is, the actual market price does not necessarily reflect the real value. This can lead to abnormal returns, good and bad. When good, the portfolio will generate positive alpha. When bad, the alpha will be negative. Viatical/life settlements. U17L04. Describe viatical/life settlements. The terms viatical and life settlement are often used interchangeably, but they are technically not quite the same. The most significant and testable difference is that viaticals apply to those with a terminal illness and a life expectancy of 24 months or less regardless of their age, while life settlements apply to those who, although generally at least 65 years old, are in decent health with a life expectancy of at least 2 years that can run 10 years or longer. Health and life expectancy aside, the concepts are the same for both. In general, almost any kind of life insurance policy can be sold, although most companies will not purchase a straight, non-convertible, term life policy. Viatical settlements emerged in the early 1990s in response to the AIDS crisis to create opportunities for terminally ill patients to receive money by selling their life insurance death benefits for much more than the cash surrender value available, but less than the death benefit, from insurance companies. The idea is that the money the person gets from the settlement is to go toward paying for medical expenses during this 2-year period. Interests in the settled insurance policies are then sold to investors, with the promise of returns in the form of the death benefit, an amount higher than the purchase price, to be paid upon the death of the insured. As the market has expanded, viatical settlement providers turn to new classes of viators, those selling their life insurance policies, including the elderly and the chronically ill. Selling a life insurance policy, or the right to receive the death benefit, to any person other than the insurance company that issued the policy, is a transaction known as a viatical or Unit 17. Unit 17 Alternative Investments and Other Assets 383. S65_LEM.IN383 March 15, 2019 10:58 and 51 seconds AM. Life settlement. NIEVES concludes that these settlements, regardless of the health status or age of the insured, are securities. All persons involved in the offer and/or sale of viatical or life settlements should be aware of the nature and extent of the registration and anti-fraud provisions of state securities laws, as well as the applicability of these provisions to every offer and/or sale of a security. Because licensing is done on a state-by-state basis, there is little uniformity. Some states require just a life insurance license, some require both a life insurance and a life settlement license, and some require either or both of these in being licensed as a securities agent. As with so much else, the regulators are concerned about suitability and disclosure. When a life insurance policy is sold to an investor, the buyer is acquiring a financial interest in the insured's death. In addition to paying a lump sum, the purchaser agrees to pay any premiums that are necessary to support the cost of the policy for his loan as the insured lives. In exchange, the buyer will receive the death benefit upon death of the insured. It is important to be aware of the risks involved in this activity. Because there is no active secondary market for these policies, it is difficult to arrive at a fair evaluation and the investor may wind up paying too much for the policy. There is always the chance that the insured will live longer than anticipated. The more the insured's life exceeds the projected expectancy, the lower the return to the investor. The possibility, remote as it is, that the insurance company will not be financially able to honor the claim. The intangible moral issue of the investor knowing that the sooner the insured dies, the greater the return. Investment real estate. U17L05 contrasts the difference between passive and active real estate investing. We have already discussed two methods of passive real estate investing. That is, investing in real estate where all of the work is done for the investor. That is the case with the REIT and the Real Estate Limited Partnership Investment, RELP. Investing in real estate, whether it be single-family homes to flip or to rent, or commercial property, involves work on the part of the investor. Whether it is collection of rents, finding tenants, or doing repairs, the investor is responsible for doing the work or hiring someone to do it. One feature of real estate investment that is similar to the Section 1035 exchange available to annuities is the Section 1031 for real estate. An investor holding real estate may exchange that for another parcel and there are no immediate tax consequences. Commodities. U17L06 identify the different types of commodities and precious metals that are popular investments. In the previous unit, we discussed futures. They are one of the methods by which individual investors can invest directly in commodities. Forwards are used primarily by producers and industrial consumers. One can also invest indirectly through ETPs, exchange-traded products, such as ETFs that follow a commodity index, or mutual funds that invest in 384 Unit 17 Alternative Investments and Other Assets. S65_LEM.IN384 March 15, 2019 10:58 and 51 seconds AM. Commodity-related businesses. For instance, an oil and gas fund would own stocks issued by companies involved in energy exploration, refining, storage, and distribution. Historically, most commodity trading was of agricultural products. We were an agrarian society, and these commodities, such as corn, wheat, oats, and soybeans, are still actively traded. There are animal-based commodities, such as beef, pork, and eggs. Today, the most commonly traded commodity is crude oil, with coffee often claimed to be in second place. And, of course, for all of you Eddie Murphy fans, remember the movie Trading Places, there are frozen orange juice futures. Active trading also takes place in industrial metals, such as aluminum, nickel, copper, and lead. Speaking of metals, it is hard to turn on the TV today without seeing a commercial for gold or silver investments. Whether you agree or not with the ads, for millennia, individuals and governments have stored their wealth in precious metals. Benefits and risks of alternative investments. U17L07 describe the benefits and risks of alternative investments. Most alternative investments share similar benefits and risks. Usually, these investments offer low or even negative correlation to the stock market, resulting in greater diversification of the portfolio. This can lead to greater overall long-term returns with reduced risk. In some cases, there are opportunities for abnormal returns, high and low. As was done with pooled investment vehicles in Unit 14, we'll take these one at a time. DPPs. The DPP investor enjoys several advantages, including an investment managed by others, flow-through of income and certain expenses, and limited liability. The most the investors can lose is the amount of their investment plus any funds committed for, but not yet remitted. The exam will probably give more attention to the following disadvantages. Liquidity risk. The greatest disadvantage is lack of liquidity. Because the secondary market for DPPs is limited, investors who want to sell their interests frequently cannot locate buyers. Legislative risk. When Congress changes tax laws, new rules can cause substantial damage to LPs, who may be locked into illiquid investments that lose previously assumed tax advantages. Unit 17. Unit 17. Alternative investments and other assets. 385. S65_LEM. IM 385 March 15, 2019 10:58 and 51 seconds AM. Risk of audit. Statistics from the IRS indicate that reporting ownership of a DPP results in a significantly higher percentage of returns selected for audit. Depreciation recapture. One of the tax benefits is the ability to depreciate most fixed assets, especially when that depreciation can be accelerated. The effect of the depreciation deduction is to lower the tax basis of the asset. If that asset is then sold for more than that basis, the excess is recaptured and subject to tax, possibly at ordinary income tax rates. You won't need to know anything more than the concept. Example 1. Benefits of investing in a DPP would include high liquidity. 2. Flow-through of operating losses. 3. Limited liability. 4. Immunization against tax audit. A. 1 and 2B. I and 4C. 2 and 3. D. 3 and 4. Answer. C. DPPs are structured as flow-through entities, giving their investors the opportunity to receive income without the partnership being taxed first. In addition, if there are losses, they get the opportunity to write off those losses against passive income from other DPPs. As limited partnership vehicles, they offer their investors liability limited to their investment. They generally have very low liquidity and, instead of reducing the tax audit risk, they increase it. Real estate investing offers several benefits. Historically, real estate has been a hedge against inflation. It provides rental income, a portion of which may be tax-advantaged due to depreciation and interest deductions. It offers high leverage. Real estate loans generally require a relatively small down payment. Investment real estate is not generally correlated with stock market returns. It offers Section 1031 tax-free exchanges. Investors should also be aware of some of the risks. In general, a lack of liquidity, certainly when compared to stocks, bonds, or mutual funds, is a risk. If purchased for rental, each month that the property is not rented is money lost. 386 Unit 17 Alternative investments and other assets. S65_LEM. IM 386 March 15, 2019 10:58 and 51 seconds AM. High leverage can work against the investor in a down market. The individual just might not have the skills necessary to manage the property, and hiring someone else could eliminate or greatly reduce the profits. Any good asset allocation program should have real estate, but other than owning your own home, at least for most investors, REITs are probably the preferred option. Example 1. Among the reasons for investors to consider investing in real estate would be all of the following except the ability to increase returns through leverage. B. A high correlation with stock market returns. C. Possible tax advantages. D. Potential appreciation. Answer. B. One of the investment advantages of real estate is that returns are generally negatively correlated with those of the stock market. Option B. Benefits of investing in commodities. Potential hedge against inflation. One of the reasons for inflation is frequently an increase in the cost of basic commodities. During those periods, investors in those commodities should keep pace with or possibly exceed the inflation rate. However, investors should note that commodities can be much more volatile than other types of investments. Diversification. Commodities are generally not correlated with stock market returns. This negative correlation, see the next unit, offers diversification of returns, commodities up when stocks are down and the reverse, and can have the effect of reducing overall portfolio volatility. However, just as with any other assets, diversification does not ensure a profit or guarantee against loss. Potential returns. As with any other investment, those who buy low and sell high will make money, or the reverse if you take a short position. Commodity prices are subject to supply and demand on a global basis and can provide handsome returns to those who predict future shortages. Risks of commodity investing. Principal risk. Commodity prices can be extremely volatile and the commodities industry can be significantly affected by world events, import controls, worldwide competition, government regulations, and economic conditions, all of which can have an impact on commodity prices. Because of the leverage involved in futures, investors can easily lose their entire investment virtually overnight. Volatility. Not only are the prices of the actual commodity volatile, but those investors seeking to lower their risk by investing in commodity mutual funds or ETFs will find that those vehicles reflect the volatility of the underlying commodity or index as well. This is especially so when the ETF or fund uses options or other derivatives. Exposure to foreign markets. In Unit 12, we discussed some of the risks of investing in foreign securities. Because commodities represent a global investment in addition to Unit 17. Unit 17 Alternative Investments and Other Assets 387. S65_Elium.in 387 March 15, 2019 10:58 and 51 seconds AM. The risks of the commodities themselves. There is also the vast array or risks that one faces when investing in foreign markets. Particularly prevalent here would be currency risk as well as the risks caused by political, economic, and currency instability. High cost. This risk applies primarily to investing in the actual precious metal. For the small to average investor, the spread between what you pay for the bullion or coins and what you can resell for is significantly higher than the markup or commissions on stock or futures contracts. Lack of income. No matter how long you hold gold or silver, you will never receive a dividend or an interest check. In fact, with any commodity, there is no income, only the chance for capital gains. Examples 1. An investor is reading a report that industrial demand for copper is expected to double in the next 5 years. This might lead the investor to A. Buy corn futures, B. Sell copper futures, C. Invest in several copper mining companies, D. Modify the investor's portfolio to take a larger cash position. Answer, C. If the demand for copper increases, those companies producing the commodity should find their stock prices increase nicely, choice C. Selling copper futures would be when one expects the demand, and, therefore, prices, to fall. 2. Investors interested in adding precious metals to their portfolios would likely consider A. Coal, B. Diamonds, C. Gold, D. Tin. Answer, C. Of these choices, only gold, C. is considered a precious metal. Diamonds are certainly precious, but they are not a metal. Tin is a metal, but is not considered precious. 388 Unit 17 Alternative Investments and Other Assets. S65_Elium.in 388 March 15, 2019 10:58 and 51 seconds AM. This unit consists of 7 units, Unit 18 Type of Client, Unit 19 Client Profile, Unit 20 Portfolio Management Styles, Strategies, and Techniques, Unit 21 Tax Considerations, Unit 22 Trading Securities, Unit 23 Performance Measures, Unit 24 Retirement Plans including ERISA issues and educational funding programs. In total there will be 39 questions on this material, representing 30% of the Series 65 exam. 4. Part. Client Investment. Recommendations and Strategies. 389. S65_Elium.in 389 March 15, 2019 10:58 and 52 seconds AM. S65_LEM.IND 390 March 15, 2019 10:58 and 52 seconds AM. Generally, any competent person of majority age can open an account, and anyone declared legally incompetent cannot. Fiduciary or custodial accounts may be opened for minors or legally incompetent individuals. In addition to individuals, accounts may be opened for anyone else meeting the definition of a person. That would include business and government entities. Some of these would be considered institutional accounts as defined in Unit 1. The Series 65 exam will include 6 questions on the material covered in this unit. Learning objectives. When you have completed this unit, you will be able to accomplish the following. U18L01, recognize the different types of client securities professional service. U18L02, identify the different ownership categories and the legal documentation required to open an account. U18L03, distinguish between the different kinds of business entities capable of opening accounts. U18L04, classify the special requirements for fiduciary accounts, including trust and estate accounts. U18L05, identify estate planning options. New account agreement. U18L01, recognize the different types of client securities professional service. Securities professionals can serve a wide variety of clients. They range from the individual client to sovereign governments and everything in between. In this unit, we'll cover accounts. 18. Unit. Type of client. 391. S65_LEM.IND 391 March 15, 2019 10:58 and 52 seconds AM. For natural persons, such as the various types of joint accounts. Accounts can be opened for all kinds of philanthropic endeavors, including charities and foundations. We'll also spend time describing the various types of business accounts. Even though any type of government unit from municipalities to states to countries can employ the services of broker-dealers and investment advisors, the exam does not deal with those relationships other than when a broker-dealer acts as an underwriter for political issuer. Account ownership categories. U18L02, identify the different ownership categories and the legal documentation required to open an account. Individual account. An individual account may be for a natural person, a trust, or a deceased person through an estate account. There is one beneficial owner. When referring to investment advisors, normally an individual client is a natural person whose investments are managed by an advisor for a fee. When a business is organized as a sole proprietorship, that business account is also considered an individual account. The advisor should establish, in consultation with the client, a written statement of objectives and investment strategy before making recommendations to the client. This document is frequently referred to as an investment policy statement, IPS. In the next unit, we will examine the client profile and see the information necessary to prepare the IPS. In Unit 24, we will discuss the use of the IPS by those with fiduciary responsibility over qualified retirement plans. The advisor must periodically review the client's investment profile to determine whether any changes in circumstances could alter the client's objectives. Unless certain legal documents are procured, the account holder is the only person who can control the investments within the account or request distributions of cash or securities from the account. Suitability for individual accounts. Both federal and state regulations require that any investment recommendation be suitable based upon the client's needs, objectives, and financial considerations. In the next unit, we will look at a number of those issues. Joint accounts. A joint account is owned by 2 or more persons, and each is allowed control over the account. Generally, suitability information is required on all of the tenants in the account. On the new account form, the account must be designated as either tenants in common, TIC, joint tenants with right of survivorship, TROS, or tenants by the entirety. Account forms for joint accounts require the signatures of all owners. Trading activity, buying or selling, may be initiated at the request of any one of the parties. If a security is purchased and a certificate is issued, it must be in the name of all of the tenants. Furthermore, when that security is sold, all of the tenants must sign that certificate or a stock or bond power. The 392 Unit 18 type of client. S65_LM.IN 392 March 15, 2019 10:58 and 52 seconds AM. Check for the proceeds must be made payable to all of the tenants, and it will be sent to the address designated in the account documents. Tenants in Common, TIC. TIC ownership, or JTIC, provides that a deceased tenant's fractional interest in the account is retained by that tenant's estate and is not passed to the surviving tenants. Ownership of a TIC account may be divided unequally. At the death of an account owner, that person's proportionate share of the cash and securities in the account is distributed according to the instructions in the decedent's will. Example: if a TIC agreement provides for 60% ownership interest by one owner and 40% ownership interest by the other, that fraction of the account would pass into the deceased owner's estate upon death. The TIC agreement may be used by more than two individuals. Joint tenants with right of survivorship, TROS. TROS ownership stipulates that a deceased tenant's interest in the account passes to the surviving tenants. Regardless of contributions, each TROS account owner has an equal and undivided interest in the cash and securities in the account. Upon the death or declaration of incompetency of any of the account owners, account ownership passes to the survivors, a right of succession occurs, and the other party or parties become sole owners of the account. Test topic alert. Whenever the test uses the term joint tenants, it means TROS, not tenants in common. Tenancy by the entirety, TBE. This is the third type of concurrent ownership, or ownership by multiple persons. As with the other two we've described, each co-tenant has an undivided interest in the account. Unlike the other two we've discussed, a tenancy by the entirety can be created only by married persons. The most important difference between a tenancy by the entirety and a TROS or TIC is that in this form of ownership, the consent of the other tenant is required before the other tenant can sell or give away his interest in the property. As with TROS, upon the death of one of the spouses, the deceased spouse's interest passes to the surviving spouse. Because this form of ownership is restricted to spouses, it is considered similar to the community property laws found in some states. Tenancy by the entirety is most commonly used for ownership of real property, real estate. Definition: undivided interest. In a joint account, all owners have an undivided interest in the account. What does that mean, especially when we see that TIC can have unequal shares? Simply stated, an undivided interest means that the no tenant has a designated interest in any specific asset in the account. Even when the shares are unequal, one tenant doesn't get stock A and the other stock B. Using Unit 18. Unit 18 type of client 393. S65_LM.IN 393 March 15, 2019 10:58 and 52 seconds AM. Our 60/40ths example with the TIC account, one owner would have 60% of each of the holdings and the other 40% of each. The assets themselves are not divided between the owners. Test topic alert. Tenants in common can own unequal interests in the account, unlike joint tenants with right of survivorship, who always share equally. Tenants by the entirety are considered a single owner, no separate shares. TIC does not avoid probate. Checks or distributions must be made payable in the account name and endorsed by all parties. Examples: 1. A new account is opened for joint tenants with rights of survivorship. All of the following statements are true except A. Orders may be given by either party. B. Mail can be sent to either party with the permission of the other party. C. Checks can be drawn in the name of either party. D. In the event of death, the decedent's interest in the account goes to the other party. Answer: C. Although either party may enter an order, any money or securities delivered out of the account must be in the names of both owners. Choice C. Rights of survivorship means that the surviving owner or owners receive the deceased's interest in the account. 2. If three individuals have a tenants in common account with a firm and one individual dies, then the account must be liquidated and the proceeds split evenly among the two survivors and the decedent's estate. B. The two survivors continue as co-tenants with the decedent's estate. C. Probate is avoided on the estate of the deceased co-tenant. D. The account is converted to joint with rights of survivorship. Answer B. In the case of a TIC account, the decedent's estate, choice B, becomes a tenant in common with the survivors. Suitability for joint accounts. The suitability requirements for a joint account follow the same basic rules as all accounts. You must have a reasonable basis to believe all recommendations presented are suitable based on the information gathered. Because a joint account is really nothing other than a collection of individuals, suitability information must be obtained on all of the account owners and any recommendations must be appropriate based upon that information. An example you might see on the exam has two brothers with a TIC account. One brother is an accredited investor under Rule 501 of the Securities Act, while the other is far from it. In this case, suitability is usually based on the lowest common denominator, the non-accredited brother. 394 Unit 18 Type of Client. S65_LEM.IM 394 March 15, 2019 10:58 and 52 seconds AM. Examples. 1. Several investors open an account in joint tenancy. For suitability purposes, financial information is required on which of the following investors? A. The majority of the investors. B. The largest investor only. C. Only the one authorized to trade the account. D. All of the investors. Answer D. When a joint account is opened, to be able to make suitable recommendations, financial information should be obtained on all of the account owners. Choice D. 2. Which of the following individuals may not open a joint account? A. 2 spouses. B. 3 sisters. C. 2 friends. D. A parent and a minor child. Answer D. A joint account may be opened by 2 or more individuals who have legal standing. A minor may not be a party in a joint account because minors are not legally considered a person. Think back to Unit 1. That makes choice D correct. A parent or any other adult can be custodian for a minor, but that is a single account, not a joint account. What are the legal requirements for opening up these various accounts? Opening an account for an individual requires the completion of the new account agreement. This is basically a contract between the broker-dealer or investment advisor and the customer explaining the rights and obligations of both and the charges for the services that will be rendered. Information that must be obtained from the client includes items such as legal capacity, that is the client of full legal age in the state or jurisdiction or residence, and does she have the capacity to enter into the agreement, employment information, and the customer identification program, CIP, notice. To help the government fight the funding of terrorism and money laundering activities, broker-dealers and investment advisors are required by federal law, the USA Patriot Act, to obtain, verify, and record information that identifies each person who opens an account. Customer identification. Requirements apply to all customers opening a new account as those terms are defined in the Bank Secrecy Act. That information includes name, date of birth, permanent physical address, no mail receiving or incorporation services, tax identification number. If a U.S. citizen, this is typically the Social Security number, citizenship or visa details, and financial information about the client. Unit 18. Unit 18 Type of Client 395. S65_LEM.IM 395 March 15, 2019 10:58 and 52 seconds AM. In the case of joint accounts, the information is the same except that details on all of the joint owners must be furnished. One of the joint owners is designated as the primary contact to receive statements and other communications. We have not heard anything about the exam requiring you to know the account opening details for business accounts, although there is plenty about those accounts tested that will be covered shortly. In Unit 16, we dealt with derivatives, especially options. There are some unique requirements to open those accounts. NAFAEL does not have a specific rule dealing with the opening of options accounts. Therefore, we will refer to the FINRA rules that are used as the guidelines for most states. Because trading options, puts and calls, generally involves a higher degree of risk than stocks, bonds, or mutual funds, a designated supervisory person with knowledge about options must approve the account opening. In addition, there is a special options disclosure document, ODD, that must be provided to any options customer at or prior to the time such customer's account is approved for options transactions. In approving a customer's account for options trading, a broker-dealer, or agent associated with the broker-dealer, must exercise due diligence to ascertain the essential facts relative to the customer, his financial situation, and his investment objectives. One question asked on a new options account form that is not required on a normal brokerage account opening is investment experience and knowledge, example, number of years, size, frequency, and type of transactions for options, stocks and bonds, commodities, and other financial instruments. Based upon such information, the designated supervisory person shall specifically approve or disapprove in writing the customer's account for options trading. The account approval will indicate the date the options disclosure document, ODD, is furnished to the customer. Nature and types of transactions for which the account is approved, example, buying, covered writing, uncovered writing, spreading, and discretionary transactions. Name of the agent assigned to the account. Name of the supervisor approving the account. Date of approval, and dates of verification of currency of account information. Within 15 days after a customer's account has been approved for options trading, the broker-dealer must obtain from the customer a written agreement that the customer is aware of and agrees to be bound by FINRA rules applicable to the trading of option contracts and that the customer has received a copy of the current ODD. Part of the agreement states that she is aware of and agrees to be bound by the rules of the Options Clearing Corporation. Finally, there are specific requirements for opening a margin account, and those will be covered in Unit 22. 396 Unit 18 Type of Client. S65_LM.IND 396 March 15, 2019 10:58 and 52 seconds AM. Example. 1. When an agent with a broker-dealer opens a new options account for a client, in which order must the following actions take place? I. Obtain approval from a qualified supervisor. 2. Obtain essential facts from the customer. 3. Obtain a signed options agreement. 4. Enter the initial order. A1, 2, 3, and 4B. 1, 2, 4, and 3C2, I, 4, and 3D2, I, 3, and 4 answer. See, the steps in opening an options account occur in the following order. Obtain essential facts about the customer, give the customer an ODD, have the manager approve the account, enter the initial order, and have the customer sign and return the options agreement within 15 days. That is the sequence in Choice C. Accounts for business entities. U18L03, distinguish between the different kinds of business entities capable of opening accounts. Sole proprietorship. This is the simplest form of business organization and is treated like an individual account. Therefore, the same issues of suitability that apply to individual accounts apply to the management of sole proprietorship accounts. In a sole proprietorship, all income or loss is that of the individual. In fact, one of the risks of operating in this fashion is that all of the owner's assets are liable for the debts of the business. You can lose everything. Obviously, this is one of the major considerations when opening an account for this form of business. General partnership. A general partnership is an unincorporated association consisting of two or more individuals. In a general partnership, the partners manage and are responsible for the operation and debts of the business. Partnerships are easy to form and easy to dissolve, but are generally not suited for raising large sums of capital. Partnerships allow the business profits and losses to flow directly through to the investors for tax purposes, thus avoiding double taxation of profits at the business and individual levels. Because the income and losses flow through to the individual partners, an investment policy for a general partnership would have to consider the combined/collective objectives of all of the partners. Unit 18. Unit 18 Type of Client 397. S65_LM.IND 397 March 15, 2019 10:58 and 52 seconds AM. Limited partnership. In In the case of an enterprise organized as a limited partnership, the management and liability is assigned to the general partners while the limited partners are passive and have liability limited to their investment. This is the typical case with the direct participation programs, DPPs, discussed in Unit 17. Suitability decisions are similar to a general partnership except that the limited partners do not have the full liability of the general partners. Limited Liability Company, LLC. A limited liability company, LLC, is a business structure that combines benefits of incorporation, limited liability, with the tax advantages of a partnership, flow-through of taxable earnings or losses. The LLC owners are members, not shareholders, and are not personally liable for the debts of the LLC. Just as with the partnership clients described previously, the objectives and financial constraints of the individual members must be considered from a suitability standpoint. S corporation. An S corporation, although taxed like a partnership, offers investors the limited liability associated with corporations in general. The profits and losses are passed through directly to the shareholders in proportion to their ownership in the S corporation. Unlike an LLC, which can have an unlimited number of members, an S corporation may not have more than 100 shareholders, none of whom may be a non-resident alien, or more than one class of stock, presumably common. Losses on S corporation stock may be claimed only to the extent of an investor's basis in the shares. The basis includes money contributed or lent to the corporation. Any business organization client where the entity itself has no liability and is not subject to tax, such as the partnerships, LLC, and S corporation, requires the advisor to look through the entity to the owners to properly meet the suitability standards. Take note. Geraldine invested $25,000 in an S corporation, along with 9 other investors who invested the same amount. Within a year, the corporation needed additional equipment, so Geraldine lent $10,000 to the business from her own funds. Her basis is now $35,000. If the corporation experiences a $400,000 loss, Geraldine's portion is $40,000. However, she may deduct only $35,000 of the loss, because that is the amount of her basis. C corporation. A C corporation is a business structure that distinguishes the company as a separate entity from its owners. If a business expects to need significant capital, this form is almost always the preferred choice. Unlike the management of a partnership, the general partners, in most cases, the corporation's officers and directors are shielded from personal liability for the corporation's debts and losses. Shareholders are also shielded from corporate creditors. That is the limited liability benefit of owning stock. Corporate income tax applies to the corporation as an entity rather than being passed through to the shareholder. If your client is 398 Unit 18 type of client. S65_Eliam.in 398 March 15, 2019 10:58 and 53 seconds AM. A C corporation, you will only look at the corporation's financial needs and objectives when determining suitability. Take note. C corporation earnings are subject to double taxation. Before distribution, the earnings are taxable to the corporation and then are taxed again to the shareholder when paid out as a dividend. Distributions from LLCs and S corporations are taxed only once because there is no taxation at the business entity level. Choosing the right business structure. Here are some testable points to consider when a person is considering the most appropriate business form to use. The easiest business to set up, especially if you don't expect much liability, is the sole proprietorship. However, because the business and the owner are inseparable, there is unlimited liability and no limits to the amount of the loss, if any, that may be claimed on the proprietor's tax return. Partnerships and LLCs are generally easier to form and dissolve than a C corporation. Benefits of structuring a business as a general partnership, an LLC, or an S corporation would include no double taxation as is the case with a C corporation. However, a company that expects to be very profitable should be a C corporation instead of a partnership, an LLC, or an S corporation because in those three, all earnings pass to owners, nothing can be retained. Only the sole proprietorship and the C corporation are taxed on their income. The sole proprietorships is on the owner's personal tax return and the corporation's is on a Form 1120. The only logical choice or a large amount of capital is to be raised is the C corporation. The business entities that have limited liability for owners as well as flow-through of income or loss are the limited partnership, LLC, and S corporation. The C corporation has limited liability but no flow-through. The sole proprietorship and general partnership have flow-through but unlimited liability. Corporations, including LLCs, survive the death of their owners, even if there is only one shareholder in an S corporation or C corporation, or one member of the LLC. When it comes to transferability of ownership, the corporate form, especially the C corporation, is the preferred choice. Selling shares is usually pretty straightforward. Unit 18. Unit 18 type of client 399. S65_LM.IM 399 March 15, 2019 10:58 and 53 seconds AM. Examples. 1. 3 friends plan to start a new business. It is anticipated it will be several years before the business turns a profit. Which of the following types of business organization would be best if they wish to limit their liability while, at the same time, being able to receive favorable tax treatment for the expected losses? A. C corporation. B. S corporation. C. A general partnership. D. The sole proprietorship. Answer. B. The only way to limit liability is through a corporation, or LLC, or limited partnership, neither of which is offered here as a choice. The S corporation allows for the flow-through of operating losses to the shareholders while the C corporation does not. 2. Which of the following business structures is most appropriate for retaining money in the business? A. C corporation. B. A sole proprietorship. C. An LLC. D. An S corporation. Answer. Only in the case of a C corporation, choice A, is money retained not subject to tax on the personal level. In all of the other choices, any income is passed through to the owners, making it inefficient to accumulate funds in the business. Fiduciary accounts. U18L04, classify the special requirements for fiduciary accounts, including trust and estate accounts. In a fiduciary account, the individual granted fiduciary responsibility enters trades for the account, makes all of the investment, management, and distribution decisions, and must manage the account in the owner's best interests. Examples of fiduciaries include the following: trustee designated to administer a trust executor, F. executrix, designated in a decedent's will to manage the estate's affairs, administrator appointed by the courts to liquidate the estate of a person who died intestate, without a will, known as an administrator or trustee, an intestacy guardian, conservator, designated by the courts to handle the affairs of a minors or a person judged incompetent custodian of a uniform. Transfer to Minors Act, UTMA, account receiver or trustee in a bankruptcy. 400 Unit 18 type of client. S65_LM.IM 400 March 15, 2019 10:58 and 53 seconds AM. A fiduciary is anyone legally appointed and authorized to represent another person, act on that person's behalf, and make decisions necessary to the prudent management of that person's account. The constraints placed on the actions of a fiduciary are described in detail in the Uniform Prudent Investors Act, UPIA. For example, a fiduciary cannot use account contents for personal benefit but may be reimbursed for reasonable expenses incurred in managing the account. Do not confuse that with transaction costs. When determining appropriate investments, the cost of the transaction, trading commissions, is not nearly as important as how well the investment meets the needs of the account. The exam tends to focus its UPIA questions on those managing qualified retirement plans, so we'll revisit the Act in Unit 24. Take note. Any trades the fiduciary enters must be consistent with the trust's investment objectives. Opening a fiduciary account. Opening a fiduciary account may require a court certification of the individual's appointment and authority. An account for a trustee must include a trust agreement detailing the limitations placed on the fiduciary. No documentation of custodial rights or court certification is required for an individual to open an UGMA or UTMA account. See Unit 24. Power of attorney. If a person person who is not named on an account is to have trading authority, the customer must file written authorization with the broker-dealer giving that person access to the account. Without this power in writing, no matter how tempting the answer on the exam, activity in the account cannot be created by anyone other than the account owners. Trading authorization usually takes the form of a power of attorney. Two basic types of trading authorizations are full and limited powers of attorney. Full power of attorney. A full power of attorney allows an individual who is not the owner of an account to deposit or withdraw cash or securities and/or make investment decisions for the account owner. Limited power of attorney. A limited power of attorney allows an individual to have some, but not total, control over an account. The document specifies the level of access the person may exercise. Test topic alert. Limited power of attorney, also called limited trading authorization, allows entering of buy and sell orders but not the withdrawal of funds. Entry of orders and withdrawal of funds is only allowed if full power of attorney is granted. Unit 18. Unit 18 type of client 401. S65_LEM, 401 March 15, 2019, 10:58 and 53 seconds AM. Durable power of attorney. A full or limited power may be made durable by the grantor of the power. It is designed to provide that a specifically designated person maintains power over the account even upon the grantor's incapacitation, whether due to physical or mental causes. Its most common use is when providing for aging parents. However, upon the death of either principal to the durable power of attorney, the power is terminated. How does this differ from the living will we will discuss shortly? A living will is a written document making your specific end-of-life wishes known. The durable power of attorney, POA, appoints someone to act on your behalf and make the decisions. So, if you want to be sure your wishes, such as organ donation, are followed, prepare a living will. Test topic alert. A durable power of attorney survives the physical or mental incompetence of the grantor but not the death of either party. This means that orders entered after the time of death of the grantor, even if the purchase or sale was decided upon before death, are not accepted. Trust and estate accounts. Two special kinds of accounts that may appear on the exam are those dealing with trusts and estates. What both of these have in common is that the person entering orders on behalf of the account is acting in a fiduciary capacity, whether it be the trustee of the trust or the executor or administrator of the estate. These fiduciaries are acting for the benefit of the beneficiary or beneficiaries of the trust or estate, so it is necessary to look at the objectives of the trust and the needs of the heirs. Trust accounts. A trust is a legal entity that offers flexibility to an individual who wishes to transfer property. Trusts may be established for a variety of personal and charitable property transfers. Trusts are also established as the legal entity for a corporate retirement plan, but that will be covered in a later unit. The subject of trust law is very complicated and should only be addressed by one who is competent in the subject, usually an attorney. This exam will require you to know the basics of trusts, how trusts are taxed, trustee responsibility, and your obligations when acting as an advisor to the account. Trust parties. For a trust to be valid, 3 parties must be specified in the trust document, trust agreement. These parties are a settlor, a trustee, and a beneficiary. Under certain circumstances, the settlor, trustee, and beneficiary may be the same individual. For a trust to be valid, both the settlor and the trustee must be competent parties. However, the beneficiary may be a minor or a legally incompetent adult. 402 Unit 18 type of client. S65_LEM, 402 March 15, 2019, 10:58 and 53 seconds AM. The settlor. The settlor is the person who supplies the property for the trust. Trust property is also referred to as its principal or corpus. This party is also known as the maker, grantor, trustor, or donor. Trustee. A trustee is an individual or other party holding legal title to property held for the benefit of another person or persons. The trustee must administer the trust by following directions in a trust agreement or in a will. A trustee must perform certain duties relative to the trust. Property. A trustee is a fiduciary and is obliged to perform in the interest of the beneficiaries. The trustee may be one or more adult individuals or an entity in the business of trusteeship that is responsible for investing, administering, and distributing trust assets for benefit of the beneficiary or beneficiaries. In many ways, a trustee's duties are like those of an executor for an estate. However, a trustee's duties generally continue for more time than a typical estate settlement, and the trustee is charged with the greater duty of investing trust assets. Beneficiary. A beneficiary is a person for whose benefit property is held in trust. A beneficiary is one who receives or who is designated to receive benefits from property transferred by a trustor. Beneficiaries to a trust include only those persons upon whom the settlor intended to benefit from the trust property or those who would succeed their interests. Example. Jill establishes a trust under which her husband, Julian, is to receive all income produced by the trust property for as long as he lives. Upon Julian's death, their daughter, Janet, will receive the trust principal. Julian is a primary beneficiary. However, until Julian's death, Janet is a contingent beneficiary because her benefit depends on the occurrence of an event, in this case, Julian's death. Test topic alert. Although it doesn't happen often, the grantor of the trust can also be the trustee and/or the beneficiary. Remainder man. When the trust has run its course and all expenses and distributions have been made, the person who receives the remaining balance is called the remainder man. No gender preference here, there's no such term as remainder woman. The most common case involves real estate. For example, the husband dies and has arranged for his wife to have full use of their home until she passes away. At that time, any surviving children inherit the home. They are the remainder men. Unit 18. Unit 18 type of client 403. S65_LEM.in 403 March 15, 2019 10:58 and 53 seconds AM. Simple trusts versus complex. Simple trusts. All income earned on assets placed into a simple trust must be distributed during the year it is received. If the trust does not distribute all of its net income at least annually, the trust is declared a complex trust. The trustee is not empowered to distribute the trust principal from a simple trust. Complex trust. On the other hand, a complex trust may accumulate income. A complex trust is permitted deductions for distributions of net income or principal. Capital gains are deemed part of the distributable net income of a complex trust unless reinvested. Furthermore, the trustee may distribute trust principal according to trust terms. We'll have more to say about these in Unit 21. Test topic alert. The key difference between a simple and a complex trust is that the simple trust must distribute all of its annual income, whereas a complex trust is not obligated to do so. Living versus testamentary trusts. Living trust. A living trust, also known as an inter vivos trust, is established during the maker's lifetime. When an individual sets up a revocable living trust, she maintains complete control over it. During the maker's lifetime, she can make changes to the trust as often as she wants to and can add or remove assets as desired. These trusts contain instructions for managing the trust upon the incapacity or death of the grantor. Testamentary trust. With a testamentary trust, the settlor retains control over assets until death, think last will and testament. The individuals will stipulate that, at death, the testator's property is to be placed in trust for the benefit of one or more beneficiaries. The testamentary trust does not reduce the grantor's income or estate tax exposure. Furthermore, assets that pass to a testamentary trust do not avoid probate, because the validity of the will's instructions to pass property to the trust must be substantiated in probate court. Living will. Please do not confuse a living will with a living trust or even a will. The common name for these is an advance directive of medical care directive. This has nothing to do with assets or beneficiaries. It is the individual's instructions for end-of-life situations, such as withholding medical care or organ donation. The exam may show it something like this. 404 Unit 18 Type of Client. S65_LEM.IN 404 March 15, 2019 10:58 and 53 seconds AM. Example. 1. A living will is used to either avoid the cost and time of probate b eliminate, or at least reduce, estate taxes c ensure that the author's assets are properly distributed after death. D. Express the author's end-of-life wishes. Answer. D is sometimes referred to as a medical directive or advanced care directive. A living will is used to express the author's end-of-life wishes, such as organ donation, pulling the plug, and so forth. Choice D. It has nothing to do with living trust or a last will and testament describing the distribution of assets after death. Foundations and charities. One of the discoveries of the Madoff affair was the large amounts lost by charities and foundations. In most cases, certainly true for charities, they should be dealt with as the fiduciary accounts described previously. In the case of foundations, because those are usually funded by the principals, a greater amount of investment flexibility may be called for. Philanthropic funds. Wealthy individuals may set up donor-advised funds that allow for flexibility and tax advantages. There are mutual fund sponsors and banks that offer these individuals the opportunity to donate a lump sum, take a current tax deduction, and then have the assets invested to earn over a period while allowing the donor to advise distributions to favored charities. If you are dealing with high net worth clients who are of a charitable bent, there could be great merit in advising them in this direction. Example. 1. For which of the following types of clients would the suitability requirements be somewhat more relaxed? A guardian for an orphan B. A charity C. A foundation D. An executor. Answer. C. Guardians and executors are fiduciaries controlling assets of those who cannot speak for themselves. Charities raise funds from donors expecting that the money will be invested wisely. Foundations, choice C, are generally funded by their founders who usually give those managing the money greater flexibility. Impact investments. Impact investing can be defined as the intentional allocation of capital to generate a positive social or environmental impact that can be and is measured. Unit 18. Unit 18 Type of Client. 405. S65_LEM.IN 405 March 15, 2019 10:58 and 54 seconds AM. Charities and foundations usually have a specified goal, whether it be medical research, think American Cancer Society, or social goals, think Greenpeace. Impact investing is when the entity commits a portion of its funds to those companies or industries which align with those goals. I don't think the Cancer Society would have tobacco stocks in its portfolio, and Greenpeace probably wouldn't invest in strip mining companies. Impact investing is a subset of socially responsible investing, SRI, that attempts to generate positive social good in addition to the goals typically outlined in an SRI approach. Where SRI fund managers are generally passive and adopt a do-no-harm approach, impact investing funds typically not only seek to create positive impact, but measure and report their impact in a transparent way. The acronym ESG is also frequently found. This stands for environment, social, and corporate governance. Example. 1. A socially responsible mutual fund would probably invest in companies. I. Generating high returns. B. Acting with high ethics and morality. C. Located in a single geographic area. D. With a major presence on social media. Answer. B. SRI looks for companies with high ethical standards. Choice B. Here is a bit more about the topic, which should enable any student encountering this or a similar question to be confident in their choice of answer. The standards involved include corporate responsibility and concerns for society as valid parts of investment decisions. ESG criteria are used in an attempt to generate long-term competitive financial returns and positive societal impact. Program-related investments. Although somewhat similar to impact investing, program-related investments are those where the foundation, more common for them than charities, makes a charitable distribution. Examples of this would be helping bring new drugs to market more quickly by providing necessary funding. One caution is that the investments must be consistent with the philanthropy's mission to get the same favorable tax treatment by the IRS as a regular charitable gift would. Management obligations. In general, these foundations are managed by a board of directors having the responsibility of selecting and overseeing the activities of the investment manager. The board prepares an investment policy statement, IPS, describing their goals and objectives and uses this IPS to monitor how well the investment managers adhere to the plan. As described in the specific IPS, these managers need to evaluate the expected returns and see that they outpace inflation without taking undue risk. Diversification is a key, both with the types of industry, types of security, and relative risk. A special investment constraint applies to most private foundations. IRS regulations require a private foundation pay out each year an amount equal to 5% of its net investment assets in qualifying distributions. 406 Unit 18 Type of Client. S65_LEM, 406 March 15, 2019 10:58 and 54 seconds AM. Account opening requirements. Opening an account for an organization is somewhat more complicated than an individual account. In addition to information about the entity, detailed information about those individuals in a control position, officers, 10% owners, etc., must be supplied. Significant financial information about the organization is also required to help determine suitability. Most broker-dealers have special account opening forms, and investments advisors usually use a different contract when dealing with an organization. We don't expect you will see much in the way of detail on your exam. Estate planning options. U18L05, identify estate planning options. Although estate planning is best left for the specialists, the exam will cover several basic concepts which will enable you to assist your clients and help identify when to call in the attorneys. Transfer on death, TOD, accounts. Using a transfer on death, TOD, account is the simplest way to keep assets held in brokerage accounts from becoming subject to probate upon a client's death and, at the same time, be distributed specifically as the account owner wishes. However, the TOD account does not avoid estate taxes if applicable. TOD accounts are available for most types of paper assets, such as savings and checking accounts in banks and credit unions, certificates of deposit, stocks, bonds, and other securities. The owner, while alive, is the only person with any rights to the property. Upon the owner's death, the property is immediately transferred to the named beneficiaries, usually without any added cost. The owner has the right to change beneficiaries at any time and provide for unequal distribution of the assets if desired. One of the other attractive features of TOD accounts is that there is no legal documentation necessary. The only types of accounts that may be opened with a TOD designation are individual accounts, TROs, and tenants by the entirety accounts. Example. 1. A client has an account where, upon her death, she desires that her only son will receive 50% of account value and her 4 daughters will receive 12.5% each. The easiest way to accomplish this would be to title the account. A. TOD. B. JUTROs. C. Tenants in common. D. In trust for the children. Answer. A transfer on death, TOD Choice A, requires no additional legal work and allows the account owner to designate beneficiaries in whatever percentages she wants. Furthermore, changes can be made at any time before death. Unit 18. Unit 18 Type of Client, 407. S65_LEM, 407 March 15, 2019 10:58 and 54 seconds AM. Take note. You might also see this as payable on death, POD, although the term is used far more frequently for bank accounts. Totten Trust. If you have a really old bank account, you might have a Totten Trust designation using language similar to John Doe in trust for Jane Doe, or perhaps John Doe as trustee for Jane Doe. Totten trusts, sometimes referred to as a poor man's will, allow for the transfer of ownership of a bank account to a beneficiary after the owner's death. Totten trusts were the predecessor to POD or TOD designations, but a few states still recognize them. Revocable versus irrevocable trusts. For more elaborate estate planning, it is advised that the client consider the use of trusts. Terms of a revocable trust may be changed during the maker's lifetime. Terms of an irrevocable trust generally cannot be changed. Revocable trust. If the grantor retains the ability to revoke the trust and take back the trust assets, the trust is revocable, and the income is taxable to the grantor under the grantor trust rules. That means the grantor is subject to tax on trust income even when not receiving the income. Assets in a revocable trust are included in the grantor's gross estate for federal estate tax purposes. No estate tax benefits apply. Revocable trusts are also called living trusts. They are used primarily as a will substitute. Assets in trust avoid the cost, time, expense, and publicity of probate. Irrevocable trust. For a trust to be considered irrevocable, the settlor must give up all ownership and property transferred into the trust. Property placed in an irrevocable trust is usually not includable in the trustor's estate for federal estate tax purposes. Certain exceptions to the general rule can jeopardize the effectiveness of an irrevocable trust to reduce estate taxes, but are unlikely to be tested. Grantor Retained Annuity Trusts, GRATs. This is an estate planning tool designed to pass assets to beneficiaries, usually children, in a way to minimize gift and/or estate taxes. The topic is very complicated, but here are the basics you might need to know. The key is in the words, grantor retained. That tells you that any income from the trust is taxed to the grantor. The annuity portion is paid for a specified number of years. At the end of that term, the beneficiaries get whatever is left, and that could be free of estate and gift taxes. 408 Unit 18 Type of Client. S65_LM.in 408 March 15, 2019 10:58 and 54 seconds AM. Example. 1. Sam Jones has been a successful businessman and is concerned that his youngest daughter will not be able to live within her means. To protect this from happening, Jones places a large sum of money into a trust for the benefit of the daughter. Because Jones knows he won't live forever, he arranges for the Fourth Fidelity Bank and Trust Company to have control over the assets. Which of the following statements is not true? A. Sam Jones is the grantor. B. Sam Jones is the trustee. C. Fidelity Bank and Trust Company is the trustee. D. Sam Jones's daughter is the beneficiary. Answer. B. The person, A, who funds the trust is the grantor or settler. The bank has been appointed to be trustee, C, and the daughter is the beneficiary, D, of the trust. That makes choice B the untrue statement. Estate accounts. An estate account is an account that, like a trust account, is directed by fiduciary on behalf of the beneficiary or beneficiaries of an estate. In the case of one who prepares a will, there is a specified executor. In the case of one who dies without a will, intestate, these functions are performed by a court-appointed administrator. The executor or administrator makes the investment, management, and distribution decisions for the account. Per stirpes. One common way for people to provide for their descendants is to incorporate the phrase, "to my living issue," per stirpes, in their will. In fact, some states automatically distribute in that fashion when one dies intestate. Per stirpes, not a typo, it is not stripes, is from the Latin word meaning branch. When used, per stirpes means that the deceased intended that a beneficiary's share of the inheritance is to go to an heir. Example. A widow or widower had 3 children and wished the estate to be distributed equally. If one of those children died prior to the estate settlement, that child's children, the grandchildren of the widow or widower, would share their parents' 1/3 share, receiving 1/6 of the total each, while the 2 living children would each receive a 1/3 share. It would look like this. Child A, Child B, Child C, deceased. Grandchild 1 and 2 1/3 1/3 1/6th and 1/6th. Per capita. Another Latin term, and this one means by total head count. Let's take the example used previously, where the deceased left the estate to 3 children. If they are all alive, simple. Unit 18. Unit 18 type of client 409. S65_LEM.in 409 March 15, 2019 10:58 and 54 seconds AM. Enough, each inherits 1/3. But if one of the 3 children, such as C in the previous example, has predeceased the parent and has 2 children, then the estate is split 4 ways. Child A, Child B and the 2 grandchildren each receive 1/4 of the estate. Take note. Some states have differing rules for per capita distributions, making it unlikely the topic will be tested. Trust suitability issues. Just as with any other account, recommendations must be suitable when considering all of the relevant information. However, in the case of a trust or estate, there are several considerations that do not arise in other individual accounts. Some of these are as follows. In virtually all cases, the trust document declares the objectives of the trust. Generally, these can only be changed by the grantor or, once in receipt of the assets, the beneficiary. The trustee is obligated to invest the funds in accordance with those objectives. For example, if the objective is income until the death of the grantor, then that is the primary consideration in any recommended transaction. Always follow the terms of the trust. Unless specifically stated in the trust document, margin trading is not permitted. In the case of an estate, the terms of the will must be followed. If the investment advisor managing the account is also the trustee or executor, in addition to the normal fiduciary responsibility assumed by all investment advisors, there are the formal requirements of the Uniform Prudent Investors Act, UPIA. That act is described in detail in Unit 24 dealing with retirement plans. Wearing 2 hats is an allowable practice, but not done very often because of the inherent conflict of interest. This, as with all potential conflicts of interest, must be disclosed to the client. There are unique tax considerations, which will be covered in Unit 21. In the case of trusts, conflicts between the grantor and the beneficiary may exist. In the case of estates, conflicts among the beneficiaries may arise. Example. A widow was left to trust with her children as contingent beneficiaries. She is to receive income from the trust, and her 2 children will receive the principal upon her death. To maximize their value, the children ask you to allocate half of the corpus to growth stocks while leaving the balance in bonds for their mother. Because the trust document calls for the widow to receive income, the advisor must pursue that objective and cannot follow the wishes of the children until the trust's assets become theirs. 410 Unit 18 type of client. S65_LEM.in 410 March 15, 2019 10:58 and 54 seconds AM. An advisor must be familiar with each client's circumstances, financial goals, and needs to formulate suitable investment recommendations. Without suitability information, the account cannot be opened. This is unlike broker-dealers that are permitted to open client accounts without suitability information. The Series 65 exam will include 7 questions on the material covered in this unit. Learning objectives. When you have completed this unit, you will be able to accomplish the following. Unit 19L01, describe the different methods of client data gathering. U19L02, identify the client's current and future financial situation. U19L03, contrast financial and non-financial investment considerations. U19L04, discover the client's risk tolerance. U19L05, distinguish between investment objectives and investment constraints. U19L06, analyze a client's financial goals and objectives for suitable recommendations. Client financial status. U19L01, describe the different methods of client data gathering. How is all of the information necessary to complete the customer profile obtained? Although there is no universal method, most firms rely on a combination of tools. The first step is usually having the client complete a detailed questionnaire. Optimally, this should be followed up by a personal interview, either in the office or home, on the phone, or online with one of the various video services currently available. There is only so much one can learn from a form, and both the client and the IAR benefit from the give and take of an interview, as that. 19. Unit. Client profile. 411. S65_LM.IM 411 March 15, 2019 10:58 and 54 seconds AM. Is the best way to discover qualitative information, such as risk tolerance and attitudes. As covered elsewhere in this course, confidentiality and security of this customer data is critical. Traditionally, data gathering techniques for financial professionals involve asking clients or prospects to bring in account statements, insurance policies, 401k plan options, and maybe tax returns. Why is all of this information needed? Without it, there is no way to determine suitability. Furthermore, as learned in the previous unit, the CIP requires certain information. Financial profile. U19L02, identify the client's current and future financial situation. A financial profile should include an assessment of the client's current expenditures, debt obligations, tax status, income sources, and a balance sheet containing the client's assets, including cash, CDs, and savings accounts, usually looked at as an emergency fund, generally considered to be a primary requirement for investing in securities, real estate holdings. Value and composition of securities holdings, pension and retirement accounts. Cash value in life insurance policies, and personal items such as jewelry and automobiles, and liabilities, including current debt obligations, credit cards, estimated tax payments, etc., long-term debt obligations, auto loan, mortgage, etc., loans against insurance cash value, and loans against 401k plan. Using this information, the advisor will prepare a family balance sheet. This balance sheet reflects all of the client's assets and liabilities to determine the overall net worth and liquidity of that client, while a family income statement includes income and expenses and is used to determine the client's cash flow. Taking into consideration all of this information indicates to the securities professional the extent to which the client is able to make a lump sum investment. The balance sheet shows a large amount of net assets available, and/or periodic investments, the income statement. Reveals a positive cash flow, there is money left at the end of the month. Because things can change, it is recommended that there be a follow-up meeting with the client at least annually. Test Topic Alert: a family balance sheet only includes assets and liabilities, not income, such as salary, dividends, or interest, or amounts paid for expenses. For 12 Unit 19 Client Profile. S65_LM.IM 412 March 15, 2019 10:58 and 55 seconds AM. Example 1. An individual's net worth is A. At the difference between the individual's assets and the individual's liabilities B. Best determined by examining the individual's personal income statement C. Largely irrelevant in identifying the individual's investment objectives D. Another term for discretionary income answer A. An individual's net worth is the difference between the individual's assets and the individual's liabilities. Choice A. It is determined from the personal balance sheet rather than from the personal income statement. Net worth is relevant in determining an individual's investment objectives. Clients with a negative net worth might find it preferable to reduce their debt level before beginning an investment program. Non-financial considerations. U19L03, contrast financial and non-financial investment considerations. The previous learning objective described a number of financial considerations. How do those contrast with non-financial ones? In its simplest form, the contrast is that one deals with monetary numbers and the other not. In the first case, we are gathering assets, liabilities, income, and expense. Now, we will look at non-monetary items. A client's non-financial considerations can be more important than the financial information. Relevant non-financial information includes the following: age, marital status, investment experience, attitudes and values, such as ESG, investing number and age of dependents, employment stability, employment of family members, demographics, where clients live can affect their investment attitudes, current and future family educational needs, current and future family healthcare needs. There is There's one other non-financial consideration that is gaining greater prominence after the 2017 Nobel Prize in Economic Sciences was awarded to Richard H. Thaler for his work in the field. Briefly, the premise is that investors are irrational when it comes to making investment decisions. The study of this is known as behavioral finance. The Dean of Behavioral Finance, Daniel Kahneman, Ph.D., was awarded the Nobel Prize in this same field in 2002. In the announcement from the Royal Swedish Academy of Sciences, they stated, his team's findings have countered some assumptions of traditional economic. Unit 19. Unit 19 Client Profile 413. S65_Elium, in 413 March 15, 2019 10:58 and 55 seconds AM. Theory. The people make rational choices based on their self-interest by showing that people frequently fail to fully analyze situations where they must make complex judgments. Instead, people often make decisions using rules of thumb rather than rational analysis, and they base those decisions on factors economists traditionally don't consider, such as fairness, past events, and aversion to loss. Today, it is accepted that behavioral biases can cause investors to make financial decisions that are irrational. Here are some of the more common examples. Overconfidence, experienced, and even some rookie investors tend to overestimate their ability and the accuracy of the information available to them. Conservatism. Many investors have a hard time changing their existing beliefs, even when new information is presented to them. Herd behavior. A market drop may be followed by panic selling. Anchoring. The tendency to base expectations upon the first information received, which may or may not be accurate. Once a thought is anchored in your mind, it is difficult to move away from it. Regret aversion. The investor prepares himself in such a way as to avoid distress over an adverse outcome. Think about a trip to Las Vegas where you know you will probably lose, but condition yourself to expect that. Risk tolerance. U19L04. Discover the client's risk tolerance. Investor risk tolerance. The attitude toward risk and safety is an important part of a client's profile. Regardless of a person's financial status, the customer's motivation to invest and risk tolerance should shape the portfolio. Selection of specific types of investments, example stocks, bonds, annuities, depends on several factors including client's objectives, amount available for investing, client must use discretionary cash for investing, not the rent money, client's aversion to risk. Every investment involves some degree of risk because every investment requires transferring purchasing power from the present to the future, and no one knows what the future holds. To understand a customer's risk tolerance, an advisor should know information such as the following: how much of a loss the investor can tolerate, example 5%, 50%, or 100%. The liquidity requirements for investments, the importance of tax considerations. Investment time horizon, either long-term or short-term. Investment experience, current investment holdings, expectations regarding investment returns. For 14 Unit 19 Client Profile. S65_Elium, in 414 March 15, 2019 10:58 and 55 seconds AM. Investment temperament, i.e., is the client bored with stable investments or anxious with volatile ones? Level of tolerance for market fluctuations. A person's risk tolerance is often characterized as either aggressive, moderate, or conservative. Aggressive investors are willing to risk greater amounts and withstand market volatility in exchange for the chance to realize substantial returns. An aggressive investor may be willing to sustain losses of 10%, 25%, or even 50% on an investment. Moderate investors are in between the other two. They can tolerate some loss, but not nearly at the level of the aggressive investor. Conservative investors normally want the relative safety of guaranteed income with low risk to loss of principal. Very conservative investors are unwilling to sustain even modest losses on their investments. There is a full spectrum of risk profiles between these two extremes. Example. The following table is a sample of how a portfolio might be structured based on the three different risk tolerances. Asset allocation: conservative portfolio, moderate portfolio, aggressive portfolio. Stocks 30%, 60%, 80% bonds, 50%, 30%, 15% cash, 20%, 10%, 5%. Take note. An investor who claims to be aggressive but is unwilling to sustain losses is actually conservative. A client's tolerance for volatility and risk will often narrow the field of potential investments. Example: 1. In designing an investment portfolio for a new client, one of the first things to do is determine the client's A home address, B social security or tax ID number, C risk tolerance, D beneficiary. Answer: C. One can't adequately present any investment recommendations without having an understanding of the client's risk tolerance. Choice C. Home address and social security number are legal requirements for opening the account, but they don't enter into the decision-making process for portfolio design. Yes, you will want to know the beneficiary of any IRAs or qualified plans, but that has little to do with the nature of your recommendations. Unit 19. Unit 19 Client Profile 415. S65_LEM.M 415 March 15, 2019 10:58 and 55 seconds AM. Investment Objectives and Investment Constraints. U19L05. Distinguish between investment objectives and investment constraints. Within the parameters determined by a client's circumstances and financial resources, the advisor and client should establish financial goals. The most commonly specified goals include capital preservation, current income, capital growth, and speculation. The objectives behind these goals may be planning for college education, retirement, death, or disability. However, in attempting to meet these objectives, there may be some obstacles, properly referred to as investment constraints, which must be considered. When an investment advisor or IAR prepares a plan for a client, all of these factors are used to prepare an investment policy statement, IPS, we described in the previous unit. The following chart may be helpful in your review of objectives and constraints. Figure 19.1, Investment Policy Statements, Objectives and Constraints. Objectives: description, return requirements, minimum current income requirements, accumulation amount needed to meet financial goals, preservation of capital, growth, and so forth. Risk tolerance: investors' risk tolerance based on self-evaluation, objective questionnaire, and past experience. Constraints: description, time horizon, time frame in which goals must be attained. Liquidity: what is the cash need? High if close to goals, retirement or education. Low if long time horizon. Taxes: tax characteristics of investor and desired level of tax management. Laws and regulations: any legal prohibitions on types of investments or transactions. Is the investor accredited? Unique circumstances and or preferences: investor preferences or desires to avoid particular types of assets. Preservation of capital. Many people are averse to any decline in value of their investments. For such investors, bank-insured CDs, savings accounts, and money market funds offer the safety they seek. However, by reducing market risk, there is little or no market price fluctuation in these instruments. The investor is sacrificing the opportunity for higher income. In addition, as fixed income investments, they are exposed to inflation, purchasing power, risk. Bank-insured certificates of deposit, CDs. In addition to the questions about the jumbo, negotiable CDs that trade in the money market, there are questions on the exam about the certificates of deposit that you can get at your local bank. Here are some points that will help you get the right answer. Bank CDs eliminate interest rate risk. Their value remains constant, even when interest rates change. They are not savings accounts with a maturity date. They would be included as an asset on a family balance sheet. For 16 Unit 19 Client Profile. S65_LEM.M 416 March 15, 2019 10:58 and 55 seconds AM. They are the preferred answer when the question asks about a client who wants capital preservation with no risk of loss. They are insured by the FDIC up to the current limit. Limits are not tested. Each bank sets the interest rate it will pay on those CDs, with smaller banks typically offering more competitive rates. Test topic alert. On the exam, the first choice for preservation of capital should always be bank-insured CDs. In addition, because they are not marketable, traded in any marketplace, bank CDs, we're referring to the ones retail investors purchase at their local branches, not the jumbo CDs traded in the money market, have no interest rate risk. That is, because their value is fixed, you can always redeem them at face value, regardless of the direction of interest rates. The exam will ignore the fact that there may be a penalty for cashing in before maturity. Current income. Investors seeking current income will normally focus on individual securities or mutual funds that invest in fixed income investments such as government bonds and notes and agency bonds, corporate bonds, preferred stock, and utility company common stock. When the investor's goal is income, a primary factor is the amount of risk the investor is willing and or able to take. The risk-reward principle is quite clear. The more risk, the greater the potential reward, and, logically, the lower the risk, the lower the potential reward. That is why, at least for those with a low risk tolerance, but with a time horizon that doesn't require money market instruments, U.S. Treasury and agency issues along with investment-grade bonds are usually the recommendations. On the other end of the spectrum are bonds of corporations with very low credit ratings, the high-yield, or junk, bonds. These bonds tend to yield high income with principal subject to credit default risk. In the middle might be those investing in preferred stock or public utility stocks. Capital growth. Common stock investments generally provide a means to preserve and increase the buying power of an investor's money over and above the inflation rate. Although subject to short-term volatility, the equity market tends to provide higher investment returns over time. As with income, the term growth refers to a broad spectrum of investments. Aggressive growth stocks may be very appropriate for a person with a very high tolerance for risk and the ability to remain invested for many years. At the other end of the spectrum are large capitalization stock funds that invest in some of the largest and most respected companies. These funds may be a better choice for older investors who may need to liquidate the investment in 3 to 5 years, or investors who are more comfortable knowing they have invested in a fund that is less risky. Unit 19. Unit 19 Client Profile 417. S65_LM.in 417 March 15, 2019 10:58 and 55 seconds AM. Speculation. A customer may want to speculate with a portion of their investments. Speculative investments offer the opportunity to earn substantial returns but carry a commensurate amount of risk. Speculative investments may include highly volatile stocks, high-yield, junk, bonds, options on stocks or stock indexes, and commodity futures. Example. 1. An 83-year-old widower explains to you that he is risk-averse and wishes to find an investment that will provide him with preservation of capital. Which of the following might you recommend? A. An index fund. B. Bank-insured CDs. C. Long-term U.S. government bonds. D. Preferred stock. Answer. B. This exam has 2 answers for preservation of capital. The strongest is a bank-insured CD, choice B, followed by a money market fund. You'll never have both in the same question. But, aren't U.S. government bonds safe, you ask? Yes, but with maturities of 10 years or longer, that long duration involves interest rate risk. So, if the client needs money now and interest rates have increased, the principal has declined in value. College tuition. In addition to other types of investments, investors planning for college tuition often invest in zero-coupon bonds that mature when the tuition expenses are due. It may be advisable to establish college tuition investment programs such as Coverdell ESAs and Section 529 plans, covered in Unit 24, because of their tax advantages. The investments selected for either of these two have time horizon as a major constraint. That is, if the plan is started when the child is very young, the portfolio can be more aggressive than if started only a few years before the funds are needed. Retirement. In determining a client's retirement needs, Social Security, company pensions, retirement savings accounts, and insurance, as well as investments outside of a retirement planning framework, should all be considered. Once again, time horizon is an important constraint. The earlier an individual begins to save for retirement, the more time the investment assets are able to grow. A long-term retirement planning time horizon may enable an investor to assume additional risk in the portfolio, generally through equities. This helps a client accumulate significant funds to support a long retirement period. As life expectancy has risen, the topic of decumulation has come into focus. How do we make sure that the money accumulated lasts long enough? One way to minimize. 418 Unit 19 Client Profile. S65_LEM, .IM 418 March 15, 2019 10:58 and 56 seconds AM. Longevity risk is through the purchase of annuities, fixed, index, and variable, because payout is guaranteed for life. In fact, there is a specialized annuity product known as the longevity annuity, or deferred income annuity, designed specifically to cover that risk. The OASDI, Old Age Survivors and Disability Income, program, which for most Americans means Social Security, provides monthly benefits designed to replace, in part, the loss of income due to retirement, disability, or death. For too many individuals, Social Security remains their primary source of retirement income. It was never designed to be the sole source and should be thought of as a supplement to funds created in the retirement plans such as the IRAs and 401(k), as covered in Unit 24. The exam may ask several questions about this topic, including length of time necessary for full coverage, spousal benefits, and timing of beginning benefit payout. Here are the key points. To qualify for full benefits, an individual must have at least 40 quarters of employment. Waiting until age 70 to claim benefits gives the individual an 8% compound return from full retirement age. If you don't need the funds and are in good health, it is generally worth the wait. Benefits for an ex-spouse. Let's use a male with an ex-spouse and a current spouse. Basically, both spouses are entitled to benefits when the man is still alive, and both can be entitled to survivor's benefits. The topic is complicated, so the question probably deals with the most important basics. The most important rule is, if you're divorced and were married to the man for at least 10 years, you're eligible for some of your ex's Social Security. In addition to the 10-year requirement, you must be unmarried at the time you become eligible to claim on your ex's Social Security. Any benefits paid to a divorced spouse do not reduce any payments to the ex's current spouse if he remarried. That can mean 2 or more spouses receiving identical benefits while the man receives his as well. Where it gets more complicated, and probably beyond the scope of the exam, is when the man dies. When the husband/ex-husband dies, each spouse is probably due a survivor's benefit. Survivors are due between 71% at age 60 and 100% at full retirement age of what the husband was getting before he died. Death benefits. Because death can eliminate a family's primary income earner, life insurance is an important component of customer portfolios. Most experts feel that an investment plan should not commence without the breadwinners having adequate life insurance. One commonly used tool to determine that amount is the capital needs analysis. Capital needs analysis. A capital needs analysis is used to determine how much life insurance is necessary to meet future needs. At a minimum, life insurance coverage should provide for payoff of the client's mortgage and other debts, income for the survivors for a reasonable time, tuition for higher education, and estate taxes if the taxable estate will exceed $11.4 million in 2019. Unit 19. Unit 19 Client Profile 419. S65_LEM, .IM 419 March 15, 2019 10:58 and 56 seconds AM. Several factors are used in the computation to evaluate how much is necessary to meet these needs. First, we try to project the client's future earnings. Then, we estimate life expectancy and, of course, we must account for inflation. Because the death benefit in a life insurance policy is generally a fixed amount, we are not concerned about market volatility. Finally, we look at existing assets, such as savings and investments, including those which offer tax deferrals such as IRAs and employer-sponsored plans. Example. 1. When performing a life insurance needs analysis, all of the following would be evaluated except a. Projected future earnings. B. Mortgage amortization schedule. C. Stock market volatility. D. Anticipated inflation rate. Answer. C. Typically, a life insurance policy has a guaranteed death benefit, so even with a variable life policy, market fluctuations will not lead to a benefit below that minimum. The needs analysis must look into the future. We don't expect the insured to die today, so future earnings and inflation must be taken into consideration. The mortgage schedule shows the outstanding balance until the mortgage is paid off. The insurance policy needs to be able to cover that. Disability. Should a client become disabled, there are 3 possible sources of replacement income: workers' compensation, Social Security, and disability insurance. Workers' compensation. If an employee is injured on the job, workers' compensation can provide protection to cover medical expenses, replace lost income, and provide death benefits to the family. Although the workers' compensation benefits in some states, benefits vary from state to state, are quite generous, usually higher than Social Security disability. Payments are made only when the disability results from a work-related injury. Social Security. Like other Social Security benefits, a worker's disability benefit will depend on a number of factors, such as age and income. However, to receive payments, you must meet their strict definition of disabled, which is: you must not be able to engage in any substantial gainful activity, SGA, because of a medically determinable physical or mental impairments that is expected to result in death, or that has lasted or is expected to last for a continuous period of at least 12 months. For 20 Unit 19 Client Profile. S65_LEM. In 420 March 15, 2019 10:58 and 56 seconds AM. Disability insurance. Because workers' compensation only covers in limited cases and because Social Security's definition of disabled is relatively strict, most agree that it is wise to purchase a private disability insurance policy. Waiting and benefit periods can be adjusted based on the client's needs and finances. The amount of insurance can be determined by the information derived from the client's income, assets, and occupation. Test topic alert. An application for disability insurance coverage can be denied in the case of a hazardous occupation. Tax planning. A client's tax situation is often an important factor in determining suitable investments. Taxes may be reduced by using the following 3 strategies: asset and income shifting, tax deferral, or tax-free income. Asset and income shifting. A client can shift investment assets and income to a person in a lower tax bracket. Until early 2006, it was common to place income-producing assets in the name of a child aged 14 or older to avoid the kiddie tax, see Unit 24, but because it now includes all children under age 19 and full-time students under age 24, the practice has lost much of its luster. However, with many of today's baby boomers supporting elderly parents, placing those assets in the parent's name will remove the income from your client and let the parent receive the income directly with little or no tax liability. As mentioned previously, trusts may also be used to shift assets and income. Tax deferral. Contributions to a qualified retirement plan or tax-sheltered annuity are not taxed until withdrawn. Investing funds that have not been taxed allows a substantially larger portion of the investor's money to earn income or capital gains, also not taxed until withdrawn. Tax-free income. Most municipal bonds pay interest that is free from federal taxation, although they are generally subject to state income tax unless issued in the taxpayer's state of residence. Municipal bonds generally pay a lower interest rate than taxable bonds, but, depending on the investor's tax bracket, may result in higher returns on an after-tax basis. Take note. Other potential sources of tax-free earnings are Section 529 plans, Roth IRAs, and covered LESAs, all covered in Unit 24. Unit 19. Unit 19 Client Profile 421. S65_LEM. In 421 March 15, 2019 10:58 and 56 seconds AM. Time horizon. An investor's time horizon and liquidity needs will determine the level of volatility the client should assume. Over a 20 or 30-year time frame, dramatic short-term volatility is acceptable, even to those who are risk-averse. Money that will be needed within 3 to 5 years should be invested for safety and liquidity. Time horizon is a particularly important investment constraint when planning for college education and for retirement. Test topic alert. The longer the time horizon, the more market risk the account can accept and vice versa. Example. 1. A married couple is 55 and 57 years old. The older of the two plans to retire at 62 and the younger at 65, and both are healthy. What is the most appropriate estimate of the time horizon for their retirement portfolio? A. 5 years. B. 7 years. C. 8 years. D. More than 20 years. Answer. D. A time horizon does not end at retirement age. The portfolio will have to last them throughout their retirement until their death. On the basis of current life expectancy tables, the money will have to last them at least 20 years, choice D. Life cycle considerations. An investor's goals may change over time. This is especially true as investors move from one phase of life to another. For example, a young couple may have a primary goal of funding a child's education. Later, the same family, having provided for their children's education, may turn their attention to the aggressive accumulation of wealth, perhaps to provide for an early retirement or a dream home. Upon retirement, this couple may need to move toward income-producing investments. Income and net worth change over time, as do investment goals and life cycle considerations. Because the advisor's responsibility to know his client is ongoing, the account form should be updated regularly to reflect the client's new goals and financial considerations. As the baby boomer generation reaches retirement age, the regulators have increased their focus on protecting senior investors. Among the suggested practices is to take detailed notes of conversations and, when it becomes apparent that the client is not grasping as well as before, recommend that a family member or other competent person participate in all discussions. For 22 Unit 19 Client Profile. S65_LAM.in 422 March 15, 2019 10:58 and 56 seconds AM. How to make suitable recommendations. U19L06, analyze a client's financial goals and objectives for suitable recommendations. Because the highest percentage of stock market investing by Main Street America is in pooled investment vehicles, mutual funds, ETFs, and variable annuities, whether through direct investment or an employer-sponsored retirement plan, such as a 401k or 403b plan, the exam tends to use these vehicles as proxies for meeting investor objectives. Once a mutual fund or variable annuity subaccount defines its objective, its portfolio is invested to match it. The objective must be clearly stated in the fund's prospectus and can be changed only by a majority vote of the fund's outstanding shares. Stock funds. Common stocks normally provide the growth component of any mutual fund that has growth as a primary objective. Preferred, utility, and large-cap stocks are typically used to provide the income component of any stock mutual fund that has income as a primary objective. Although there are other categories to be covered in Unit 20, at this point you need to know the difference between large-cap and small-cap stocks. The term cap refers to the company's market capitalization, the number of outstanding common shares multiplied by the current market price per share. For example, a company with 30 million shares outstanding where the price per share is $30 has a market cap of $900 million. As you will see again in Unit 20, a market cap of $300 million to $2 billion is considered small cap, while that of more than $10 billion is considered large cap. It is generally felt that the larger the market cap, the more conservative the investment. Growth funds. Growth funds invest in stocks of rapidly growing corporations. Growth companies tend to reinvest all or most of their profits for research and development rather than pay dividends. Growth funds are focused on generating capital gains rather than income. Aggressive growth funds tend to concentrate more in small-cap stocks, while conservative growth funds have a preponderance of large-cap issues. Income funds. An income fund stresses current income over growth. The fund's objective may be accomplished by investing in the stocks of companies with long histories of dividend payments, such as utility company stocks, large-cap stocks, and preferred stocks. Combination funds. A combination fund, also called a growth and income fund, may attempt to combine the objectives of growth and current income by diversifying its portfolio among companies showing long-term growth potential and companies paying high dividends. Unit 19. Unit 19 Client Profile 423. S65_LM.in 423 March 15, 2019 10:58 and 56 seconds AM. Specialized sector funds. Many funds specialize in particular economic sectors or industries. Others specialize in geographic areas such as the BRIC countries or the Pacific Rim. The funds have 25 to 100% of their assets invested in their specialties and are more likely than other funds to stick to a relatively fixed allocation. Example: gold funds, gold mining stocks, insurance funds, insurance company stocks, technology funds, and utility funds are examples of sector funds. Sector funds offer high appreciation potential but may also pose higher risks to the investor because of their lack of diversification among industries or geographic areas. Special situation funds. Special situation funds buy securities of companies that may benefit from a change within the corporations or in the economy. Takeover candidates and turnaround situations are common investments. Index funds. Index funds invest in securities to mirror a market index, such as the S&P 500. An index fund buys and sells securities in a manner that mirrors the composition of the selected index. The fund's performance tracks the underlying index's performance. This approach reflects the passive style of portfolio management as opposed to active portfolio management, more on those in Unit 20. Turnover of securities in an index fund's portfolio is minimal. As a result, an index fund generally has lower management costs than other types of funds. Furthermore, because index funds have little turnover, they frequently appeal to investors seeking minimal taxable capital gains. Foreign stock funds. Foreign stock funds invest mostly in the securities of companies that have their principal business activities outside the United States. Long-term capital appreciation is their primary objective, although some funds also seek current income. Foreign investments involve foreign currency risks, as well as the usual risks associated with stock investments. Take note. There are two terms generally used to describe funds that invest in foreign securities. International funds have their entire portfolio invested in securities issued outside of the United States. The way to remember that is if you will be traveling internationally, you'll be outside the United States. Global funds have the portfolio invested around the globe, and that includes U.S. securities. Once again, using the travel example, if you were to travel around the globe, a portion of your trip would be in the United States. For 24 Unit 19 Client Profile. S65_LM.in 424 March 15, 2019 10:58 and 56 seconds AM. Example. 1. An investor looking for an open-end investment company with an objective of providing current income to its shareholders would most likely choose a common stock fund, B, a growth fund, C, an income fund, D, a venture capital fund. Answer. C. Income funds, choice C, have the goal of producing income. That is why they are named as such. This is a case where you don't look a gift horse in the mouth. Bond funds have income as their primary investment objective. Some funds invest solely in investment-grade corporate bonds. Others, for enhanced safety, invest only in government issues. Others seek maximum income by investing in lower-rated issues that entail greater risk, but potentially higher returns. Tax-free, tax-exempt, bond funds. Tax-exempt funds invest in municipal bonds that produce income exempt from federal income tax. Tax-free funds invest in municipal bonds. Please note that any capital gains distributions from the fund are taxable just as with any other fund. A key to remember for the exam is that municipal bonds or municipal bond funds are only suitable for those in higher tax brackets. U.S. government and agency securities funds. U.S. government funds purchase securities issued by the U.S. Treasury or an agency of the U.S. government, such as Ginnie Mae. Investors in these funds seek current income and maximum safety. Foreign bond funds. These funds invest in foreign sovereign and/or corporate debt issues. Although they carry the same general risks as investing directly into foreign debt, these tend to be reduced because of the professional management and diversification offered by fund investing. Unit 19. Unit 19 Client Profile 425. S65_LM.IM 425 March 15, 2019 10:58 and 56 seconds AM. Example. 1. If ABC Fund pays regular dividends, offers a high degree of safety of principal, and appeals especially to investors in the higher tax brackets, ABC is A. An aggressive growth fund. B. A corporate bond fund. C. A money market fund. D. A municipal bond fund. Answer. D. Municipal bonds are considered second only to U.S. government securities in terms of safety. Furthermore, whenever you see a question about an investor in a high tax bracket, always look for the answer choice with municipal bonds. The tax-free income is the key. That is what makes choice D correct. On the other hand, when you see growth, dividends will probably not be part of the equation. Balanced funds. Balanced funds invest in stocks for appreciation and bonds for income. The exact mix is determined according to a formula used by the portfolio manager. These tend to be the most conservative of the stock funds. Example. A balanced funds portfolio might contain 60% stocks and 40% bonds. Asset allocation funds. Asset allocation funds split investments between stocks for growth, bonds for income, and money market instruments, or cash, for stability. The fund advisor switches the percentage of holdings in each asset category according to the performance, or expected performance, of that group. We will have more to say about asset allocation in Unit 20. Example. A fund may have 60% of its investments in stock, 20% in bonds, and the remaining 20% in cash. If the stock market is expected to do well, the advisor may switch from cash and bonds into stock. The result may be a portfolio of 80% in stock, 10% in bonds, and 10% in cash. Conversely, if the stock market is expected to decline, the fund may invest heavily in cash and sell stocks. Money market funds. Money market funds are no-load, open-end investment companies, mutual funds, that serve as temporary holding accounts for investors' money. As the name implies, the portfolio of a money market fund consists of money market instruments having a maximum maturity of 397 days. The term no-load means that investors pay no sales or liquidation fees. Money market mutual funds are most suitable for investors whose financial goals require liquidity above all. For 26 Unit 19 Client Profile. S65_LM.IM 426 March 15, 2019 10:58 and 56 seconds AM. The interest these funds earn and distribute as dividends is computed daily and credited to customer accounts monthly. In general, money market mutual funds offer check-writing privileges, making for extraordinary liquidity. The net asset value, NAV, of money market funds is generally fixed at $1 per share. Although this price is not guaranteed, a fund is managed in order not to break the buck, regardless of market changes. Thus, the price of money market shares does not fluctuate in response to changing interest rates. Example. 1. An investor has a portfolio diversified among many different asset classes. If there was an immediate need for cash, which of the following would probably be the most liquid? A. Cash value from a universal life insurance policy. B. A CDL common stock mutual fund. C. A QRS money market mutual fund. D. XYZ international stock mutual fund. Answer: C. Money market funds, choice C, generally come with a check writing privilege offering investors the opportunity to convert the asset to cash at once. Although all mutual funds are readily redeemable, under the Investment Company Act of 1940, the fund has 7 days to redeem. One must request the cash value from the insurance company, and, in many cases, that can take 30 days or longer. Test topic alert. Be aware that an investment in a money market fund is not insured or guaranteed by the FDIC or any other government agency. Although a money market fund seeks to preserve the value of the investment at $1 per share, it is possible to lose money by investing in a money market fund. Alternative investments. As described in Unit 17, there are a number of alternative pooled investments. The risks and rewards were covered there, but, as a refresher, in almost all cases, these are speculative investments and will only be suitable on that basis. For example, ETNs can provide attractive short-term returns based on the performance of the selected index, but with a number of risks pointed out earlier. Leveraged or inverse ETFs or funds can offer dynamic profits, but only for those with a very short time horizon and high appetite for risk. Unit 19. Unit 19 Client Profile 427. S65_LEM.in 427 March 15, 2019 10:58 and 57 seconds AM. The following chart summarizes common investor objectives and appropriate recommendations. Be ready for a significant number of situational questions that require determining the best solution for the investor. Investor objective: suitable recommendation, preservation of capital, safety-insured bank CDs, money market instruments or funds, and T-bills growth balance / moderate growth, aggressive growth. Common stock or common stock mutual funds, large cap stocks, defensive stocks, technology stocks, sector funds, or cyclical stocks, income greatest safety, tax-free income, high yield income from a stock portfolio. Bonds, but not zero coupons, U.S. government bonds, municipal bonds or municipal bond funds, corporate bonds or corporate bond funds, preferred stock and utility stocks, liquidity money market funds, DPPs, real estate, and annuities are not considered liquid, speculation volatile stocks, high-yield bonds, stock/index options, and leveraged and inverse ETFs. For 28 Unit 19 Client Profile. S65_LEM.in 428 March 15, 2019 10:58 and 57 seconds AM. Portfolio managers use a range of investment styles and strategies. Although each style attempts to generate superior investment returns and reduce investment risks, no single style is suited to every investor. Often, an investment advisor's role is to guide clients toward a mutual fund or private money manager that is consistent with the client's objectives and temperament. The unit will conclude with a look at some of the techniques used by the various styles and strategies discussed. The Series 65 exam will include 9 questions from this unit. Learning objectives. When you have completed this unit, you will be able to accomplish the following. U20L01, discriminate between the major asset classes used in an asset allocation program. U20L02, identify the risk reduction benefits of diversification. U20L03, describe the difference between active and passive management styles. U20L04, compute a rebalancing problem. U20L05, contrast the different portfolio management strategies, styles, and techniques. U20L06, identify the major levels of market capitalization. U20L07, compare the 3 techniques for minimizing interest rate risk. U20L08, identify the components and goals of the capital market theory. U20L09, compute the expected return using the security market line. U20L10, identify the 3 forms of the efficient market hypothesis. U20L11, illustrate how dollar cost averaging results in lowering an investor's average cost per share. U20L12, describe the use of puts and calls to hedge positions. 20. Unit. Portfolio management styles, strategies, and techniques. 429. S65_LEM.in 429 March 15, 2019 10:58 and 57 seconds AM. Asset allocation classes. U20L01. Discriminate between the major asset classes used in an asset allocation. Program. Asset allocation, more accurately, but rarely stated, asset class allocation, refers to the spreading of portfolio funds among different asset classes with difference risk and return characteristics, based on the Investment Policy Statement, IPS. Proponents of asset allocation feel that the mix of assets within a portfolio, rather than individual stock selection or marketing timing, is the primary factor underlying the variability of returns in portfolio performance. There are three major types, each with subclasses, of asset classes. Stock, with subclasses based on market capitalization, value versus growth, and foreign equity. Bonds, with subclasses based on maturity, intermediate versus long-term, and issuer, treasury versus corporate versus non-U.S. issuers. Cash, focusing mainly on the standard risk-free investment, the 91-day, 13-week, treasury bill, but also including other short-term money market instruments. Proper asset allocation takes into consideration the investor's desire for preservation of capital, income, capital growth, or a combination of all of these. In some instances, tangible assets, such as real estate, usually in the form of REITs, precious metals and other commodities, and certain collectibles, think fine art, are part of the asset allocation because these types of assets tend to reduce inflation risk. Increasingly, institutional investors, and some very high net worth individuals due to the high cost of entry, are using such alternative investment asset classes as ETNs, private equity, and venture capital. It is important to understand that asset allocation is not simply spreading the money around helter-skelter to different asset classes. There is a process, as described in the following question. Example. 1. Which of the following best describes the steps of the asset allocation process? A. Determine the objectives and constraints. Create the IPS. Determine the asset allocation. Allocate capital. Monitor and evaluate. B. Determine the objectives and constraints. Determine the asset allocation. Allocate the capital. Create the IPS. Monitor and evaluate. C. Determine the objectives and constraints. Perform asset allocation. Create the IPS. Monitor and rebalance. D. Determine the objectives and constraints. Determine capital market expectations. Create the IPS. Perform asset allocation. Monitor and evaluate. Answer. Steps in the asset allocation process are those in choice A. Step 1. Determination of the objectives and constraints of the asset owner. Step 2. Creation of the Investment Policy Statement, IPS. Step 3. Determine the asset allocation based on the IPS. Step 4. Capital allocation. Step 5. Monitor and evaluate investments. For 30 Unit 20 portfolio management styles, strategies, and techniques. S65_LEM, in 4:30 March 15, 2019, 10:58 and 57 seconds AM. Benefits of diversification. U20L02, identify the risk reduction benefits of diversification. The term diversification has been used many times already in this manual. The term is a common one in our everyday life, not restricted to investing. As a technique in portfolio management, portfolio diversification, i.e., committing to an array of separate investments, reduces unsystematic risk, such as business risk, and enhances returns. The securities in a diversified portfolio are selected, in part, because they do not tend to move up or down in relation to each other. When some go down, the loss is offset by those that rise. That is the concept we covered with correlation coefficient. This kind of diversification is enhanced by the addition of foreign securities to a portfolio because they are usually not highly correlated with domestic equity. There are many ways to classify investment and financial products. The investment pyramid, shown following, for example, categorizes products according to their risk and return potential. Another way is to group similar products into specific classes. These classes are generally defined as the following: cash and cash equivalents, passbook savings and checking accounts, money market funds, bank-insured CDs, and T-bills. Fixed income investments, corporate bonds, municipal bonds, treasury bonds, bond funds, and mortgage-backed securities. Equities, preferred and common stocks of all kinds, growth, income appreciation, and stock mutual funds. Hard assets, real estate, collectibles, precious metals, and stones. Each of these asset classes, as a whole, responds differently to different types of risk. Therefore, diversifying or allocating investment resources among these classes is a proven way to reduce risk overall, dampen volatility, and improve the performance of one's portfolio. Fixed income products, for example, are a hedge against deflation. Equities are a hedge against inflation. To minimize market risk, one could diversify among all four asset categories, with additional diversification within the equities category. To minimize interest rate risk, one could diversify within the fixed income category by staggering bond maturity dates. To minimize business risk, one could allocate among the four categories and purchase mutual funds. To reduce liquidity risk, one would keep a sufficient portion of assets in cash or cash equivalent assets. Unit 20. Unit 20 Portfolio Management Styles, Strategies, and Techniques 431. S65_LEM, in 431 March 15, 2019 10:58 and 57 seconds AM. Figure 20.1, Risk Return Pyramid. Futures/commodities speculative common stocks and bonds. Gold, silver, and collectibles. Limited partnerships. High-grade common stock growth mutual funds. Balanced mutual funds high-grade preferred stock. FDIC-insured checking and savings accounts. FDIC-insured certificates of deposit. High-grade convertible securities. High-grade municipal bonds. Treasury bills, notes, and bonds insurance-based investments U.S. savings bonds. Money market accounts high-grade corporate bonds. Real estate options. Example. 1. Simply adding more securities to a portfolio does not necessarily reduce portfolio volatility. For example, if the beta of a portfolio was 1.1, adding which of the following stocks would most likely increase the overall portfolio volatility? Stock A, beta 1.5. B is stock B, beta 1.1. C, the stock C, beta 1.0. D is stock D, beta 0.7. Answer, the addition of a security with a beta higher, stock A, than that of the current portfolio will increase overall portfolio volatility. Diversification is not a synonym for asset allocation. For example, an aggressive young professional may invest almost exclusively in common stock. That would be a single asset class. But, within that asset class of common stock, the portfolio might consist of the shares of a dozen or more different companies in varied industries. Tactical asset allocation. U20L03, describe the difference between active and passive management styles. The two most common forms of asset allocation are tactical and strategic. You may see the terms active and passive management, referring to these two. Tactical asset allocation refers to short-term portfolio adjustments that adjust the portfolio mix between asset classes in consideration of current market conditions and investor sentiment. For 32 Unit 20 Portfolio Management Styles, Strategies, and Techniques. S65_LEM, in 432 March 15, 2019 10:58 and 58 seconds AM. Example. If the stock market is expected to do well over the near term, a portfolio manager may allocate greater portions of a portfolio to stocks. If the market is expected to decline, the portfolio manager may allocate greater portions of the portfolio entirely to bonds and cash. This is done in an attempt to create positive alpha for the portfolio. An active, tactical, portfolio manager, using a particular stock selection approach, typically buys and sells individual securities. Active management relies on the manager's stock picking and market timing ability to outperform market indexes. Market timing is the strategy of making buy or sell decisions, generally regarding stocks, by attempting to predict future price movements. Usually, the focus is on timing the overall market rather than a specific security. Example. An active portfolio manager may position the portfolio in stocks within a few market sectors, such as pharmaceuticals and technology, frequently trading in and out of the stocks. An active manager may change the sector focus to capitalize on relative performance of different sectors during different stages of the business cycle. The goal is to successfully time the market. The term used to describe this process is sector rotating, sometimes called sector or segment rotation. Different sectors of the economy are stronger at different points in the economic cycle. Each industry sector follows its cycle as dictated by the stage of the economy. Portfolio managers attempt to buy into the next sector that is about to experience a move up. When an industry sector reaches the peak of its move as defined by the business cycle, it is time to start to sell the sector. Test topic alert. One way to remember that tactical is active is by thinking of the word like this, tactical, where the act reminds you that it is active portfolio management. Strategic asset allocation. Strategic asset allocation refers to the proportion of various types of investments composing a long-term investment portfolio. A passive portfolio manager believes that no particular management style will consistently outperform market averages and therefore constructs a portfolio that mirrors a market index, such as the S&P 500. In many cases, rather than construct a portfolio, those following this style will simply recommend index funds and/or ETFs. Passive portfolio management seeks low-cost means of generating consistent, long-term returns with minimal turnover. When a portfolio is passively managed, it can happen that one asset class or even a single security can rise or decline in such a manner as to cause the portfolio to no longer mirror the targeted index or portfolio balance. When that happens, the manager will rebalance the portfolio, will demonstrate how in the next learning objective. Example. A standard asset allocation model suggests subtracting a person's age from 100 to determine the percentage of the portfolio to be invested in stocks. According to Unit 20. Unit 20 Portfolio Management Styles, Strategies, and Techniques 433. S65_LEM, .aim 433 March 15, 2019 10:58 and 58 seconds AM. This method, a 30-year-old would be 70% invested in stocks and 30% in bonds and cash. A 70-year-old would be invested 30% in stocks with the remainder in bonds and cash. Test topic alert. You may be asked about the relative commission expense when comparing active and passive management. It should be obvious that the more active the portfolio, the greater role commissions will play in determining overall portfolio performance. That is one reason why this style is more appropriate than strategic allocation for RAFAEL accounts. Rebalancing. U20L04, Computer Rebalancing Problem. A passive portfolio is rebalanced to bring the asset mix back to the target allocations. If the stock market should perform better than expected, the client's proportion of stocks to bonds would be out of balance. So, on some timely basis, perhaps quarterly but not less than annually, stocks would be sold and bonds would be purchased, or funds would be placed in cash, to bring the proportions back to the desired levels. Example. Using the 70% equity/30% debt model described previously, the investor's initial investment of $100,000 is split $70,000 into equity securities and $30,000 into debt securities. Let's say the account is to be rebalanced semi-annually. Because of a bull market in stocks, 6 months later, the account value is $120,000. Analysis of the account indicates that the value of the equities is now $90,000, whereas the bonds have remained stable at $30,000. To rebalance, that is, to bring the account back to the 70-30 ratio, it will be necessary to sell $6,000 of the equity and invest those funds into debt. That will make the account $84,000 equity and $36,000 debt, our desired 70-30 ratio. The effect of this is that stocks are sold in a rising market and purchased in a falling market, following the old adage of buy low and sell high. Now, you try one. Example. 1. A conservative client's portfolio is designed to have a 60-40 ratio of debt to equity securities. The initial investment was $250,000. 1 year later, the value of the portfolio is $260,000 with $90,000 of that represented by the equity portion. If the portfolio is rebalanced annually, this would require A. Selling $14,000 of debt and buying $14,000 of equity. B. Selling $14,000 of equity and buying $14,000 of debt. C. Selling $6,000 of debt and buying $4,000 of equity. D. Buying $10,000 of equity and selling $10,000 of debt. Answer: A 60/40 ratio will require the debt represent $156,000, 60% of $260,000, and equity represent the balance, $104,000. Thus, this portfolio. For 34 Unit 20 Portfolio Management Styles, Strategies, and Techniques. S65_LM, in 434 March 15, 2019 10:58 and 58 seconds AM. Will be rebalanced by selling $14,000 of debt and purchasing $14,000 of equity, choice A. Constant ratio plan. An investment plan that attempts to maintain the type of relationship shown in our example between debt and equity securities or other asset classes is sometimes called a constant ratio plan. Periodically, the account is rebalanced to bring it back to the desired ratio. Constant dollar plan. Under this investment plan, the goal is to maintain a constant dollar amount in stocks, moving money in and out of a money market fund when necessary. Using the last example, if the investor had a goal of a constant dollar of $70,000 in stock, the other $30,000 would be placed into a money market fund. When the stock value rose to $90,000, $20,000 would be liquidated and placed into the money market account. At this point, the account would have the desired $70,000 in stock and now have $50,000 in money markets. If the stock value should drop to $55,000, the money market fund would be tapped for $15,000 to get back to the $70,000 constant dollar. Example. 1. Which of the following statements is correct regarding a portfolio manager employing a tactical style? A. The commission expense will likely be higher than one employing a passive style. B. The portfolio will be rebalanced more often than would be the case with a passive style. C. The manager is looking to create a positive beta. D. The portfolio will contain a high percentage of index ETFs. Answer. A tactical style is an active one with frequent trading. As such, commissions will be a larger portion of the operating expenses, choice A, than would be the case with a passive strategy. Rebalancing is an integral part of passive management. The very nature of tactical management makes rebalancing unnecessary. Tactical asset managers are looking to create positive alpha, not beta, and it is the passive manager who invests in indexes through ETFs and/or index funds. Low-cost management strategies. U20L05, contrast the different portfolio management strategies, styles, and techniques. Money managers use a number of different styles and techniques. For the most part, these can be considered subsets of either active or passive management, or both. Unit 20. Unit 20 Portfolio Management Styles, Strategies, and Techniques 435. S65_LM, in 435 March 15, 2019 10:58 and 58 seconds AM. Buy and hold. A buy and hold manager rarely trades in the portfolio. This results in lower transaction costs and capital gains, which are invariably taxed at the lower long-term rate, Unit 21. A low expense ratio in a mutual fund often may reflect a buy and hold approach. This is the classic passive strategy used by investors for many years and is probably the easiest of all to implement and follow. With this strategy, there is always the question, when do I sell? As with most investment strategies, there are varying opinions. On an individual investor level, one of the most common reasons for unloading a position is a change in objectives. This is certainly true as one ages, or if one has a windfall, such as an inheritance. Of course, if there is a personal financial need, the asset will be sold to provide the necessary funds. Portfolio managers using this style may sell when the stock's fundamentals have weakened, such as a sharp decrease in earnings, or a change in the competitive arena. Think of what digital cameras did to Kodak. Another case would be when the company's price-to-earnings ratio, PE, has reached levels well above those for its competitors. Test topic alert. Maybe you've owned a car that was a lemon. That generally means you had high maintenance costs. One point to know about the buy and hold style is that it is just the opposite, it is low maintenance. Indexing. Investment portfolios constructed to mirror the components of a particular stock index, such as the S&P 500, will normally perform in line with the index. Because such portfolios are not actively managed, the costs of managing the portfolio are relatively low. With less frequent portfolio turnover, these funds have lower transaction costs and tend to be more tax efficient. Because most professional money managers are unable to consistently outperform market indexes, indexed mutual fund portfolios are a popular investment vehicle for investors. With the advent of index funds and ETFs, this has become a very popular passive strategy. Growth versus value. One of the longest-running arguments in investment analysis is, which is more successful, the growth style or the value style? The father of value investing was Benjamin Graham, and his text Security Analysis, co-authored with David Dodd in 1934, is still widely read today. The exam won't ask you about Graham and Dodd, but will want you to know the essential features of both styles. Growth style. Portfolio managers using the growth style of portfolio management focus on stocks of companies whose earnings are growing faster than most other stocks and are expected to continue to do so. Because rapid growth in earnings is often priced into the stocks, growth investment managers are likely to buy stocks that are at the high end of their 52-week price range. Therefore, in the eyes of some, they might be buying stocks that are overvalued. For 36 Unit 20 portfolio management styles, strategies, and techniques. S65_LEM.IN 436 March 15, 2019 10:58 and 58 seconds AM. Test topic alert. Growth managers are looking for earnings momentum. Value. Portfolio managers using the value style of management concentrate on undervalued or out-of-favor securities whose price is low relative to the company's earnings or book value and whose earnings prospects are believed to be unattractive by investors and securities analysts. In fact, sometimes value managers think they can find a bargain with companies that are currently operating at a loss, no earnings, hence no PE ratio. Value investment managers seek to buy undervalued securities before the company reports positive earnings surprises. Their primary source of information is the company's financial statements. Value investment managers are more likely to buy stocks that are at the bottom of their 52-week price range. Test topic alert. In addition to the pricing models expressed previously, growth managers expect to see high PE ratios, price-to-earnings ratios, or high price-to-book ratio with little or no dividends. On the other hand, value managers expect to see a low PE ratio or low price-to-book ratio and dividends offering a reasonable yield. Another sign of a value stock is a large cash surplus, sometimes referred to as a rainy day fund. Example. ABC Company is a metal processor for parts used in the automotive industry. Earnings per share have grown by a compounded rate of 8% per year for the past 15 years, but are somewhat susceptible to downturns in the economy. The stock has paid a quarterly dividend that has increased 5 times in the past 10 years, and the current market price of the stock is 6 times earnings. Conservatively managed, the company owns assets and cash that exceed the market value of its common stock. ABC would be attractive to value investors because its intrinsic value is higher than its market value, it appears to pay liberal dividends, and it is selling for a low earnings multiple. Other portfolio management styles. In addition to those already described, there are several other styles you should be familiar with. Contrarian. A contrarian is an investment manager who takes positions opposite of that of other managers or in opposition to general market beliefs. In essence, these managers buy when everyone else is selling and sell when everyone else is buying. Income versus capital appreciation. At first glance, this might appear to be a rehashing of growth versus value and, although there are some similarities, you should be aware of what each of these styles represents. Unit 20. Unit 20 Portfolio Management Styles, Strategies, and Techniques 437. S65_LEM.in 437 March 15, 2019 10:58 and 58 seconds AM. Capital appreciation. Capital appreciation can take several forms, from moderate to aggressive. Although growth stocks will frequently be found in these portfolios, the hunt for appreciation will also involve options and/or futures, special situation stocks, potential takeover or merger candidates, futures, IPOs, and day trading. When recommending a manager using this style, it is critical to determine where on the risk scale, from lower to moderate to speculative, this manager's philosophy is. Then, and only then, can you attempt to match it with your clients? Income. As the term implies, the income style focuses on generating portfolio income. When dividends on common stock offer better income opportunities than interest on debt securities, the portfolio will be overweight in that direction. Frequently, the search for income will lead the portfolio manager to foreign securities and/or high-yield bonds. When recommending a manager using this style, it is important to evaluate the risks being taken to provide income. For the most part, an income style relies heavily on debt securities. Monte Carlo simulations. Stochastic modeling is a method of financial analysis that attempts to forecast how investment returns on different asset classes vary over time by using thousands of simulations to produce probability distributions for various outcomes. The term stochastic comes from the Greek word meaning to aim or guess. When an investment advisor is called upon to provide advice on developing a plan for a client's funds to last throughout what might be a 30-year or even longer retirement, all the advisor can do is make an educated guess. A popular form of stochastic modeling that uses computer-generated distributions is the Monte Carlo simulation, MCS. This simulation is an analytic and risk management tool widely used in finance. MCS incorporates computer programming to generate thousands of different probabilities. Consider the uncertainty in retirement planning. Small changes in the projected rate of return will make a dramatic difference in the outcome. Life expectancy is also another important variable that may be incorrectly approximated. MCS uses a random number generator to provide an output with specific probabilities of outcomes. The simulation provides insight into the range of outcomes and provides the user, the investor or advisor, with both a best case and a worst case scenario. Advantages. Can clearly display trade-offs of risk and return. The paths can be ranked from best to worst to assess the probability of any given outcome. A clearer understanding of short-term and long-term risk can be gained. For example, reducing the holdings of risky stock would reduce the short-term variability of the portfolio but increase the long-term risk of not having running out of money. For 38 Unit 20 Portfolio Management Styles, Strategies, and Techniques. S65_LEM.in 438 March 15, 2019 10:58 and 58 seconds AM. MCS can better model the real probability process where return over time depends not only on the starting value of the period, but also on the additions or withdrawals to the portfolio at each future period. Points along the timeline can be considered to answer questions such as, do savings need to be increased? Can I retire earlier? Must I retire later? Do I need to reduce my withdrawal rate? Can I increase my withdrawal rate? Disadvantages. Simplistic use of historical data, such as expected returns, for the inputs. Returns change and have a major effect on projected future values of the portfolio. Models that simulate the return of asset classes, but not the actual assets held. Simulating the return of the Wilshire 5000 or the S&P 500 when a fund with fees will be held could significantly overstate the future value or time period over which distributions can be sustained. For an individual entering retirement, the timing of the cash flows out of the portfolio and the sequence of returns are critical. Example. Consider two clients, Mr. Jones and Ms. Smith. Both enter retirement with $1 million, both withdraw $50,000 per year from their portfolios, and both portfolios generate an average return of 10% over the life of the portfolios. Their yearly results are the same, but they come in different sequences. Jones experiences 15 up years followed by 5 down years. Smith experiences 5 down years followed by 15 up years. Jones will be better off than Smith, because Smith will deplete her portfolio in the early years, and hence her portfolio will not benefit fully from the positive return years down the line. The concept of ill-timed cash flows may be easy for experienced advisors to grasp, but it is not one that clients readily understand. Through the use of NCSs, advisors can easily generate charts and graphs to educate clients about sequential return issues. Market capitalization levels. U20L06, identify the major levels of market capitalization. Definition: market capitalization. A company's market capitalization, usually referred to as market cap, is the product of the number of outstanding shares and the current market price per share. For example, if a corporation has 100 million shares of common stock outstanding and the market price per share is $50, the market cap is $5 billion. Another portfolio management style is using market capitalization to influence security selection. Although the boundaries are imprecise, microcap companies are generally those with a market capitalization of less than $300 million. Small-cap companies are generally those with a market capitalization of between $300 million and $2 billion. Mid-cap companies are those with $2 billion to $10 billion, and large-cap companies are those with more than $10 billion. Unit 20. Unit 20 Portfolio Management Styles, Strategies, and Techniques 439. S65_LEM.IN 439 March 15, 2019 10:58 and 59 seconds AM. It is generally assumed that small companies with a short history, small product line, and limited financial resources represent a larger degree of risk in an economic downturn. As revenues, product diversification, and financial worth increase, the relative risk the company carries in a weak economy diminishes. In Unit 23, we will match each level to its appropriate benchmark index. Test Topic Alert. Look out for numbers written in long form. For example, where would you categorize a stock with a market capitalization of $5 billion? Were you able to fight through all of those zeros to see that this is $5 billion and is a mid-cap security? Take note. In a strong economy, small, fast-moving companies with a concentrated product line in a fast-growing sector can dramatically outperform larger, more bureaucratic companies. Minimizing interest rate risk. U20L07, compare the 3 techniques for minimizing interest rate risk. Most of the substance of the exam will deal with strategies employed in equity investing, but you may be asked about several popular strategies used by bond buyers. Primarily, the goal in all of these strategies is to mitigate the effects of interest rate fluctuations on the value of the principal, the income received, or both. 3 in particular are the barbell strategy, the bullet strategy, and the laddering strategy. All 3 of these are considered active rather than passive, and we will look at them individually. Barbells. Envision a barbell. What do you see? A thin bar with heavy weights of equal size on each end. That's what a bond portfolio using the barbell strategy looks like. The investor purchases bonds maturing in 1 or 2 years and an equal amount maturing in 10 or more years with no bonds in between. Assuming a normal yield curve, the long-term end of the barbell contains bonds offering the higher long-term interest rates, while the short-term end provides you with soon-to-be realized cash, as they mature, that may be reinvested at higher rates if that is the direction the market takes. This is not a passive strategy like buy and hold. You will be actively buying new bonds as the old ones get closer to maturity. For 40 Unit 20 Portfolio Management Styles, Strategies, and Techniques. S65_LEM.IN 440 March 15, 2019 10:58 and 59 seconds AM. Bullets. For what do you use a bullet? You use it to hit a target, and that is the concept behind the bullet strategy. Let's say the target is funds for a child's college education, and the child is currently 6 years old. This strategy would have the investor purchase bonds today that mature in 12 years, assuming college starting when the child is 18. 2 years from now, the investor should purchase some more bonds, but those should have a 10-year maturity. In another 2 years, another purchase is made, this time of bonds that have 8 years to go, and so forth. A picture of this active strategy would reveal bonds purchased at different times, but all maturing at the same time. This tends to allow the investor to capture current interest rates as they change rather than having the entire portfolio locked into one rate. Ladders. Picture a ladder. You see rungs at set intervals going from bottom to top. That is the concept behind a laddered portfolio. Unlike the bullet strategy described previously where the bonds are bought at different times but all mature together, in a laddered strategy, the bonds are all purchased at the same time but mature at different times, like the steps on the ladder. As the shorter maturities come due, they are reinvested, and now become the long-term ones. This has also been a very common strategy with those purchasing CDs at their local bank. Examples. 1. An investor in debt securities might elect to use any one of the following techniques to limit interest rate risk except A. Barbells, B. Bullets, C. Increasing the duration, D. Laddering. Answer. C. The longer the duration, the greater the interest rate risk, choice C, so the investor would not want to do that. The others are useful strategies for reducing interest rate risk. 2. Which of the following statements regarding a bond ladder strategy is correct? A. A bond ladder strategy involves the purchase of very long-term and very short-term bonds. B. A laddered portfolio of bonds will provide lower yields than a portfolio consisting entirely of short-term bonds. C. A bond ladder strategy is generally more aggressive than a bond barbell strategy. D. The bond ladder strategy is a relatively easy way to immunize a portfolio against interest rate risk. Answer. D. The bond ladder strategy, choice D, is a relatively easy way to immunize a portfolio against interest rate risk. By holding many positions across the yield curve, the individual is diversified in the event that yields behave differently in one part of the curve than in another. The laddered portfolio will generally provide higher, not lower, yields than a portfolio consisting entirely of short-term bonds. Choice A describes the bond barbell strategy, not the bond ladder strategy. Unit 20. Unit 20 Portfolio Management Styles, Strategies, and Techniques 441. S65_LM.in 441 March 15, 2019 10:58 and 59 seconds AM. Capital Market Theory. U20L08, identify the components and goals of the capital market theory. Portfolio management theory builds on a foundation of assumptions about investors' behavior and was first introduced by Harry Markowitz in 1952. At its core, modern portfolio theory proceeds from the premise that investors will behave rationally. Pricing models have been introduced to determine what should be the proper market price for investment assets. The most familiar and useful of these models is the capital asset pricing model, known as CAPM, which derives from the work of Markowitz and others, including William Sharpe, after whom the Sharpe ratio was named. Several capital market theories exist, all with the goal of maximizing returns while minimizing risks. Capital Asset Pricing Model, CAPM. CAPM is a securities market investment theory allowing the investor to determine an asset's expected rate of return, a form of risk-adjusted return encapsulating how much risk the investor should assume to obtain a particular return from an investment. The CAPM does so solely on the basis of the asset's systematic, non-diversifiable risk. William Sharpe first formulated the CAPM in the 1960s. The basic premise is that every investment carries two distinct risks, systematic, which cannot be diversified away, and unsystematic risk, which can be mitigated through appropriate diversification. As a result of this work, and its further refinements, Professor Sharpe was awarded the Nobel Prize in Economics in 1990, that is untested. You will see several applications of the CAPM in upcoming paragraphs. Modern Portfolio Theory. Modern portfolio theory is an approach that attempts to quantify and control portfolio risk. It differs from a traditional securities analysis in that it emphasizes determining the relationship between risk and reward in the total portfolio rather than analyzing specific securities. Under the CAPM, the investor should be rewarded for the risks taken, so it is proper to assume that the higher the risk, the higher the return. Instead of emphasizing particular stocks, modern portfolio theory, MPT, focuses on the relationships among all the investments in a portfolio. This theory holds that specific risk can be diversified away by building portfolios of assets whose returns are not correlated. MPT diversification allows investors to reduce the risk in a portfolio while simultaneously increasing expected returns. Diversification reduces risk only when assets whose prices move inversely, or at different times, in relation to each other are combined. In other words, decreased correlation leads to decreased risk. The theory is that, all factors being equal, the portfolio with the least amount of volatility would do better than one with a greater amount of volatility. For 42 Unit 20 Portfolio Management Styles, Strategies, and Techniques. S65_LAM, in 442 March 15, 2019 10:58 and 59 seconds AM. Test Topic Alert. The goal is to design the optimal portfolio. An optimal portfolio is one that returns the highest rate of return consistent with the amount of risk an investor is willing to take. In other words, an optimal portfolio is the portfolio that makes the best trade-off between risk and reward for a given investor's investment profile. Simply stated, given a choice between assets with equal rates of expected return, the risk-averse investor will always select the asset with the lowest level of risk. Example 1. Risk aversion means that if two assets have identical expected returns, a risk-averse individual will choose the asset with the A, lower risk level, B, higher standard deviation, C, shorter payback period, D, higher expected return. Answer: risk-averse investors are those with a low tolerance or capacity for risk. Given a choice between assets with equal rates of expected return, the risk-averse investor will always select the asset with the lowest level of risk. Choice A. A standard deviation is a way to quantify risk. The higher the standard deviation, the greater the volatility. The payback period is used to evaluate capital projects, not investment returns. Capital market assumptions. The capital market theory builds upon the Markowitz portfolio model. The main assumptions of the capital market theory are as follows. All investors can borrow or lend money at the risk-free rate of return. All investors are rational and evaluate investments in terms of expected return and variability, standard deviation. Therefore, given a set of security prices and a risk-free rate, all investors use the same information to generate an efficient frontier. The time horizon is equal for all investors. When choosing investments, investors have equal time horizons for the chosen investments. There are no transaction costs or personal income taxes. Investors are indifferent between capital gains and dividends. There is no inflation. All assets are infinitely divisible. This indicates that fractional shares can be purchased. There is no mispricing within the capital markets. It is assumed that the markets are efficient and that no mispricings within the markets exist. Another way to state this is that capital markets are in equilibrium. Capital market line. One of the offshoots of the CAPM is the capital market line, CML. The CML provides an expected return based on the level of risk. The equation for the CML uses the expected return of the portfolio. Unit 20. Unit 20 Portfolio Management Styles, Strategies, and Techniques 443. S65_LAM, in 443 March 15, 2019 10:58 and 59 seconds AM. Risk-free rate, return on the market, standard deviation of the market, and standard deviation of the portfolio. Take note that the CML, like Markowitz's efficient frontier, uses standard deviation as the measure of risk. Test topic alert. Please note that alpha and beta are not used in the CML equation while standard deviation is. Efficient portfolios/efficient frontier. The goal of MPT is to construct the most efficient portfolio. One selects the efficient set from the feasible set. The feasible set of portfolios represents all portfolios that can be constructed from a given set of equities. An efficient portfolio is one that offers the most return for a given amount of risk, or the least risk for a given amount of return. The collection of efficient portfolios is called the efficient set or efficient frontier. The universe of these portfolios is, in turn, plotted on a risk-return parabola known as the efficient frontier. Specifically, this curve represents that set of portfolios that has the maximum rate of return for every given level of risk. The objective is for the portfolio to lie on the curve. Then, by being on the efficient frontier, the optimal portfolio has been created. Any portfolio that is below the curve, not an efficient one, is said to be taking too much risk for too little return. A portfolio above the efficient frontier is impossible. In pictorial terms, the efficient frontier is depicted as follows. Figure 20.2, efficient frontier. Risk, sigma. Every portfolio residing on the efficient frontier has either a higher rate of return for equal risk or lower risk for an equal rate of return than another portfolio below, underneath, the. For 44 Unit 20 Portfolio Management Styles, Strategies, and Techniques. S65_LM.IN 444 March 15, 2019 10:59 a.m. Frontier. For example, in the previous graphic, portfolios A and B are both equally efficient and are more efficient than portfolio C because portfolio A has an equal expected rate of return as portfolio C but with a significantly lower level of assumed risk, and portfolio B has an equal level of assumed risk as portfolio C but with a significantly higher expected rate of return. Therefore, portfolio C is inefficient. It is attainable but not optimal. Portfolio D is unattainable because it resides above the efficient frontier. As the graphic indicates, the expected rate of return is unattainable because it is located outside the universe of available portfolios. In the figure, portfolios A and B are both efficient, but portfolio C is not. Example 1. According to modern portfolio theory, the optimal portfolio is one that A lies above the efficient frontier, B lies below the efficient frontier, C lies on the efficient frontier, D provides the lowest return for the highest risk answer. C. The efficient frontier is a curve representing the amount of return for a specified risk. Portfolios residing on that curve provide the highest return for that level of risk and are considered optimal or efficient portfolios. Choice C. Below the efficient frontier is inefficient and a portfolio cannot lie above the curve. The security market line. U20L09. Compute the expected return using the security market line. The CML provides an expected return for a portfolio based on the expected return of the market, the risk-free rate of return, and the standard deviation of the portfolio in relation to the standard deviation of the market. The CML is generally used to evaluate diversified portfolios. The security market line, SML, which is derived from the CML, allows us to evaluate individual securities for use in a diversified portfolio. The expected return for the asset, the risk-free rate, the return on the market, the beta of the asset. The SML determines the expected return for a security on the basis of its beta and the expectations about the market and the risk-free rate. Basically, we want to determine how much over the risk-free rate we should earn for taking the investment risk. You may be asked to compute the expected return using the SML. It is done like this. Unit 20. Unit 20 Portfolio Management Styles, Strategies, and Techniques 445. S65_LM.IN 445 March 15, 2019 10:59 a.m. We start by comparing the market's return to the RF rate, expecting it will be higher because of the risk. Then we multiply the difference by the stock's beta and add that number to the RF rate. It is much easier to follow with the numbers. Example. If the beta of ABC Company is 1.2 and the market return is expected to be 13% with a risk-free return of 3%, then the expected return of ABC is 15% as follows. We begin with the difference between the risk-free rate and market rate. 13% minus 3 equals 10%. Then we multiply the expected return in excess of the RF rate by the stock's beta, 10% times 1.2 equals 12%. Finally, we add the RF rate, 3%, to the 12% and arrive at 15%. Therefore, on the basis of the level of systematic risk of ABC Company, it should earn a return of 15%. The SML helps identify how the characteristics of a portfolio will be impacted when a security is added to the portfolio. You should note that the SML accounts for the impact of systematic risk, as measured by beta, only and does not take into consideration unsystematic risk, which is assumed to have been diversified away. The efficient market hypothesis, IM. U20L010, identify the three forms of the efficient market hypothesis. The efficient market hypothesis, EMH, maintains that security prices adjust rapidly to new information with security prices fully reflecting all available information. In other words, markets are efficiently priced as a result. This is sometimes referred to as the random walk theory. The random walk theory would suggest that throwing darts at the stock listings is as good a method as any for selecting stocks for investment. Eugene F. Fama, professor at the University of Chicago, coined the term in a 1965 Financial Analyst's Journal article entitled Random Walks in Stock Market Prices. There are three versions of the EMH based upon the level of available information. The more information available, the more likely it is that you should be able to beat the market. But, as we will see, under this theory the conclusion is that under all circumstances, there is no way to accurately predict stock prices, and a passive strategy is probably the most suitable for investment success. Weak form market efficiency. The weak form holds that current stock prices have already incorporated all historical market data and that historical price trends are, therefore, of no value in predicting future price changes. Although fundamental analysis and insider information may produce above-market returns under the weak form, technical analysis is of no value. Indeed, none of the forms of EMH attributes any value to technical analysis. Semi-strong form market efficiency. The semi-strong form holds that current stock prices not only reflect all historical price data but also reflect data from analyzing financial statements, industry, or current economic outlook. For 46 Unit 20 Portfolio Management Styles, Strategies, and Techniques. S65_Elium.in 446 March 15, 2019 10:59 a.m. Thus, even fundamental analysis is of no value in this form, and only insider information may produce above-market returns. Technical analysis is also of no value. Strong form market efficiency. The strong form of the EMH states that security prices fully reflect all information from both public and private sources. The strong form includes all types of information, past security market, public, and private, inside, information. This means that no group of investors has monopolistic access to information relevant to the formation of prices, and none should be able to consistently achieve positive abnormal returns. Although some would disagree, the prevailing opinion is that the only thing that will work in this case is random walk, just throwing darts, because the market is totally efficient with market prices quickly adjusting to reflect new information. Take note. According to the EMH, if a financial market is weakly efficient, technical analysis will be useless, but it is still possible to use fundamental analysis to seek out mispriced investments. On the other hand, if a financial market is semi-strong formally efficient, there is no point in using any fundamental analysis tools. All of that information is already in the hands of all investors. If a financial market is strongly efficient, then everything, including information generally only available to insiders, is known and, without an edge, there is no benefit to be gained by using any analytical tools. Take note. As a base-level knowledge of the EMH, you should know that the weak form is based on past security market information, the semi-strong form is based on all public information, including market information, and the strong form is based on both public information and inside or private information. The following chart may help you with EMH. Figure 20.3, the three forms of EMH. Form won't work will work. Weak technical analysis, fundamental analysis, and insider information. Semi-strong technical and fundamental analysis insider information. Strong technical and fundamental analysis and insider information random walk. Test topic alert. You may have to know that there is no such term as semi-weak EMH. Can't imagine what would be weaker than weak anyway. Unit 20. Unit 20 Portfolio Management Styles, Strategies, and Techniques 447. S65_Elium.in 447 March 15, 2019 10:59 a.m. Example. 1. Followers of the efficient market hypothesis believe that following the business cycle is the best way to maximize returns. B. Concentration rather than diversification will produce superior returns. C. By following the pundits on TV, you'll wind up rich. D. An efficient market is one that produces random results. Answer. DEMH is really just an extension of the random walk theory, choice D, which states that throwing darts at the stock market page is as good as any way to select investments. If the market is truly efficient, no one has an edge. One common fear of investors is buying at the top of the market. One can never know when a bull market will reverse its course. Conversely, we all want to get in at the bottom, but how do you know when the bear market is over? Because no one knows all of the answers, one popular technique is time-based investing to average your cost. Popular time-based investment programs used by investors include dollar cost averaging and income reinvestment. Dollar cost averaging. U20 Yellow 11 illustrate how dollar cost averaging results in lowering an investor's average cost per share. Investors use dollar cost averaging as a means to invest consistent amounts of money in a mutual fund or stock at regular periodic intervals, such as monthly or quarterly. This form of investing allows the individual to purchase more shares when prices are low and fewer shares when prices are high. This has the effect of reducing timing risk, the risk that all of your money will be invested at a market top. In a fluctuating market, the average cost per share is lower than the average price per share. Example. The following table illustrates how average price and average cost may vary with dollar cost averaging. Month amount invested price per share No shares January $600 $20 30th February $600 $24 25th March $600 $30 20th April $600 $40 15 total $2,400 $114.90. The average cost per share equals $2,400, the total investment, divided by 90, the total number of shares purchased, or $26.67 per share, whereas the average price per share is $28.50, $114/4. With any market fluctuations, this strategy will produce a lower cost, $26.67, than average price, $28.50. This average cost of $26.67, not the average price paid of $28.50, is the investor's cost basis when the shares are subsequently sold. For 48 Unit 20 Portfolio Management Styles, Strategies, and Techniques. S65_Elium.in 448 March 15, 2019 10:59 and 1 second a.m. Test topic alert. Although it is unlikely that you will have to compute the average price or average cost per share, a question may ask the purpose of dollar cost averaging. The purpose of dollar cost averaging is to reduce the investor's average cost to acquire a security over the buying period relative to its average price. Hedging with equity options. U20 Yellow 12 describe the use of puts and calls to hedge positions. The final strategy discussed in this unit is using options to hedge a position. In the real world, these are very popular tools to limit risk, and the exam usually contains one question on there. Use. An investor with a long position in a stock, she owns it, can use options to hedge the position's risks. Remember, the term hedge, used in this context, means to protect. Long stock and long puts. What if the investor is concerned about a potential drop in the price of her stock? An investor who owns a stock can protect against a decline in market value by buying a put. Doing so allows the investor to sell the stock by exercising the put if the stock price declines before expiration, which will offset the decline in the stock price. This strategy is called portfolio insurance. Any profits in the stock are offset by the cost of the put premiums. Example: a concerned, afraid investor who owns 100 shares of stock with a current market value of $50 purchases a 50 put at $2.50 for protection. If the stock goes down to $40 per share, the investor has the ability to exercise the put, deliver the stock, and receive $50 per share. The only cost for this protection is the premium of $2.50 paid for the put. So, instead of losing $1,000, the loss was held to only $250. Test topic alert. This strategy is also useful for managers of large portfolios, such as pension funds. If the portfolio consisted of large-cap stocks, a way to hedge against a down market would be to purchase put options on an index that mirrors the portfolio. In the case of large-cap stocks, that would generally be the S&P 500 index. More about that in Unit 23. Long stock and short calls, covered call writing. A covered call is a call written, sold, on a stock an investor owns. The covered call writer reduces the risk of that long stock position and generates income with the dollars received in premiums from selling the call. If the call is not exercised, the call writer keeps the premium. If the call is exercised, the covered call writer can deliver the stock owned. The covered call writer limits potential gain in exchange for the partial protection against a loss. Unit 20. Unit 20 Portfolio Management Styles, Strategies, and Techniques 449. S65_LAM.M 449 March 15, 2019 10:59 and 1 second AM. Partial protection. By writing a covered call and receiving the premium, an investor, in effect, reduces the stock cost by the premium amount. If the stock price falls below the purchase price minus the premium received, the investor incurs a loss. Should the stock price rise dramatically, the stock will likely be called. Example: an investor buys 100 shares of REST at 53 and writes one RST55 call for 2. The premium offsets the stock price by the $2 per share premium received. The maximum gain equals $400. If the stock price rises above 55, the call will be exercised. Thus, the investor will sell the stock for a gain of $200, in addition to the $200 premium received. The $200 premium initially received lowers the true cost of the stock to $51 per share, so the investor is protected against loss for the first 2 points of market decline. The maximum loss is $5,100, instead of $5,300, should the stock become worthless. Take note. A covered call provides partial protection that generates income but reduces the stock's potential gain. Buying puts provides nearly total loss protection that costs money yet does not reduce the stock position's potential gain. The benefit of the covered call is that it does offer some hedging with no cost. In fact, the investor receives income in the form of the premium. Short stock and long calls. An investor who sells a stock short sells borrowed stock, expecting the price to decline. The short seller must buy stock to repay the stock loan and hopes to do so at a lower price. A short seller can buy calls to protect against a price rise. If you are not familiar with the concept of short selling, it will be covered in Part 4, Unit 22. Example: an investor sells short 100 shares of REST at 58 and buys in REST 60 call for 3. The maximum loss is no longer unlimited as it would normally be for a short sale. Instead, it is $500. No matter how high the stock price rises above $60, the investor will exercise the call to buy the stock for $60, incurring a $200 loss on the short sale, in addition to the $300 paid for the call. Test topic alert. Most of our students report a question on protecting against loss on a short sale. As shown previously, the best way to hedge is to buy a call option on the stock underlying the short sale. This strategy offers full protection against loss. Please notice that in protecting the long or short position, the investor buys an option. It is useful to remember that you buy protection, you don't sell it. For 50 Unit 20 Portfolio Management Styles, Strategies, and Techniques. S65_LEM.IM 450 March 15, 2019 10:59 and 1 second AM. Taxes on income and capital gains diminish the amount of money available to the person who earns it. As a result, personal and business investment decisions are often influenced by the tax implications. Please note, because tax brackets generally change every year, they are not testable. We've included those for 2019 only for perspective. The Series 65 exam will include 2 questions on the material covered in this unit. Learning objectives. When you have completed this unit, you will be able to accomplish the following. U21L01, recognize income tax fundamentals for individuals. U21L02, identify the different sources of income and loss. U21L03, distinguish between income and capital gain and how they are taxed. U21L04, recall the preference items included in the AMT computation. U21L05, describe the fundamentals of insurance, trust, estate, and gift taxation. U21L06, identify the different types of business taxation. Individual taxation. U21L01, recognize income tax fundamentals for individuals. Taxes function as either regressive or progressive. Regressive taxes, example sales, excise, payroll, property, and gasoline taxes, are levied at the same rate, regardless of income, and thus represent a smaller percentage of income for wealthy taxpayers than for taxpayers with lower incomes. Because low-income families spend a larger percentage of their incomes than they save or invest, regressive taxes consume a larger fraction of the income of the poor than of the wealthy. Progressive taxes, example estate, gift, and income taxes, increase the tax rate as income. 21. Unit. Tax considerations. 451. S65_LEM.IM 451 March 15, 2019 10:59 and 1 second AM. Increases. Progressive taxes are costlier to people with high incomes than to people with low incomes. This unit will deal with taxation on the federal level with specific reference to state taxes when necessary. Test topic alert. In a progressive tax system, the term used to describe the highest rate paid on income, sometimes referred to as the next dollar received, or the last dollar received, is the individual's marginal tax rate. For example, in 2019, a single individual with taxable income in excess of $214,100 is taxed on each dollar earned above that amount at a rate of 35% until reaching $510,300, at which time the excess is taxed at 37%. Therefore, if this individual reported earnings of $250,000, it is proper to say that the marginal tax rate is 35%. If the individual earned $525,000, then it would be 37%. Please note, the actual tax brackets are never tested on the exam because they change every year. We are showing them only as examples. Example. Based on this information, a single taxpayer with taxable income of $220,000 is given a $10,000 bonus. The federal income tax on that bonus is taxed at the individual's marginal, or top, tax bracket rate of 35%, so the tax would be $3,500. This individual won't move into another bracket until taxable income exceeds $510,300. Besides the amount of income, the most important factor in determining an individual's income tax bill is the choice of filing status. The choice of filing status one makes has a major impact on the amount of taxes levied. There are 5 different filing statuses. Single. Married filing jointly. Married filing separately. Head of household. Qualifying widow, or with dependent child. Filing status is determined by your marital status as of the last day of the year. If more than one filing status applies to the taxpayer, the IRS suggests using the one resulting in the lowest tax obligation. Generally, that will be married filing jointly. For those who are not married, if qualifying, the lowest rate is usually obtained by filing as head of household. Test topic alert. How you file a return can impact your taxes. Your tax filing status is based on your marital status as of the end of the year, December 31st. In the case of a single parent with dependent children, it will generally be most advantageous to use the filing status, head of household. For 52 Unit 21 tax considerations. S65_LM, in 452 March 15, 2019 10:59 and 1 second AM. Example 1. In most cases, the tax filing status that results in the highest income tax is a head of household being married filing jointly. C. Qualifying widower with a dependent child. D. Single answer. D. In general, for the same amount of income, filing single, choice D, will result in the highest income tax, while married filing jointly, the lowest. Head of household is usually the best for those who are not married, but do have children. Other factors include age. Taxpayers who are 65 or older receive an addition of $1,300 each if married and filing a joint return, or $1,650 if single, to the standard deduction. This additional amount is also available to those who are blind or disabled. This increased standard deduction can lower the tax bill. State of residence. If the taxpayer lives in a state with a state income tax up to certain limits, the amount paid can be taken as a deduction on the federal return, thus lowering the tax due. Citizenship. An individual who is not a citizen of the U.S. may pay taxes at a different rate than citizens and may also receive certain tax credits due to tax treaties. Much of this depends on whether the individual is a resident alien or a non-resident alien, and the details are beyond the scope of the exam. Example 1. Under current tax law, which of the following would not be a factor in determining an individual's federal income liability? IHB is citizenship. C. A filing status. D. Sex answer. D. One area in which the federal tax laws do not discriminate is the individual's sex, choice D. Those 65 and older are entitled to an additional exemption. Non-U.S. citizens may pay more or less tax based on tax treaties and other factors, and filing status has a major impact on taxes. Sources of income. U21L02, identify the different sources of income and loss. Earned income includes salary, bonuses, tips, and income derived from active participation in a trade or business. Unit 21. Unit 21 tax considerations 453. S65_LM, in 453 March 15, 2019 10:59 and 1 second AM. Alimony. Alimony is payment made under a divorce, court order, or under a legal separation agreement to an ex-spouse. Alimony may be paid directly to the ex-spouse or to a third party on the ex-spouse's behalf, example, to pay premiums on the ex-spouse's life insurance or contribute to the ex-spouse IRA. Alimony payments, within limits, are generally deductible to the spouse making the payments and includable in income for tax purposes by the spouse receiving them. Take note. Effective January 1, 2019, the tax treatment of alimony is reversed. That is, the ex paying the alimony won't get to deduct the payment and the ex receiving the alimony won't report it as income. That will impact counting received alimony as income for IRA purposes. This change only applies to divorce decrees entered into after December 31, 2018, so any test question would have to specify a date. Child support. Alimony should not be confused with child support. Child support is a legal obligation of a parent to provide financial support for a child, typically occurring when the parent providing the support is not the parent with whom the child or children lives. Child support is not deductible by the parent who pays it, nor is it includable in income by the recipient, who is often the other parent receiving the support on behalf of the child of the dissolved marriage. Example. Chuck and Alice divorced on November 1, 2018, after a 10-year marriage that produced 2 children, Tim, age 6, and Kim, age 8. Under a court order, it is decided that Chuck will pay Alice $1,000 per month in alimony and $600 per child per month, $1,200 in total child support. Chuck may deduct $12,000 for the tax year, $1,000 times 12 months, on his federal income tax return. Alice must report $12,000 for the tax year on her federal income tax return. Chuck cannot deduct any of the child support, nor is any of it reportable for income tax by Alice or their children. Passive income and passive losses. Passive income and losses come from rental property, limited partnerships, and enterprises, regardless of business structure, in which an individual does not actively participate. For the general partner, income from a limited partnership is earned income. For the limited partner, the income is passive, not earned. Passive income is netted against passive losses to determine net taxable income, which is then taxed at ordinary income rates. Passive losses may be used to offset only passive income. Portfolio income. Portfolio income includes dividends, interest, and net capital gains derived from the sale of securities. No matter what the source of the income, it is taxed in the year in which it is earned. Capital gains and capital losses will be covered separately. 454 Unit 21 Tax Considerations. S65_LM.IM 454 March 15, 2019 10:59 and 2 seconds AM. Dividend income. If the dividend qualifies, you don't need to know the technical points that make a dividend qualify. The tax rate is generally a maximum of 15%. It can be as high as 20% or more for very high income taxpayers, but that is unlikely to be tested. Otherwise, the dividend is taxed at ordinary income rates. For test purposes, assume that any dividend from a U.S. corporation, including stock mutual funds, is qualified, unless the question states otherwise. Example. 1. An investor who would like to increase current income from investments and, at the same time, pay taxes on that income at less than his marginal tax rate, would probably find which of the following to be most suitable? A. U.S. Treasury bonds. B. Public utility stock. C. Growth stock. D. Money market mutual fund. Answer. B. The key to this question is that dividends paid on stock issued by American companies and certain qualified foreign corporations generally qualify for a reduced tax rate, maximum 15 to 20%. No such benefit accrues to money market funds. Their dividends are generated from interest income, and government bond interest is always taxed as ordinary income, although state income tax-free. The dividends on a growth stock would also qualify, but, because the question deals with increasing current income, public utility, choice B is a more sensible approach. This is an example of how the test might present you with two answer choices that could be correct, and you must choose the one that is more correct. Interest income. Interest on any debt security, other than tax-free municipal issues, is always taxed at ordinary income rates. Please note that interest on U.S. Treasury securities, but not GMMA and FMMA debt, is exempt from state taxation, but not federal. Furthermore, income distributions from bond funds are not qualified dividends and are taxed fully as ordinary income. Take note. Although interest income from municipal bonds is tax-free, capital gains are fully taxable. Capital gains occur when the bond is sold for a price that is greater than the investor's cost basis investment in the bond. This is also true of capital gains distributions from municipal bond mutual funds. While the income distributions may be tax-free, capital gains from any source are always taxable. Test topic alert. In the case of TIPS, the taxation is a bit different. Being Treasury securities, they are exempt from state and local income tax. However, the annual interest payment received is taxable on a federal basis as ordinary income and, what is reminiscent of the tax treatment of a zero-coupon bond discussed in Unit 13, the annual increase to the principal is taxed as well. Unit 21. Unit 21 Tax Considerations 455. S65_LM.IM 455 March 15, 2019 10:59 and 2 seconds AM. What about income from foreign issuers? Dividend and interest income received from foreign securities, including ADRs, is normally subject to withholding tax, typically about 15%, by the issuer's country of domicile. Current U.S. tax law allows many investors to reclaim the withheld tax as a credit against taxes owed on their tax returns, and it is not a preference item for AMT, U21L04. For example, if you purchase some Matilda, also called kangaroo, bonds, remember them from Unit 13, they are issued in the Australian marketplace by non-Australian entities. The Australian government requires that a withholding tax be placed on the interest, but U.S. taxpayers can take that tax withheld as a credit against U.S. income tax due on the interest. In almost all cases, income from foreign securities is taxed in the U.S. at all levels, federal and state. Taxation of reinvested distributions. Stocks and bonds normally pay dividends and interest in cash, taxable in the year of receipt, and the investor only realizes a capital gain or loss when the investment is sold. Mutual funds normally allow dividends and capital gains to be automatically reinvested in the fund shares at the net asset value annually per share. Reinvesting creates a compounding effect. These distributions are taxable to shareholders whether the distributions are taken in cash or reinvested. The issuer must disclose whether each distribution comes from income or realized capital gains. Form 1099, which is sent to shareholders after the close of the year, details tax information related to distributions for the year. Dividends must be reported as dividend income and will be taxed either as ordinary income or as a qualifying dividend. Capital gains distributions from mutual funds are generally reported as a long-term capital gain and are taxed at the same reduced rate as qualified dividends. Test topic alert. One term you might see on the exam refers to an interest-on-interest plan, and it will be compared to a dividend reinvestment plan. What is the exam referring to? This is nothing other than a typical bank savings account where your interest compounds, usually quarterly. Therefore, you are earning interest on the interest. From a tax standpoint, this interest, just like reinvested dividends, is taxable in the year received. Dividend reinvestment plans, DRIPs. Some corporations offer their shareholders the opportunity to purchase additional shares of the company's common stock using their cash dividend. Under most DRIPs, the shareholder automatically purchases the additional shares directly from the issuer, paying little or no commission and often at a discount to market price. In fact, most companies permit investors in these plans to add money along with the reinvested dividend. They are taxed in the year of receipt, as is any cash dividend. However, the amount of reinvested dividends increases the investor's cost basis, thereby reducing the amount of capital gains if the position is later sold at a profit. The effect of reinvestments on cost basis. Because the taxes have already been paid on any income reinvested, when the investor sells the asset, the cost basis is increased so that the income is not taxed again. 456 Unit 21 Tax Considerations. S65_LEM, in 456 March 15, 2019 10:59 and 2 seconds AM. Example. An investor purchases 100 shares of Capco common stock for $100 per share and elects to participate in Capco's DRIP. During the next 5 years, the investor receives dividends totaling $2,200, which has allowed the purchase of 20 additional shares through the DRIP. With Capco selling at $110 per share, the investor liquidates the entire position. For tax purposes, the investor has a capital gain of $1,000, even though the proceeds are $3,200 more than the original investment. Here's the math. Purchase of 100 shares at $100 equals $10,000. Add the reinvested dividends of $2,200 to increase the cost basis to $12,200. Sell all the shares, 100 plus the 20 acquired through the DRIP, equals 120 times $110 equals $13,200. The proceeds exceed the adjusted cost basis by $1,000, and that is the amount of capital gain. It might appear on the exam in question form like this. Example. 1. An investor purchases 100 shares of DRP common stock at $50 per share and elects to have all cash dividends reinvested through the DRIP being offered by DRP. After holding the stock for 5 years, the investor has reinvested $1,200 and acquired 20 additional shares. If the market price of DRP is $55 per share and the investor liquidates the position, the tax consequence will be A. A loss of $700. B. A gain of $400. C. A gain of $600. D. A gain of $1,600. Answer. B. The investor establishes the position at a cost of $5,000. To that, we add the $1,200 cost of the reinvested dividends, bringing the investor's tax cost basis to $6,200. When all of the shares are sold, the proceeds are $6,600, 120 shares times $55. Subtracting the $6,200 cost from the $6,600 proceeds results in a capital gain of $400. Choice B. Test topic alert. Regardless of fluctuations in the market price, as long as a dividend is paid, investors participating in a DRIP will always have more shares in their account at the end of the year than at the beginning. Retirement plan distributions. Qualified retirement plan distributions are, with few exceptions, taxed at the investor's ordinary income tax rate when funds are withdrawn from the plan. Distributions from a qualified plan before the investor reaches age 59.5 are also subject to a 10% early withdrawal penalty. Distributions from a qualified plan must begin by April 1st following the year the participant reaches 70.5. More on this in Unit 24. Unit 21. Unit 21 Tax Considerations 457. S65_LEM.IN 457 March 15, 2019 10:59 and 2 seconds AM. Margin expenses. Margin interest is a tax-deductible expense. Margin accounts are covered in Unit 22. The one exception is interest expenses incurred in the purchase of municipal securities. Because municipal interest income is federally tax-exempt, the IRS does not allow taxpayers to deduct the margin interest expenses for municipal securities. Investors can deduct interest expenses incurred when borrowing money to purchase other securities to the extent those interest expenses do not exceed their net investment income, which includes interest income, dividends, and all capital gains. Effective tax rate. In an earlier test topic alert, we introduced you to the term marginal tax rate. That should not be confused with the individual's effective tax rate. What is the difference? As stated earlier, the marginal tax rate is the rate you pay on each additional dollar you receive as income. The effective tax rate, however, is the overall rate of tax you pay on your total taxable income. The following example should help you visualize the difference. Example. In the test topic alert, we showed you how a single person with $250,000 in taxable income was paying taxes at a marginal rate of 35%. That is, a bonus of $10,000 would result in an additional tax liability of $3,500. That 35% rate was in effect for all income in excess of $200,000. According to the tax tables, and absolutely not tested, the tax on that first $200,000 is $42,449, and then everything above that, until $500,000, is taxed at 35%. So, for the single individual with $250,000 of taxable income, the total tax bill would be $42,449 plus 35% times $50,000, or $42,449 plus $17,500, which is a total tax of $59,949. That means that out of $250,000 in income, slightly less than 24% of it, $59,949 divided by $250,000, went to pay tax. This works out to be an effective tax rate of 23.98%. Tax treatment of capital gains and capital losses. U21L03 distinguish between income and capital gain and how they are taxed. Whereas income is generally money received from the ownership of an investment, example the dividends on a stock, interest on a debt security, or from personal work, such as salary, capital gains and losses always involve the sale of an asset. The sale of a security can result in a capital gain or a capital loss. A capital gain occurs when a security is sold for a price higher than its cost basis. If the selling price is lower than the cost basis, a capital loss occurs. Capital gains. A capital gain occurs when capital assets, securities, real estate, and tangible property are sold at prices that exceed the adjusted cost basis. Usually, computing the capital gain or loss on an asset is a matter of comparing the purchase price with the selling price less commissions. For 58 Unit 21 tax considerations. S65_LM.in 458 March 15, 2019 10:59 and 2 seconds AM. Adjusting cost basis. Investment's cost basis, total cost of the investment, is used to determine whether a capital gain or a capital loss occurs when an asset is sold. Because many factors affect an asset's cost basis, the IRS requires the cost basis to be adjusted for such occurrences as stock splits and stock dividends. Example. A client buys 100 shares of REST at $55. Later, the company declares a stock dividend and the investor receives 10 more shares. The client's total investment remains $5,500, but there are now 110 shares of REST in the account. The client's adjusted cost basis per share is now $50, $5,500/110. When the securities are sold, the holding period is based upon the original purchase date. The dates of the acquisition of the shares through the stock dividends or stock splits are of no consequence. If the sales price exceeds the adjusted cost basis, the investor realizes a capital gain, if lower, a capital loss. Take note. A lower cost basis results in a larger capital gain. The gain is determined by comparing the sales proceeds with the cost basis. Example. If the investor's cost basis in stock is $50 per share and shares are sold for $60, the investor has a capital gain of $10. However, if the investor's cost basis is $55 and the shares are sold for $60, the investor's capital gain is only $5. Effects of reinvesting on cost basis for computing capital gains/losses. A few pages ago, we discussed the fact that any distributions received, whether taken in cash or reinvested, were reported on the Form 1099 as taxable for that year. In the case of reinvestments, because they have already been taxed, when a sale takes place, they are not taxed again. The amount reinvested adds to the investor's tax basis or cost. You may wish to go back and review the two examples shown there. Capital losses. A capital loss occurs when capital assets are sold at prices that are lower than the adjusted cost basis. Net capital gains and losses. To calculate tax liability, a taxpayer must first add all short-term capital gains and losses for the year. Short-term gains are investments held 12 months or less and are taxed at the investor's ordinary income tax rate. Then all long-term capital gains and losses are added. A long-term capital gain or loss only occurs after the investor has held the investment at risk for a period exceeding 1 year. Finally, the taxpayer offsets the totals to determine the net capital gain or loss for the year. If the result is a net long-term capital gain, it is taxed at the capital gains rate, currently at 15% for most taxpayers. Unit 21. Unit 21 Tax Considerations 459. S65_LM.in 459 March 15, 2019 10:59 and 3 seconds AM. Capital losses that exceed capital gains are deductible against earned income up to a maximum of $3,000 per year. Any capital losses not deducted in a taxable year may be carried forward indefinitely as a deduction to offset capital gains in future years. Determining which shares to sell. An investor holding identical securities, each with a different acquisition date and cost basis, may determine which shares to sell by electing one of three accounting methods: first in, first out, FIFO, share identification, or average cost basis. If the investor fails to choose, the IRS assumes the investor liquidates shares on a FIFO basis. When FIFO shares are sold, the cost of the shares held the longest is used to calculate the gain or loss. In a rising market, this method normally creates adverse tax consequences. When using the share identification accounting method, the investor keeps track of the cost of each share purchased and uses this information to liquidate the shares that would provide the lowest capital gain. Share identification is used to identify the specific per share cost basis when shares are sold. The investor keeps track of the cost of each share purchased and specifies which shares to sell on the basis of that investor's specific tax needs. A Shareholder may elect to use an average cost basis when redeeming mutual fund shares, but not shares of specific stocks. The investor would calculate average basis by dividing the total cost of all shares owned by the total number of shares. The shareholder may not change the decision to use the average basis method without IRS permission. Take note. Share identification may result in more advantageous tax treatment, but most accountants prefer the convenience of the averaging method for mutual fund shares. Share identification is most commonly used with stock sales. Wash sale. An investor may not use capital losses to offset gains or income if the taxpayer sells a security at a loss and purchases the same or a substantially identical security within 30 days before or after the trade date establishing the loss. The sale at a loss and the repurchase within this period is a wash sale. The loss that was disallowed, however, is added to the repurchased shares cost basis. Example. An investor buys 100 shares of ABC for $50 per share. 1 year later, the investor sells the shares for $40 per share. 15 days after the sale, 100 shares of ABC are repurchased for $42 per share. The investor's new cost basis is $52 per share because the $10 loss that was disallowed is added to the repurchase price of $42. For 60 Unit 21 tax considerations. S65_LM.in 460 March 15, 2019 10:59 and 3 seconds AM. Figure 21.1 Wash Sale. Trade date 30 days before 30 days after. April 15th, May 15th, June 14th. Substantially identical securities include stock rights, call options, warrants, and convertible securities of the same issue. The IRS compares three qualities of debt securities in determining whether they are substantially identical: the maturity, coupon, and issuer. A bond is substantially identical if all three qualities of the bond sold at a loss and the newly purchased bond are the same. After selling a bond, an investor can buy another bond with either a different maturity, coupon, or issuer without violating the wash sale rule. Example, an investor could sell an ABC 8% bond that matures in 2030 at a loss and buy back an XYZ 8% bond that matures in 2031 and claim the loss. This is commonly called tax swapping. Take note the wash sale rule applies only to realized losses, not to realized gains. Sale of a primary residence. The final example of capital gain taxation deals with the unique treatment offered on the sale of a primary residence. There are special tax benefits available to those selling their primary residence as long as it has been lived in as the primary residence for at least 2 of the past 5 years. For a couple, the first $500,000 in profit is excluded from capital gains taxation. For a single person, it is the first $250,000. Example, Chloe and Edgar bought their home 30 years ago for $50,000. Now that the children are all on their own, they decide to downsize and move to a retirement village. If they sell their home for $600,000, what is the tax consequence? Chloe and Edgar are selling their home for a profit of $550,000. However, the first $500,000 for a couple is excluded from taxation. Therefore, they will only have to report the remaining $50,000 as a long-term capital gain. Unit 21. Unit 21 Tax Considerations 461. S65_LM.in 461 March 15, 2019 10:59 and 3 seconds AM. Alternative Minimum Tax, AMT. U21L04, recall the preference items included in the AMT computation. Congress enacted the Alternative Minimum Tax, AMT, to ensure that high-income taxpayers do not escape federal income taxes. Certain items that receive favorable tax treatment must be added back into taxable income to arrive at the AMTI, Alternative Minimum Taxable Income, and include the following. Accelerated depreciation on property placed in service after 1986. Certain costs associated with limited partnership programs, such as research and development costs and excess intangible drilling costs. Local tax and interest on investments that do not generate income. Tax-exempt interest on private purpose municipal bonds issued after August 7, 1986. Examples of these private purpose or private activity bonds that makes them subject to the AMT would be those issued to finance sports stadiums, hospitals, housing projects, and so forth. Incentive stock options, ISO, to the extent that the fair market value of the employer's stock is in excess of the strike price of the option, even when the stock is not sold in that year. To determine if you owe AMT, you compute your regular tax and then you compute the AMT and pay whichever is the higher amount. The IRS has an unusual way of stating this. They say that the AMT is the regular tax plus the amount by which the AMT exceeds the regular tax. So, if the AMT computation shows $12,000 due and the regular shows $10,000 due, you take the $10,000 and add the amount by which $12,000 exceeds $10,000, $2,000, to arrive at $12,000. Wouldn't saying, pay the higher of the two, be easier? It sure would, but then that might put some accountants out of business, just like simplifying the tax code would do. Take note. Items that must be added back in for the purpose of the AMT computation are sometimes called tax preference items. If the tax liability computed under the AMT computation is greater than the taxpayer's regular tax computation, the taxpayer must pay the AMT amount. Taxation of life insurance. U21L05 describe the fundamentals of insurance, trust, estate, and gift taxation. Income tax implications of life insurance. Premiums for individually purchased life insurance are generally non-deductible for income tax purposes. Generally, proceeds from life insurance policies made to a beneficiary are exempt from federal income tax. For 62 Unit 21 tax considerations. S65_LEM.AIM 462 March 15, 2019 10:59 and 3 seconds AM. Estate tax implications to owning life insurance. If someone named as the insured individual on a life insurance policy holds incidents of ownership in that policy, the entire death benefit payable under that policy is included for federal estate tax purposes in the insured individual's estate. If a person retains the right to designate a beneficiary, transfer ownership of an insurance policy, assign, choose how dividends or policy proceeds will be paid out, borrow money from the accumulated cash value of the policy, or perform any other functions that are rights of ownership, then that person has incidents of ownership in the policy. In light of the estate tax implications, it is frequently best that a party other than the insured own the life insurance policy in order to remove the proceeds from the estate of the insured. An effective alternative to ownership of a policy on one's own life is to have the life insurance acquired by or transferred to an irrevocable life insurance trust, ILIT. If certain provisions, known as crummy powers, are included in the ILIT document, premiums paid by the insured may qualify for the annual gift tax exclusion, currently $15,000 per year, per beneficiary. Test topic alert. In most cases where the estate does have liquid assets such as stocks and bonds, life insurance still may serve a valuable need in that these income-producing assets will not have to be sold to cover the estate tax liability or other final expenses. Policy loans. When you borrow cash value from your life insurance policy, the funds received are non-taxable. This is the same as any other borrowed money. It isn't your money and must be paid back at some time in the future. Note that if you never pay it back, the amount of the loan will be deducted from the death benefit. The insurance company will finally get back the money. Policy surrender. If a variable life insurance policy is surrendered, any cash value in excess of the basis in the policy, the premiums paid, is taxable as ordinary income. Withdrawal of cash value. If there is a partial withdrawal of cash value from a variable life insurance policy, the FIFO rules apply. This is unlike the LIFO treatment on an annuity. Therefore, there are no tax consequences until the amount withdrawn exceeds the cost basis in the policy. Unit 21. Unit 21 Tax Considerations 463. S65_LEM.AIM 463 March 15, 2019 10:59 and 4 seconds AM. Example. 1. Which of the following are possible sources of taxable income to an individual? I. Owning a sole proprietorship. 2. Being a shareholder in a subchapter S corporation. 3. Owning stocks and bonds. 4. Proceeds paid on a life insurance policy. A. 1 and 2. B. 1, 2, and 3. C. 1, 2, 3, and 4. D. 2 and 3. Answer. Being an individual can generate income from running a sole proprietorship or being a shareholder in an S corporation. The exam will probably use the obsolete term, subchapter S. Of course, taxable income can be generated by investments in the form of dividends, interest, and capital gains. One very valuable feature of life insurance is that death benefits paid to the beneficiary of a life insurance policy are not subject to federal income tax, so choice 4 is not part of the correct answer. B. Taxation of Social Security. Taxation of Social Security is included in this LO because the Old Age, Survivors and Disability Insurance Program, OASDI, is the official name for Social Security in the United States. As much as 50% of Social Security benefits start becoming taxable once a single person's base income, IRS computation called provisional income, exceeds $25,000 and a married couple's exceeds $32,000. Once that income exceeds $34,000, single, or $44,000, couple, it is likely that 85% of the Social Security benefit is subject to income tax. Although we have not heard of this being tested, individuals claiming benefits before full retirement age will see a reduction in those benefits once earnings reach a certain point, changes every year. Capital gains taxation on donated, gifted, and inherited securities. Gifts. When a donor makes a gift of securities or virtually any asset, the cost basis to the recipient, the donee, is the donor's cost basis, original cost and holding period beginning from the donor's date of purchase. This describes carryover basis. Example. In 2010, Joe Smith bought 1,000 shares of COD at $24 per share, for a total cost of $24,000. In 2017, when COD was trading at $32.50, Joe gave those 1,000 shares to his daughter, Sally. When Sally sells the shares, her cost basis is Joe's cost basis on the date of his original purchase, $24 per share, 7 years ago, not the market. For 64 Unit 21 tax considerations. S65_LEM.M 464 March 15, 2019 10:59 and 4 seconds AM. Value on the date of the gift. So, if Sally were to sell those shares for $33 per share 1 month after receiving the gift, she would be realizing a long-term capital gain of $9,000. Take note. It gets more complicated if the securities are worth less than the donor's cost at the time of the gift, and we don't expect the exam to deal with that situation. Take note. If a gift of securities held more than 1 year, long-term, is made to a 501c3 charity, that is the IRS designation for qualifying nonprofit organizations, the tax treatment is more favorable. Under these circumstances, Joe's deduction is based on the fair market value on the date of the gift, not his cost basis. He would have received a $32,500 tax deduction and avoided capital gains taxes on the $8,500 profit. Inherited securities. When a person dies and leaves securities to heirs, the cost basis to the recipients is usually the fair market value on the date of the owner's death. In other words, the cost basis steps up to the date of death value. Furthermore, the IRS treats any gains to be long-term, regardless of when the deceased purchased the security. Example. In 2010, Joe Smith bought 1,000 shares of COD at $24 per share for a total cost of $24,000. In 2017, when COD was trading at $32.50, Joe died. His daughter, Sally, is Joe's sole heir and inherits the 1,000 shares upon his death. When Sally sells the shares, her cost basis is the fair market value on the date of Joe's death, $32.50 per share, not Joe's original purchase cost, and any gain would be long-term. Test topic alert. The step-up provision does not apply when inheriting an annuity. Trusts are considered legal persons and may be subject to taxation. In fact, if not handled properly, the taxes can be quite onerous. Trust tax rates. Taxation of trusts and estates is based on what is distributed and what is retained. In the case of non-distributed income, the tax consequences can be quite severe because the tax brackets are highly compressed. For example, although a joint return filed for 2019 would have to report income in excess of $612,350 to be subject to the highest tax bracket of 37%, that rate is reached once a trust or estate has non-distributed income in excess of $12,750. Obviously, this can have a major impact on investment planning. Test topic alert. If the trust or estate has income, it must be reported on IRS Form 1041. Unit 21. Unit 21 Tax Considerations 465. S65_LM.AM 465 March 15, 2019 10:59 and 4 seconds AM. Distributable net income, DNI. Because of the onerous tax implications described previously, most trusts and estates distribute their income. In the context of a trust or an estate, the taxable income is known as distributable net income, DNI. DNI determines the amount of income that may be taxable to beneficiaries, or the grantor in the case of a revocable trust, whereas the balance may be taxed to the trust as indicated previously. Commissions and other fees charged for buying and selling securities held in a trust are subtracted from the trust's DNI. Realized capital gains that are reinvested in the corpus, Latin for body, of the trust are not considered part of DNI. Example. The Gordon Clark Trust had dividend income of $10,000 and interest income of $7,000. In addition, the trust realized capital gains of $3,000, half of which were reinvested in the corpus of the trust. Transaction costs for the year were $2,000. The Gordon Clark Trust has DNI for the year of $16,500, $10,000 plus $7,000 plus $1,500 minus $2,000. The $1,500 of realized gains reinvested is not part of DNI. Tax-exempt interest from municipal bonds remains tax-exempt to trust beneficiaries. If the trust is revocable, all income, whether distributed or not, is taxed to the grantor. In the case of an irrevocable trust, distributed income might be taxed to the beneficiary and or the grantor, but the topic is so complicated that we don't expect it to be tested. Bypass trust. A bypass trust is an estate planning tool used to take advantage of the lifetime estate tax exclusion. It is commonly used between spouses when both are U.S. citizens and takes advantage of the unified tax credit. The concept of the bypass trust is to enable a surviving spouse to take advantage of the unused lifetime exclusion, currently $11.4 million, of the first to die and add it to their exclusion. Tax legislation passed in 2010 has largely removed the need for this trust. Portability of unused estate tax exemption under ATRA. As mentioned previously, the bypass trust is no longer needed. This is because the Tax Act of 2010 contained the concept of portability, which permits the surviving spouse to take the unused portion of the first deceased spouse's federal exemption and aggregate it with the surviving spouse's unused portion. To use an example, for 2019, each living spouse has a lifetime exemption from estate tax of $11.4 million. The husband dies in 2019, leaving his entire estate of $17 million to his wife. There would be no estate tax because of the unlimited marital deduction. Let's assume that the husband has not used any of his $11.4 million exemption by making taxable gifts in previous years. If the wife dies later with her estate value up to as much as $22.8 million, the executor of her estate can use all of her exemption of $11.4 million as well as the husband's unused portion, up to $11.4 million, needed to reduce the federal estate tax to zero. Example. Each individual in a married couple has a lifetime estate tax exclusion, 2019, of $11.4 million. At the time of the first to die, the gross value of the estate is $15 million. If the provisions of the will stated that the estate was to be left to the For 66 Unit 21 Tax Considerations. S65_LAM.AM 466 March 15, 2019 10:59 and 4 seconds AM. Surviving spouse, then, taking advantage of the unlimited marital deduction, all $15 million passes without estate tax and without impacting the deceased's lifetime exclusion. Therefore, the surviving spouse gets the $11.4 million left over from the deceased, meaning that no estate tax will be due after the survivor's passing unless the estate's value exceeds $22.8 million. Generation Skipping Trust, GST. Just as the name implies, a generation skipping trust is used to pass money from family members to other members more than one generation removed, grandchildren and/or great-grandchildren. Therefore, instead of the assets being taxed upon the death of the parents and then again when their children pass them to the grandchildren, one level of estate taxation is eliminated. The combination of the marital portability and the greatly increased estate tax exclusion granted by the Tax Cuts and Jobs Act, TCJA, of 2017, will result in many fewer clients needing this kind of plan. Estate taxes. The federal government imposes a tax on a decedent's estate based on the value of the estate at death. An individual may transfer an unlimited amount to a spouse who is a U.S. citizen without the imposition of federal estate tax. This is known as the marital deduction. In addition, an individual may transfer unlimited amounts of money and other property to an eligible charity with no federal estate tax. For heirs other than spouses, an estate tax credit will offset estate tax on transfers of up to $11.4 million in 2019, indexed for inflation of property. We have discussed some ways to reduce or eliminate estate taxes earlier in this unit. The gross estate versus the taxable estate. Federal estate tax is calculated using a formula that begins with the gross estate. The gross estate includes all interests in property held by an individual at the time of death. Although amounts of property transferred to a spouse or a charity will generally not be subject to federal estate tax, such amounts are includable in calculating the gross estate. Certain expenses are then deducted from the gross estate to arrive at the adjusted gross estate, AGE. Examples of deductions for the AGE include funeral expenses, charitable contributions, and debts of the decedent. Once the amount of the AGE is determined, the unlimited marital and charitable deductions are subtracted to arrive at the taxable estate. Example: Caroline, who was unmarried, died in 2019, owning various property. The amount of her gross estate is $18 million. However, her estate incurred $20,000 in funeral expenses, she had made charitable gifts of $1 million, and she owed mortgages of $200,000 and $30,000 in credit card balances. Thus, her AG is $16,750,000. In 2019, because of an estate tax credit that exempted the first $11,400,000 of property transferred after death, Caroline's estate will be taxed on the remaining $5,350,000 in transferred property. Unit 21. Unit 21 Tax Considerations 467. S65_LAM.AM 467 March 15, 2019 10:59 and 4 seconds AM. Alternative Valuation Date. The Internal Revenue Code provides that the executor of an estate may choose to value the assets in the estate as of date of death or, alternatively, 6 months later. This is particularly beneficial if the estate consists of assets that have dropped substantially in value following the date of death of the deceased. What value is used if an asset that is appraised at the date of death is subsequently sold for a different price? The executor will use that sale price as long as it represents the fair market value. In the case of mutual funds, FMV is the NAV, not the POP. Test Topic Alert. If an asset is sold after death at a greatly reduced price from its appraised value in a transaction that does not meet the definition required under fair market value, the IRS will use the higher value. Payment date of estate taxes. Regardless of whether the date of death or alternative valuation date is used, estate taxes are due no later than 9 months after death. Just as with personal income taxes, it is possible to get an extension to file the return, but the taxes are due at the 9 months' time and interest will be charged on any amount owed that is not paid at that time. Test topic alert. The computation of the estate tax is done on IRS Form 706. From the gross assets, certain expenses, such as the costs of administration of the estate, funeral expenses, payments of outstanding debts, and charitable bequests, are deducted and the tax is levied on the remaining taxable estate. Taxation of estate income. During the time before the estate is liquidated, and estates that are contested can drag on for years, it is likely that the executor will manage the assets in such a fashion that the estate receives income and possibly capital gains. If this is the case, the taxation to the estate is at the same rates mentioned earlier regarding trusts and, as with trusts, Form 1041 is used to report the income. Furthermore, the income is taxed using the same compressed brackets as trust income, 37% for everything in excess of $12,750. Test topic alert. Just as you may have to know that the estate tax computation is done on Form 706, you may also have to know that the estate income tax computation is done on Form 1041. Donor's gift tax obligation. Gift tax is a progressive federal tax imposed on the transfer of property during the lifetime of the donor. Up to $11.4 million, 2019, in lifetime gifts may be made without incurring gift tax. Additionally, currently, an individual may give up to $15,000 per year, per person to any number of individuals without generating the federal gift tax. If a married couple joins in the for 68 Unit 21 tax considerations. S65_LM.in 468 March 15, 2019 10:59 and 4 seconds AM. Gift. The allowable amount is doubled to $30,000 per person per year. Gifts of securities are valued as of the current market price on the date of the gift. Please don't confuse this with cost basis of a gift discussed earlier in this unit. When a gift is made between spouses, the rule is somewhat different. Generally, there is an unlimited exclusion for these gifts. However, there are limits if your spouse is not a citizen of the United States. In 2019, a spouse may gift up to $155,000 to a non-citizen spouse. The number won't be tested because it changes each year, but the concept might be on your exam. Test topic alert. Generally, a gift tax return must be filed whenever a gift in excess of $15,000, or whatever the annual exclusion is at the time of the gift, is made to any individual, other than a spouse. Any excess over the annual exclusion is applied against the lifetime exclusion until it is used up. The return is filed on Form 709 and is due at the same time as the donor's income tax return, generally April 15th. Take note. If a gift tax is due, it is the responsibility of the giver of the gift, donor, not the receiver of the gift, donee. Example. This concept is pretty simple. You have some stock worth $22,000 and give it to a child or grandchild. You've exceeded the $15,000 annual gift exclusion, so a gift tax return would have to be filed. However, it might look like this on your exam. A grandfather received stock as a result of demutualization that is currently worth $22,000 and wishes to give it to his grandchild. Most students would waste their time trying to figure out what demutualization means and not realize how simple the question really is. It makes no difference how the stock was acquired. For gift tax purposes, the only thing that counts is the fair market value on the date of the gift. Take note. Taxation of estates and gifts are unified. That means that whatever is used of the lifetime gift exclusion before death reduces the estate tax exclusion. Both have a lifetime exclusion, 2019, of $11.4 million and both have a progressive structure with rates beginning at 18% and reaching a maximum tax rate, 2019, of 40%. There are two testable differences. 1. The annual gift tax exclusion, $15,000 in 2019, and 2. Gift taxes are due at the same time as the individual tax return, April 15th, while estate taxes are due 9 months after death. Unit 21. Unit 21 Tax Considerations 469. S65_LAM.AIM 469 March 15, 2019 10:59 and 5 seconds AM. Test topic alert. The concept of taxation relating to gifts and inheritances can be confusing. There are two separate taxable situations: taxes due on the proceeds of a sale of gifted or inherited property, and taxes due based on the amount of the gift or the estate. The following comparison should help. 1. A client has received a gift of securities from someone, or has inherited securities. I gift. The client's cost basis for determining if there is a taxable capital gain is that of the donor. The client is considered to have acquired the security on the donor's purchase date and at the donor's purchase price. B. Inheritance. The client's cost basis for determining if there is a taxable capital gain is the fair market value, FMV, as of the date of death. The holding period is not a consideration because any gains are considered long-term. 2. Your client made a gift of securities to someone, or has died. A gift. The obligation to pay a gift tax is that of the donor. Anything over the annual exclusion, currently $15,000, may be subject to the gift tax, unless used against the lifetime exclusion of $11.4 million. The amount of the gift for tax purposes is the FMV as of the date of the gift. B. Estate. The obligation to pay an estate tax is that of the deceased's estate. The value used to determine if there is an estate tax liability is the FMV either as of the date of death or, by using the alternative valuation date, the FMV 6 months after death. As with the gift tax, there is the unified credit of $11.4 million. Example. 1. Bruno and Griselda have been married for 56 years. Bruno passes away in 2019 and leaves his entire estate of $10 million to his wife. During his lifetime, Bruno had used $2.2 million of his lifetime gift exclusion. Upon Griselda's death 2 years later, the estate is worth $22.2 million. The gross taxable estate is: A is $0. B. $1.6 million. C. $2 million. D. $11 million. Answer: B. Because Bruno used $2.2 million, his estate tax exclusion is now $9.2 million. The portability provisions all that to be added to her exclusion, making the total $9.2 million, $9.20 plus $11.40 equals $20.6 million. With a gross value of $22.2 million and a remaining exclusion of $20.6 million, before any deductions, the gross taxable estate is $1.6 million, choice B. For 70 Unit 21 tax considerations. S65_LAM.AIM 470 March 15, 2019 10:59 and 5 seconds AM. Taxation of businesses. U21L06. Identify the different types of business taxation. Sole proprietorships. Sole proprietorships are the simplest business form but offer no liability protection to the owner. In fact, this is the only form of business where the potential loss is unlimited because the personal assets of the owner are at risk in addition to any assets owned by the business. The owner computes the earnings of the business on the Schedule C of her Form 1040, so anything made, or lost, by the business is reflected directly on her tax return. There is no separate tax return for the business entity. Partnerships. Partnerships are relatively easy to form and dissolve and come in two types. Both offer flow-through of income and losses, the difference being in the degree of liability. General partnerships provide no liability protection to the partners. In other words, if the business goes under, they, collectively and separately, are liable for any losses. In a limited partnership, as the name implies, something is limited. In this case, it is the liability. A limited partner's maximum loss is what has already been invested plus any funds committed for but not yet contributed. That is why so many DPPs are organized as LPs. Partnerships do not pay taxes. They file an information return, a Form 1065, and attach to that, and send a copy to each partner, a Schedule K1 indicating the amount of income or loss to be inserted on the investor's personal Form 1040. Limited Liability Company, LLC. The LLC is somewhat of a hybrid between the partnership and the corporation. The federal government does not recognize an LLC as a classification for federal tax purposes. An LLC business entity must file as a corporation, a partnership, or sole proprietorship. Generally, a one-member LLC will use the Schedule C, just as if it were a sole proprietorship. Those with two or more members invariably file as partnerships using the Form 1065 to provide the IRS with the information in the Schedule K-1 for each member's share of income or loss. If filing is a corporation, they generally file as an S-corporation, but it is unlikely, for test purposes, that you will have to know anything about an LLC filing as a corporation. Corporations. As with partnerships, we have two types here as well, the C corporation and the S corporation. Of all the business entities we've discussed, the only one that actually files a tax return on which it must pay income tax is the C corporation. It files on Form 1120 and pays taxes at a rate that generally does not exceed 21%. The key fact about the C corporation is that its dividends are paid out after paying income taxes, and then the dividend is taxable to the shareholder, hence the term double taxation. The S corporation, sometime referred to by its ancient name, Subchapter S corporation, on the exam, is treated for tax purposes the same as a partnership except that the return filed is the Form 1120s. Shareholders receive a Schedule K-1 indicating their share of income or loss. Unit 21. Unit 21 Tax Considerations 471. S65_LAM.IN 471 March 15, 2019 10:59 and 5 seconds AM. Just as with the LLC and the partnership, the business entity is not taxed. Everything flows through to the owners. The TCJA of 2017 made a major change in the way that flow-through business entities are taxed. Subject to certain income limitations, not likely to be tested, there is a 20% reduction to operating business income. The effect of this is to lower the amount of taxable income to each partner/member/shareholder. C corporations are major investors in securities. Some Internal Revenue Code, IRC, provisions affecting C corporations as investors include the following. Dividend exclusion rule. Dividends paid from one corporation to another are 50% exempt from taxation. A corporation that receives dividends on stocks of other domestic and certain qualifying foreign corporations, therefore, pays taxes on only 50% of the dividends received. Municipal securities, like individual taxpayers, corporations do not pay federal taxes on interest received from municipal bonds. Filing dates for business tax returns. Sole proprietorship. A business organized as a sole proprietorship is an extension of the individual running the business, so its year-end is December 31st, and the tax return due date is the same as the individual's April 15th of the following year. Single-member LLC. If the business is an LLC with only one member, it is taxed like a sole proprietorship, using Schedule C with a year-end of December 31st. The tax returns are due in taxes payable on April 15th of the following year. Partnership and multiple member LLCs. The tax filing requirements for a partnership and an LLC with more than one member are the same. An information return is filed on Form 1065, with a Schedule K-1 sent to the partners/members indicating the amount of income or loss attributable to each of them. Remember, the business entity pays no income tax. All reportable income/loss flows through to the partners/members. Form 1065 is due on March 15th of the following year. The year-end for these businesses is typically December 31st. Because these are flow-through entities, they don't pay taxes. Taxes are due on April 15th, when the individual partners/members file their Form 1040s showing their share of the business's income or loss that was reported on the Schedule K-1. Corporations. A regular C corporation may choose any convenient date as their year-end, usually a quarter-end date. C corporation tax returns are due and taxes are payable on the 15th day of the fourth month after the end of the company's fiscal, financial year. So, a C corporation with a year-end date of December 31st must file and pay taxes by April 15th. A C corporation with a year-end date of September 30th must file and pay taxes by January 15th. For 72 Unit 21 tax considerations. S65_LAM_ Chapter 21.9 472 October 7, 2019 11:28 and 1 second a.m. In the case of an S corporation, income/loss is taxed on individual income tax returns. Therefore, an S corporation must usually take a calendar year-end date, December 31st, unless the corporation can establish a reasonable business purpose for a different date. The filing date of the Form 1120's due date is the same as for partnerships and multiple member LLCs, March 15th for a December 31st year-end. As with the other flow-through entities, the Schedule K-1 is sent to shareholders and is used in the preparation of their Form 1040 return. Test Topic Alert. You may be asked about tax documents for each of these different forms of business organizations. Sole proprietors and single-member LLCs file their business information on a Schedule C. Investors in partnerships, members of LLCs, and shareholders in S corporations receive a Schedule K-1 and C corporations report their income on a Form 1120. Take note. This chart should help. Sole proprietorship, Schedule C, April 15th. Single-member LLC, same as above. Multiple member LLC, partnership, S corporation, March 15th. LLC and partnership on Form 1065, S Corp on Form 1120s. C corporation, April 15th, or 15th day of the fourth month after the end of the fiscal year, Form 1120. Example. 1. Most new businesses operate at a loss the first year or so. If several of your clients were forming a group to fund a startup enterprise but wish to limit their liability and, at the same time, be able to receive favorable tax treatment for the expected losses, you would suggest forming which of the following? A. C corporation. B. General partnership. C. LLC. D. Sole proprietorship. Answer. C. The only way to limit liability is through a corporation, C or S, LLC, or limited partnership. The LLC, choice C, allows for the flow-through of operating losses to the shareholders while the C corporation does not. Unit 21. Unit 21 Tax Considerations 473. S65_LAM.IN 473 March 15, 2019 10:59 and 5 seconds a.m. S65_LAM.IN 474 March 15, 2019 10:59 and 5 seconds a.m. By this time in the course, you're probably itching to go out and try some of these great strategies and techniques and get active in the market. In this unit, we'll cover the first thing you have to do, decide what type of account you're going to open. Then, we'll discuss where the securities you wish to purchase or sell are traded. It isn't like you can visit your local Walmart and pick up a few hundred shares of stock. Nor can you go online to Amazon and, even if you have Prime registered, order some bonds and have them delivered in 2 business days. The Series 65 exam will include approximately 4 questions on the material presented in this unit. Learning objectives. When you have completed this unit, you will be able to accomplish the following. U22L01, compare cash and margin accounts. U22L02, compute the margin account calculations. U22L03, contrast stock exchanges and the over-the-counter market. U22L04, identify the difference between functioning as a broker and acting as a dealer. U22L05, describe the costs of trading securities. U22L06, identify the features and uses of market, stop, limit orders and short sales. U22L07, describe high-frequency trading, HFT, and dark pools. Cash and margin accounts. U22L01, compare cash and margin accounts. Customers can open either cash accounts or margin accounts, depending on how they choose to pay for securities. In cash accounts, customers pay the full purchase price of securities by 22. Unit. Trading securities. 475. S65_LAM 475 March 15, 2019 10:59 and 5 seconds AM. The transaction settlement date. In margin accounts, customers may borrow part of a securities purchase price from the broker-dealer under terms set by Regulation T of the Federal Reserve Board. That power was given to the Federal Reserve Board, FRB, in the Securities Exchange Act of 1934. Cash account. A cash account is the basic investment account, and anyone eligible to open an investment account can open one. In a cash account, a customer must pay in full for any securities purchased. Although, as with almost everything in this course, there are exceptions. For exam purposes, certain accounts may only be opened as cash accounts, including personal retirement accounts, such as IRAs, corporate retirement accounts, custodial accounts, such as Uniform Transfer to Minors Act accounts, UTMAs, and covered LESAs. Margin accounts. Margin accounts allow customers to control investments for less money than they would need if they were to buy the securities outright, because a margin account allows a customer to borrow money for investing. The term margin refers to the minimum amount of cash or marginable securities a customer must deposit to buy securities. Margin also is a potential source of cash. If a customer has fully paid securities in an account and needs cash, a broker-dealer is permitted to lend money against those securities up to the margin limit that the FRB has set. Customers who open margin accounts must meet certain minimal suitability requirements. The customer may then buy securities on margin and pay interest on the borrowed funds. The securities purchased are held in street name as collateral for the margin loan. When buying on margin, investors are using financial leverage. That is, they are increasing the potential for gain and for loss as well by using borrowed funds. Leveraging can be beneficial when the security is moving up, but it can result in a loss greater than the original investment if the security goes against the investor. Marginable securities. In addition to prescribing the loan value of securities, Regulation T also identifies which securities are eligible for purchase on margin and which may be used as collateral for loans for other purchases. These are known as marginable securities. The following should be helpful. Securities that may be purchased on margin/used as collateral: exchange-listed stocks and bond stocks traded on the NASDAQ stock market, warrants traded on either of these securities that cannot be purchased on margin/used as collateral options, puts and calls. Leaps are an exception, but that is unlikely to be tested. For 76 Unit 22 trading securities. S65_LAM 476 March 15, 2019 10:59 and 5 seconds AM. Stock rights, preemptive. Insurance contracts, example, variable annuities and variable life. Securities that cannot be purchased on margin, but may be used as margin collateral once owned at least 30 days. Mutual funds. New issues. Finally, although exempt from Regulation T, they are exempt securities. The self-regulatory organizations, primarily FINRA, have established margin requirements for government and municipal securities. That means that they can also be purchased on margin and have value as collateral. Documenting a margin account. Opening a margin account requires more documentation than opening a regular cash account. The customer signs a margin agreement, which includes the required credit agreement, hypothecation agreement, and an optional loan consent. Under NIEVES policies, it is an unethical business practice to execute any transaction in a margin account without securing from the customer a properly executed written margin agreement promptly after the initial transaction in the account. Margin account agreements. Credit agreement establishes the debtor/creditor relationship and discloses the terms under which credit is extended. SEC Rule 10b-16 requires firms to disclose the method of computing interest and the KINDI tie-ins under which interest rates and charges will be changed. Firms must send customers an assurance that statements accounting for interest charges will be sent with the same frequency that interest is charged, monthly or quarterly. Hypothecation agreement gives the firm permission to use the client's margin securities as collateral for the margin loan and pledge, rehypothecate, securitize held on margin to a lending institution, a mandatory part of a margin agreement. Loan consent, optional, gives the firm permission to lend securities held in the margin AC account to other brokers, usually for short sales. It is not mandatory for customers to sign the loan consent agreement. Take note. Although an ASAA does not have FINRA rules, which most states view as practices to be followed by broker-dealers under their jurisdiction, do have a risk disclosure requirement for margin accounts. As part of opening a margin account, the broker-dealer must provide customers with a risk disclosure document. Unlike the promptly after the initial trade requirement that NASAA has for its required documentation, FINRA requires this document to be delivered no later than the time of opening the account. This information must also be provided to margin customers on an annual basis. The document discusses the risks associated with margin trading, some of which are listed here. You can lose more funds than you deposit in the margin account. Unit 22. Unit 22 Trading Securities 477. S65_LM, 477 March 15, 2019 10:59 and 6 seconds AM. The firm can force the sale of securities or other assets in your accounts and do so without contacting you. You are not entitled to choose which securities can be sold if a call for additional funds is not met. You are not entitled to an extension of time to meet a margin call. The firm can increase its house maintenance margin requirements at any time and is not required to provide advance written notice to the client. Take note. One of the agreements described previously is the hypothecation agreement. To finance the loan the broker-dealer makes to the client, the firm takes the newly purchased security and hypothecates, pledges, it to a bank to collateralize a loan made by the bank to the BD. The broker call loan rate is the interest rate banks charge broker-dealers on money they borrow to lend to margin account customers. The broker call loan rate is also known as the call loan rate or call money rate. The broker call loan rate usually is slightly higher than other short-term rates. Broker call loans are callable on 24-hour notice. Invariably, call loan appears on the exam as one of the incorrect choices. Margin account calculations. U22L02, compute the margin account calculations. The term margin call is properly defined as the initial call for funds when making a margin transaction. For example, with the margin requirements of the FRB's Regulation T at 50%, as they have been since 1974, a purchase of $12,000 of stock will result in a margin call of $6,000. The broker-dealer lends the client the other $6,000, creating a debit balance in the account. The equity in the account is 50%, and the client's debt is the other 50%. Maintenance margin. The self-regulatory organizations, SROs, example FINRA and the NYSE, rather than the Fed through Reg T, have established minimum levels of equity in a margin account below which a call will go out for additional funds. This is properly referred to as margin maintenance or a maintenance call. Current SRO levels are 25% for long margin accounts. For example, if, in the above purchase, the stock's price were to drop to $8,000, there would only be $2,000 of equity in the account. Market value of $8,000 minus debit balance of $6,000 equals $2,000. At this point, the equity represents 25% of the current market value, $2,000/$8,000. If the stock should drop any further, a maintenance margin call would be sent with a request for immediate funds. You will not have to do any of these computations, but you will need to know the term. If the maintenance call is not met, the broker-dealer will liquidate enough securities in the account to bring the equity back to the maintenance level. If there is more than one security in the account, the firm can select which to sell that does not have to be one whose decline triggered the call. For 78 Unit 22 Trading Securities. S65_LM, 478 March 15, 2019 10:59 and 6 seconds AM. House maintenance. This is the term used to describe stricter limits imposed by the broker-dealers themselves. Typically, instead of relying on the SRO maintenance level of 25%, the individual firm may require a minimum of 35% or even higher. Take note. This should help you remember the three terms we've just discussed. Margin call, set by the Federal Reserve Board under Regulation T. This is the initial deposit required when purchased securities on margin. The broker-dealer lends the balance of the purchase price. For equity securities, the initial margin requirement is 50% of the purchase price. Minimum maintenance, set by the SROs. This is the minimum equity that must be maintained in a margin account. Should the equity fall below the minimum required, a maintenance call, sometimes called maintenance margin, will go out demanding an immediate deposit of enough equity to bring the account above the required level. Currently, the minimum maintenance level for long positions is 25% and for short positions is 30%. House maintenance, set by the individual broker-dealer firm. As a cushion, and to reduce the possible sellout caused by failure to meet a maintenance call, most firms set a minimum equity level above the SRO minimum. A common house requirement is 35%. Falling below triggers a house call. None of these numbers will be tested, only the concepts. Mixed margin account. Later in this unit, we'll describe the short sale. Short sales must take place in a margin account. When the margin account contains both long and short positions, it is said to be a mixed margin account. Computing the equity, sometimes called net equity, in one of these accounts is done by calculating the equity for both the longs and shorts and then combining them. In a long account, the equity is what you own minus what you owe. That would be the current market value of the long stock minus the debit balance. In the case of the short position, it is basically the same, except the terms are different. What you owe on a short position is the cost to buy back the stock you've borrowed. What you own is the credit balance representing what you received when you sold the stock in the first place. So, the equity in a short account is the credit balance minus the current market value of the short stock. Perhaps the following will make it a bit easier. CMV long minus debit balance equals long equity. Credit balance minus CMV short equals short equity. We have two positive numbers, the stock we own and the credit balance. You know that when you get a bill and there is a credit balance, it means they owe you money that's yours. On the other side, we have two negative numbers, the cost to buy back the stock we're short and the debit balance. If we add the two positives and then subtract the two negatives, we've got our net equity. Unit 22. Unit 22 Trading Securities 479. S65_LEM.IN 479 March 15, 2019 10:59 and 6 seconds AM. Example. A client's mixed margin account shows the following. Current market value of the long positions is $50,000, while the current market value of the short positions is $25,000. There is a debit balance of $20,000 and a credit balance of $40,000. What is the combined, or net equity in the account? Either find the equity in each account, long, $50,000 minus $20,000 equals $30,000 and short, $40,000 minus $25,000 equals $15,000, so the total is $45,000. Or, take the two positive numbers, $50,000 plus $40,000, which equal $90,000 and subtract the two negative numbers, $20,000 plus $25,000, which equal $45,000 and you get the same $45,000. Positive, negative, margin. The term positive margin simply means that your returns are higher than the cost of the borrowed money to carry the positions in a margin account. For example, if you buy $10,000 of stock on 50% margin, you will be borrowing $5,000 of that purchase price from the broker-dealer. If, over the holding period, you pay $400 in interest and sell the stock for $11,000, you've made a profit of $1,000 against the cost of $400 for net winnings of $600. That would be considered positive margin. If, however, you sold the stock for $10,300, your interest cost would have exceeded the profit by $100, and that would be considered negative margin. There is one more fact we need to cover about margin accounts. Margin interest is a tax-deductible expense. The one exception is interest expense incurred in the purchase of municipal securities. Because municipal interest income is federally tax-exempt, the IRS does not allow taxpayers to deduct the margin interest expenses from municipal securities. Investors can deduct interest expenses incurred when borrowing money to purchase other securities to the extent those interest expenses do not exceed their portfolio income, which includes interest income, dividends, and all capital gains. Types of securities markets. U22L03 contrasts stock exchanges and the over-the-counter market. After the initial offering, many stocks and bonds are bought and sold on exchanges in a two-way auction process. The major exchanges include the New York Stock Exchange, NYSE, NYSE American LLC, formerly known as the American Stock Exchange, AMEX, the Chicago Board Options Exchange, CBOE, and the NASDAQ stock market. Other trades take place in the nationwide network of broker-dealers known as the over-the-counter, OTC, market. Securities markets. There are two terms used to describe the market for securities. The primary market is the market in which the proceeds of sales go to the issuer of the securities sold. The secondary market is where previously issued securities are bought and sold between investors. This unit will focus on secondary market trading. For 80 Unit 22 trading securities. S65_LEM.IN 480 March 15, 2019 10:59 and 6 seconds AM. Exchange market. The exchange market is composed of the NYSE and other exchanges on which listed securities are traded. Listed security refers to any security listed for trading on an exchange. Each stock exchange requires corporations to meet certain criteria before it will allow their stock to be listed for trading on the exchange. To operate in the United States, an exchange must be registered with the Securities Exchange Commission as called for in the Securities Exchange Act of 1934. Under that act, the SEC has many powers including enforcement of the laws. Two specific actions that the SEC can take that might be tested are: suspend trading in any non-exempt security for up to 10 days without prior notice, and suspend trading on an entire exchange for up to 90 days. To do this, the SEC must give prior notification to the President of the United States. Location. Many stock exchanges, such as the NYSE, maintain central marketplaces and trading floors. Some, such as the NASDAQ stock market, are strictly electronic markets. At one time, there were a number of regional stock exchanges, but they have either been closed or merged into the national ones. Pricing system. Historically, listed markets operated as auction markets. Floor brokers competed to execute trades at the most favorable prices. That process still exists on some exchanges. Specialist. The specialist maintains an orderly market and provides price continuity. He fills limit and market orders for the public and trades for his own account to either stabilize or facilitate trading when imbalances in supply and demand occur. The specialist's chief function is to maintain a fair and orderly market in the stocks for which he is responsible. An additional function is to minimize price disparities that may occur at the opening of daily trading. He does this by buying or selling, as a dealer, stock from his own inventory only when a need for such intervention exists. Otherwise, the specialist lets public supply and demand set the stock's price. Take note. The term specialist has been replaced with designated market maker, DMM, but you should expect to still see specialist on your exam. Over-the-counter, OTC, market. The OTC market functions as an interdealer market in which unlisted securities, that is, securities not listed on any exchange, trade. In the OTC market, securities dealers across the country are connected by computer and telephone. Thousands of securities are traded OTC, including stocks, corporate bonds, and all municipal and U.S. government securities. One of the best known of the OTC markets is the OTC Bulletin Board, where stocks that don't qualify for listing on the exchanges are traded. Another is the OTC Link, which for many years was known as the Pink Sheets because the Unit 22. Unit 22 trading securities 481. S65_LM.in 481 March 15, 2019 10:59 and 6 seconds AM. Quotes were printed on pink paper. These tend to include those stocks which are thinly traded, little trading activity, with higher than normal spreads. Location: no central marketplace facilitates OTC trading. Trading takes place over the phone, over computer networks, and in trading rooms across the country. Pricing system: the OTC market is an interdealer network. Registered market makers compete to post the best bid and ask prices. The OTC market is a negotiated market. Market makers are broker-dealers who stand ready to buy and sell at least the minimum trading unit, usually 100 shares, or any larger amount they have indicated, in each stock in which they have published bid and ask quotes. Market makers, acting in a dealer, principal, capacity, sell from their inventory at their asking price and buy for their inventory at the bid price. Take note: the differences between the OTC and NYSE markets are summarized here. OTC NYSE securities prices determined through negotiation. Securities prices determined through auction bidding, regulated by FINRA, regulated by the NYSE, traded at many locations across the country, traded on the NYSE floor on Wall Street. Exchange equals listed securities equals prices determined by auction. OTC equals unlisted securities equals prices determined by negotiation. Government and municipal bonds and unlisted corporate stocks and bonds trade in the OTC market. Broker versus dealer. U22L04. Identify the difference between functioning as a broker and acting as a dealer. Most securities firms act as both brokers and dealers, but never in the same transaction. Let's examine the differences between these two terms. 482 Unit 22 Trading Securities. S65_LM.in 482 March 15, 2019 10:59 and 6 seconds AM. Brokers. When a broker-dealer acts in the capacity of a broker, it is said to be acting in an agency capacity. That is, the firm represents clients who wish to buy a security by finding a seller, or finding a buyer for those clients with a security to sell. For this service, they charge a commission. Brokers do not buy shares for inventory but facilitate trades between buyers and sellers. Dealers. When a broker-dealer acts in the capacity of a dealer, it is said to be acting as a principal in the trade. Just as with any transaction, there are always two principals, the buyer and the seller. Dealers, acting as principals, buy and sell securities for their own account. When they receive a customer order to buy a security, they sell that security out of their inventory in the same manner as an automobile dealer sells you a car off the lot. When they receive a customer order to sell, dealers buy that security for their inventory, once again, similar to an automobile dealer who buys your old clunker from you. Test topic alert. Disclosure of the capacity in which the broker-dealer acted is always required on the trade confirmation. Trading costs. U22L05. Describe the costs of trading securities. Buying and selling securities is not without cost. As described previously, there are two ways in which broker-dealers function, as brokers or as dealers. As brokers, they are acting as their clients' agents and, as is typical in any business, agents charge a commission for their service. That means, when buying a security, the commission will be added to the purchase price. Likewise, when selling a security, the commission will be deducted from the proceeds. When selling from their inventories, dealers charge the buying customers a markup rather than a commission. When buying for their inventory, dealers charge the selling customers a markdown. They buy for less than they can sell it for. Think about what happens when the auto dealer buys your used car from you and what it sells for on the lot a week later after they've cleaned it up. Take note. The term principal has several meanings in the securities industry. A broker-dealer acts as a principal in a dealer transaction. A principal of a firm is a person who acts in a supervisory capacity. Principal can also mean the face value of a bond or asset in a trust. A firm cannot act as both a broker and a dealer in the same transaction. Unit 22. Unit 22 Trading Securities 483. S65_LAM.in 483 March 15, 2019 10:59 and 7 seconds AM. Example. A firm cannot make a market in a stock, mark up that stock, and then add an agency commission. If the firm acts as a broker, it may charge a commission. If it acts as a dealer, it may charge a markup or markdown. Violation of this practice is called making a hidden profit. Broker-dealer acts as an agent, transacting orders on the client's behalf, acts as a principal, dealing in securities for its own account and at its own risk, charges a commission, charges a markup or markdown, is not a market maker, makes markets and or takes positions, long or short, in securities, must disclose its role, and the amount of its commission to the client must disclose its role to the client, but not necessarily the amount or source of the markup or markdown. Take note: an easy way to remember these relationships is to memorize the following letters. BAC/DPP, brokers act as agents for commissions / dealers act as principals for profits. ABCD, agents that are brokers for commissions that must be disclosed. Example. 1. When viewing several of your clients' trade confirmations, you noticed that a recent purchase was made of ABC stock where there was no commission indicated, while a sale took place of DEF stock in which the commission listed was $55. From this information, you could determine that ABC was purchased in an agency transaction 2. ABC was purchased in a principal transaction 3. DEF was sold in an agency transaction 4. DEF was sold in a principal transaction A. I and 3B. I and 4C, 2 and 3, D, 2 and V. Answer. C. Whenever a trade is made without a commission indicated on the confirmation, it means that a markup or markdown was charged. That makes it a dealer or principal transaction. Commissions are always disclosed on agency transactions. Therefore, we know that ABC 2 was purchased in a principal transaction and DF 3 was sold in an agency transaction, so the correct match is choice C. For 84 Unit 22 Trading Securities. S65_LAM.in 484 March 15, 2019 10:59 and 7 seconds AM. Bids, offers, and quotes. A firm quote is a market maker's current bid and offer on a security. The current bid is the highest price at which the dealer will buy, and the current offer is the lowest price at which the dealer will sell. The difference between the bid and ask is known as the spread. A general rule is the more active the stock, the narrower the spread. This concept plays out in our everyday life because those products that move off the shelves quickly, think about milk, eggs, and bread in the grocery store, tend to have a lower retail markup than items which move slowly, such as antiques and fine art. We have mentioned earlier that higher markups or commissions on thinly traded, not highly active, securities would generally not be in violation as long as properly disclosed. In most cases, a market maker's quote will also include the size. That indicates the number of shares the quote is good for. For example, a quote of 45 minus 45.20, 8 by 10, means the dealer is offering 1,000 shares for sale at 45.20 and is ready to buy 800 shares at 45. If not stated, the quote is firm for a single round lot, 100 shares. Remember, when acting in a principal capacity, no commissions are added. Example. If WXYZ is quoted as 43.25 to 0.50, it means that the bid price, the price that a customer would receive for his shares, is $43.25, and the ask price, the price that the customer would pay to buy shares, is $43.50. The 25 cents difference is the dealer's spread. Alternatively, the exam might put it like this. 1. A broker-dealer quotes a stock 42 to a half. The difference between these two numbers is known as A. The broker's commission. B. The dealer's markup. C. The profit margin. D. The spread. Answer. D. The dealer's quote represents the bid and the offer, ask, prices. This quote is 42 bid and 42.50 offered. The difference between these two is the spread. Choice D. A markup is added to the higher price, the ask or offering price. Test topic alert. If the client has U.S. Treasury bonds she wishes to sell and receives a quote of 104.22, which represents the bid price, don't select an answer choice that says a premium. It is a premium, but that is not as specific an answer. Types of orders. U22L06, identify the features and uses of market, stop, limit orders and short sales. Many types of orders are available to customers. The type will be indicated on the order ticket. SEC rules require preparation of order tickets before order entry. Required disclosures include the account number, Unit 22, Unit 22 Trading Securities 485, S65_LEM_ Chapter 22.9 485 March 19, 2019 1:13 and 42 seconds p.m. Whether the order is solicited, unsolicited, or discretionary, including time or price, if a sale, whether long or short, the terms and conditions of the order, market, limit, or stop, the number of shares if a stock and if a bond, aggregate par value, but not rating or current yield, the time of order entry, execution time and execution price will be added, and the name of the broker-dealer and identity of the registered individual who accepted the order or is responsible for the account. Test topic alert. 2 items that would not be on an order ticket are the current market price of the security and the client's name or address. Price orders that restrict the price of the transaction include the following: market executed immediately at the market price with no restrictions, limits the amount paid or received for securities. Stop becomes a market order if the stock reaches or goes through the stop price. Stop limit entered as a stop order and changed to a limit order if the stock hits or goes through the trigger price. Time limit orders based on time considerations include the following: day expires if not filled by the end of the day. Good till canceled, GTC, does not expire until filled or canceled. Size. NYSE Rule 72 defines a block as at least 10,000 shares or $200,000, whichever is less. Thus, for stocks priced at less than $20, a 10,000 share trade can be a block, but in higher priced stocks even a 1,000 share trade could constitute a block. Example 1. Which of the following types of orders does not restrict the price at which an order is executed? A limit. B. Stop. C. Market. D. Stop limit. Answer. C. A market order, choice C, does not reflect or restrict the price at which a security is executed. A limit order limits the amount to be paid or received for securities. A stop order becomes a market order if the stock. 486 Unit 22 Trading Securities. S65_LEM. 486 March 15, 2019 10:59 and 7 seconds a.m. Reaches or goes through the stop price. A stop limit order becomes a limit order if the stock hits or goes through the trigger price. Market orders. A market order is sent immediately to the floor for execution without restrictions or limits. It is executed immediately at the current market price and has priority over all other types of orders. A market order to buy is executed at the lowest offering price available. A market order to sell is executed at the highest bid price available. Those prices are usually referred to as the inside market or inside quote. As long as the security is trading, a market order guarantees execution. Limit orders. In a limit order, a customer limits the acceptable purchase or selling price. A limit order can be executed only at the specified price or better. Better means lower in a buy order and higher in a sell order. If the order cannot be executed at the market, the order is left with the specialist, now called the DMM, who records the trade in the order book and executes the order if and when the market price meets the limit order price. Risks and disadvantages of limit orders. A customer who enters a limit order risks missing the chance to buy or sell, especially if the market moves away from the limit price. The market price may never go as low as the buy limit price or as high as the sell limit price. Test topic alert. If any part of an order can be filled at the limit price, it is done. For example, if a day limit order to buy 400 shares at $22.45 is turned in and all that can be executed at that price or better is 200 shares before the market closes, that sale is confirmed, and the order for the balance is canceled. Definition: short sales. Selling short is a technique to profit from the decline in a stock's price. The short seller initially borrows stock from a broker-dealer to sell at the market. The investor expects the stock price to decline enough to allow him to buy shares at a lower price and replace the borrowed stock at a later date. Unless the stock price declines to zero, the short seller is obligated to buy the stock and replace the borrowed shares to close the short position. Because of this borrowing, a margin deposit is required. Therefore, short sales can only take place in a margin account. Short sales are risky because if the stock price rises instead of falls, an investor still must buy the shares to replace the borrowed stock, and a stock's price can rise without limit. Therefore, the position has unlimited risk. Stop orders. A stop order, also known as a stop-loss order, may be entered to protect a profit or prevent a loss if the stock begins to move in the wrong direction. Unit 22. Unit 22 Trading Securities 487. S65_LM.IN 487 March 15, 2019 10:59 and 7 seconds AM. The stop order becomes a market order once the stock trades at or moves through a certain price, known as the stop price. Stop orders for listed stocks are usually left with and executed by the specialist, DMM. A trade at or through, lower in the case of a sell stop, higher in the case of a buy stop, the stop price triggers the order, which then becomes a market order. As a market order, there is no assurance of any specific price. The order may wind up being executed at, above, or below the stop price. A stop order takes two trades to execute. Trigger: the trigger transaction at or through the stop price activates the trade. Execution: the stop order becomes a market order and is executed at the market price, completing the trade. Stop limit order. A stop limit order is a stop order that, once triggered, becomes a limit order instead of a market order. Buy stop order. A buy stop order protects a profit or limits a loss in a short stock position. The buy stop is entered at a price above the current market and is triggered when the market price touches or goes through the buy stop price. Example: a customer has shorted 1,000 shares of XYZ stock at $55 with the expectation that the stock's price will decline. As we know, the investor will lose if the price rises, and, because there is no limit on the upside, the potential loss is unlimited. As a form of protecting against extreme loss, the customer enters a buy stop order for 1,000 shares at $60. That way, if the price begins to rise, once it reaches or goes above 60, a market order will be entered, and, once the purchase is confirmed, the stock will be used to close the short position. Yes, it will be at a loss, but that is why these are called stop-loss orders. They keep you from losing any more than you specify. Sell stop order. A sell stop order protects a profit or limits a loss in a long stock position and is entered at a price below the current market. Example: continuing the stop-loss theme, investors who own a stock will lose money if the price declines below the purchase price. These investors are hoping for a rising market, but, just in case, to protect themselves, they can enter a sell stop order. A customer has purchased 1,000 shares of ABC stock at $55 with the expectation that the stock's price will rise. Unlike the short sale, the loss is not unlimited. The stock's price cannot fall below zero, but investors don't want to lose all of their investment. So, a sell stop order for 1,000 shares is entered below the current market at $50. As long as the stock's price goes up, they're making money, but... For 88 Unit 22 Trading Securities. S65_LM.IN 488 March 15, 2019 10:59 and 7 seconds AM. Should it reach 50 or less, the order is triggered and a market order is automatically entered, stopping the loss. Take note, in either of these examples, a stop limit order could have been turned in and the story would be the same, except that, upon being triggered, a limit order at the limit price would be entered instead of a market order. Example: an order that reads, sell 100 COD at 52 stop, 51.50 limit, means that the stop will be activated at or below 52. Because a 51.50 limit applies, the order to sell cannot be executed below 51.50. Take note, the uses of buy and sell stop orders are summarized here. Buy stop orders might be called stop buy on the exam. Protect against loss in a short stock position. Protect a gain from a short stock position. Establish a long position when a breakout occurs above the line of resistance, i.e., stock prices rise above historic high levels. Sell stop orders might be called stop sell on the exam. Protect against loss in a long stock position. Protect a gain from a long stock position. Establish a short position when a breakout occurs below the line of support, i.e., stock prices decline below low level. Mechanics of a stop order. As stated previously, it takes more than one trade for a stop order to be executed. The first of those, the trigger, occurs whenever the subject security trades at or through the stop price. In the case of a buy stop order, through means at a higher price. In the case of a sell stop order, through means at a lower price. Then, once the order has been triggered, unless it is a stop limit order, the next price in the market is the one at which the trade is executed. It will probably be easier to follow if we display an example. Example: a client enters a buy stop order for 100 shares of XYZ at 40. Trades then occur at 38, 39, 39.90, 40.05, 40.10, and 39.78. What price did the client pay for the stock? The order will be triggered as soon as the price gets to 40 or higher. That would be the trade at 40.05. At that time, a market order is entered and the client pays the next price, which could be more or less than 40. In this case, the next price is 40.10, and that is the price per share paid by the client. We're ignoring any commissions. Unit 22. Unit 22 Trading Securities 489. S65_LEM.IM 489 March 15, 2019 10:59 and 7 seconds AM. How is this different for a stop limit order? If we change the previous example to make the order, buy stop at 40, limit 40, then the client is stating that once the order has been triggered, enter a limit order, and do not pay any more than 40 for the stock. Once again, the order is triggered with the trade at 40.05, but now, because a limit order has been placed, we can't buy on the next trade. 40.10 is too high. However, the following trade at 39.78 allows us to meet the client's limit of paying no more than 40 for the stock. Let's try one in test format. 1. A client order is received with the following instructions. Buy stop 100 shares ABC at 34, limit 34.20. After the order is submitted, trades occur at 33, 33.90, 34.10, 33.85, 34.05, and 34.25. More than likely, the client paid A. 33.85, B. 34.05, C. 34.10, D. 34.25. Answer: this is two orders in one. The first does not become triggered until the price gets as high at 34. That happens at 34.10. Then, a buy stop order at 34.20 is entered, pay 34.20 or less, and the trade at 33.85, choice A, meets that requirement. Test topic alert. There is a danger in using stop orders in that once they are triggered, the marketplace receives an increase of sell orders in a falling market and buy orders in a rising market. This can have the tendency to accelerate the direction of the market, sell stops in a bearish market, buy stops in a bullish one. Take note. An interesting legal question arises when an agent becomes aware of material non-public information, MNPI, after a stop order is triggered, but prior to execution. Unless the agent has reason to suspect that the client was acting on that information, the order can proceed as normal because it was received prior to the agent becoming aware of the information. Market manipulation definitions. In Part 1, Unit 7, we discussed the prohibitions against market manipulation. Here are some additional cases that will make more sense now. Capping. This is the act of entering sell orders in a stock for the purpose of keeping the stock from rising above the sale price when one is short the stock. If successful, the stock will stay below the strike price and the short position will be profitable. The opposite of this is supporting, where purchase orders are entered in an attempt to keep the price of a stock from falling when one has a long position. for 90 Unit 22 trading securities. S65_LAM, in 490 March 15, 2019 10:59 and 7 seconds AM. Pegging. This is a generic term that applies to any activity intended to keep the price of a stock from moving. This can involve entering either buy or sell orders or both. For example, a short straddle rider will profit most if the stock price and strike prices of the position are the same at expiration, that is, the short options are right at the money. High-frequency trading, HFT. U22L07 describe high-frequency trading, HFT, and dark pools. Over the past 10 years, high-frequency trading, HFT, has gone from a small, niche strategy in financial markets to the dominant form of trading. It currently accounts for well over half of trading volume in U.S. equity markets, 40% in European equity markets, and is quickly growing in Asian, fixed income, commodity, foreign exchange, and nearly every other market. Although a precise definition of HFT does not exist, it is generally classified as autonomous computerized trading that seeks quick profits using high-speed connections to financial exchanges. The objective of HFT is to take advantage of minute discrepancies in prices and trade on them quickly and in huge quantities. As computers get more technically advanced, trading practices have increased in size and algorithms have become more sophisticated. The trades are done at close to the speed of light. In fact, HFT firms have moved their servers to be near an exchange computer to further increase trading speeds. Regulators across the globe are spending considerable effort deciding if and how to regulate HFT. On the one hand, HFT appears to make markets more efficient. Algorithmic trading in general, and HFT specifically, increases the accuracy of prices and lowers transaction costs. On the other hand, HFT appears to make the financial system as a whole more fragile. The rapid fall and subsequent rise in prices that occurred in U.S. markets on May 6, 2010, known as the flash crash, when the Dow Jones Industrial Average plunged about 1,000 points in a matter of minutes, was, in part, due to HFT. Because HFT firms do not openly disclose their trading activities, it has so far been unclear how and why HFT produces these outcomes, a circumstance that has greatly increased the controversy surrounding its existence. A typical objective of high-frequency traders is to identify and capture minute price discrepancies present in the market. They do so with no human intervention, using computers to automatically capture and read market data in real time, transmit thousands of order messages per second to an exchange, and execute, cancel, or replace orders based on new information on prices or demand. In most cases, the trades are executed before individual investors know the quotes of prices or that the trades happened at all. For example, a computer recognizes when one exchange quotes an ask price of 1 cent more than the quote on another exchange. This computer then trades in extraordinarily large volumes on this information, taking advantage of the arbitrage opportunity in a split second. Before individual and other investors who do not possess the same sophisticated technology realize, the 1 cent spread between the two exchanges is erased and the stock price trades at the same level. Benefits of HFT. Increased liquidity in the markets, especially for more active stocks. Market efficiency price differences are arbitraged away, leading to narrower spreads. Reduced costs, especially for institutional purchasers such as mutual funds. Unit 22. Unit 22 trading securities 491. S65_LAM, in 491 March 15, 2019 10:59 and 8 seconds AM. Negatives of HFT. Market manipulation. With the huge volume that can be generated, HFT traders entering phony trades that are later canceled can prompt market activity that would not have happened had these HFT traders not manipulated the market to their advantage. Hurt small investors because they do not have access to the same trading information anywhere near as soon as the HFT traders. Snowballing effect of HFT. For years, one of the problems with stop orders was the acceleration of a downward move when sell stop orders were triggered. With HFT, the volume is so much greater that this movement, as we saw in the flash crash, is magnified. Take note. HFTs rely on very low latency for their algorithmic trading schemes. Low latency is just a fancy way of saying quick trading. It's not unusual nowadays to have a DMA, direct market access, customer enter and have executed 5,000 or 6,000 orders or more in 1 second. Trades are being executed and reported in microseconds. HFT customers are the most likely customers to be provided by their broker-dealer with DMA, which bypasses the firm's trading desk. This kind of DMA trading is called low or no-touch. No-touch doesn't mean no obligation. The broker-dealers still have an obligation to monitor their DMA customers' behavior. No broker-dealer can throw its hands up and say to the regulators, "We didn't know what they were doing." Dark pools. Dark pools, sometimes referred to as dark pools of liquidity or simply dark liquidity, is trading volume that occurs or liquidity that is not openly available to the public. The bulk of this volume represents trades engaged in by institutional traders and trading desks away from the exchange markets. Generally, these are large volume transactions that occur on crossing networks or alternative trading systems that match buy and sell orders electronically for execution without routing the order to an exchange or other market where, quote, last sale price, and volume information is displayed. Institutional trading desks that choose to use dark pools are able to execute large block orders without impacting public quotes or price, or revealing their investment strategy regarding any of their holding accumulations or divestitures. Additionally, orders can be placed anonymously so that the identity of the entity placing the order is unknown to the general investing public along with the volume and price for the transaction. The concern with dark pools is that some market participants are left disadvantaged because they cannot see the trades, volume, or prices agreed upon within the pools, and thus market transparency is darkened. Dark pools account for about 17% of the trading volume in the U.S. stock market. For 92 Unit 22 trading securities. S65_LM.IN 492 March 15, 2019 10:59 and 8 seconds AM. Example 1. A dark pool would most likely be used by a market manipulator B, a high-frequency trader C, an institution D, a retail investor answer. C. Dark pools are favored by institutions, choice C, because of the anonymity it gives to their trading. Unit 22. Unit 22 trading securities 493. S65_LM.IN 493 March 15, 2019 10:59 and 8 seconds AM. S65_LM.IN 494 March 15, 2019 10:59 and 8 seconds AM. Ultimately, the judge of the value of an investment advisor is the performance of the client's account. There are a number of different ways to measure the performance, and one must always keep in mind that it is how well the account meets the investor's objectives that counts. For example, an account that appreciated 10% in 1 year while distributing an income return of 1% is not meeting the goals of a client needing current income. The Series 65 exam will include 4 questions on the material presented in this unit. Learning objectives. When you have completed this unit, you will be able to accomplish the following. U23L01, define the difference between current yield, yield to maturity, and yield to call. U23L02, compute the investment return measurements most commonly found on the exam. U23L03, match the appropriate benchmarks for various portfolios. Review of bond yields. U23L01, define the difference between current yield, yield to maturity, and yield to call. Referring to the short example given in the introduction to this unit, for income-oriented investors, probably the most important performance measurement is yield. In Part 3, Unit 13, we discussed the various types of yield on debt securities, so we'll just mention a few highlights here. 23. Unit. Performance measures. 495. S65_LM.IN 495 March 15, 2019 10:59 and 8 seconds AM. Current yield. The current yield on any investment, debt or equity, is simply the annual income stream, interest or dividends, divided by the current market price. In the case of a debt security, the annual interest is always fixed as a percentage of the par value and doesn't fluctuate when the market price of the security changes. That means that a bond with a 5% coupon interest rate will always be paying $50 per year, divided into two semi-annual payments of $25. If the market price of that bond is currently $800, the current yield, also called current return, is 6.25%, 50 divided by 800. If the current market price of the bond is $125,250, the current yield is 4%, 50 divided by 1,250. The arithmetic is the same when computing the current yield on a stock. Example. When asking for the current yield on a stock, the question will usually give you the quarterly dividend rate. Be sure to multiply that by 4 to arrive at the annual dividend payment. For example, ABC common stock's most recently quarterly dividend was 36 cents per share. ABC expects to keep the dividend payments at that level. If ABC common stock has a current market value of $32 per share, the current return is? The first choice will probably be 1.1%, which is incorrect because that is based on a single dividend. You must multiply the 36 cents by 4 to arrive at the annual dividend of $1.44. Then, divide that by the current market price of $32 and the correct answer is 4.5%. Yield to maturity. Yield to maturity would only apply to a debt security because they have a loan principal that is to be paid back at some future date, the maturity date. It is often referred to as the true yield because it is the most accurate reflection of the actual return to be received by the investor. Unlike our work in a previous unit, here you need merely understand the concept. Test topic alert. The yield to maturity, YTM, of a bond is actually the bond's internal rate of return, IRR, because it represents the discount rate that equates to the discounted value of the bond's future cash flows to its current price. Yield to call, YTC, is a subset of YTM in that, instead of using the maturity date, the call date is used to calculate the return. In almost cases, bonds are called when interest rates have fallen and the issuer can now borrow at a lower rate. Holders of those bonds with higher coupons do not want them taken away, called. The key facts to remember are: if the bond is selling at a premium, the YTC will be lower than the YTM, CY, and New York. If the bond is selling at a discount, the YTC will be higher than the YTM, CY, and New York. 496 Unit 23 Performance Measures. S65_LM, .im 496 March 15, 2019 10:59 in 8 seconds AM. Investment Return Measurements. U23LO2, compute the investment return measurements most commonly found on the exam. There will probably be two computations on your exam dealing with different types of returns. We'll cover all of them and indicate which are the most and least likely to appear on your test. Take note. As you review these quantitative evaluation measurements, know that the exam is more concerned with the ability to identify what they measure than how to perform the calculation. One or two questions might require a relatively simple calculation on current yield, after-tax return/yield, inflation-adjusted return, or total return. Total return. Total return includes the income from dividends or interest plus any capital appreciation, or less any capital depreciation, over a given time period, usually 1 year. As such, total return is considered to be the best measure of how a security has performed for an investor. Example. A common stock purchased for $20 with an annual dividend of $1 is sold after 1 year for $24. The total return on the investment is $5, $1 in dividends plus $4 in capital appreciation. The total return, then, is 25%. $5/$20 equals 25%. Test topic alert. The exam may require you to know how to calculate total return. Keep in mind that the total annual return on an investment includes income and capital appreciation. In the case of bonds held to maturity, this is the YTM. Otherwise, it is the coupon income plus any appreciation or less any price depreciation. In the case of stocks, one would use the dividend income plus or minus the appreciation or depreciation. Mutual fund returns. Unlike other securities, an investor's total return from a mutual fund investment may include, in addition to income distributions in the form of dividends, distribution of realized capital gains. They are all added together, along with unrealized appreciation or depreciation, to compute the total return. Mutual funds must separate total return from current return. The SEC requires that current return calculations be based only on income distributions for the past 12 months divided by the current per share price. Annual dividend / current price equals current yield. Unit 23. Unit 23 Performance Measures 497. S65_LAM. In 497 March 15, 2019 10:59 and 8 seconds AM. Example. 1. The Capco Income Fund has a current public offering price of $10.50 and an NAV per share of $10. During the past 12 months, the fund has made 4 quarterly distributions from net investment income of 15 cents and 1 distribution from capital gains in the amount of 25 cents. The fund's current yield would be A. 1.1%, B. 1.5%, C. 5.7%, D. 6%. Answer. C. It is computed by dividing the annual income, 4 times 15 cents equals 60 cents, by the POP, not the NAV, of $10.50. Only the dividends are used for current yield. Holding period return. The length of time an investor owns an investment is called the holding period. The return for that period is called the holding period return, HPR. HPR is the total return, income plus capital appreciation, of an investment over a specified period, the holding period. It is essentially the same as total return, but, whereas total return is usually computed on an annual basis, HPR can be for any period. Example. An investment purchased for $100 and sold 3 years later for $120, $20 capital appreciation, after paying a total of $30, $10 per year, in dividends has a HPR of 50%, $120 plus $30 equals $150. The total gain is $150 minus $100 equals $50. A $50 return on a $100 investment is 50%. $50/$100 equals 50%. Take note. HPR is not an annualized return. It is the percentage return over a defined period. Test topic alert. We tend to focus on looking at the total return and holding period return for equities, but it is also a valid measurement for bond returns. In this case, we combine the interest received and any appreciation or depreciation. However, there is one other factor that is sometimes considered, the rate at which the coupons are reinvested. If we assume the bondholder will keep the bond until maturity date, in a period of rising interest rates, the bondholder should be able to reinvest the coupons at a higher rate than the coupon, thus causing the holding period return to exceed the yield to maturity. If, on the other hand, interest rates are falling, the coupons will only be able to be reinvested at a lower rate, causing a holding period return that is less than the bond's YTM. For 98 Unit 23 Performance Measures. S65_LAM. In 498 March 15, 2019 10:59 and 9 seconds AM. Annualized return. Annualized return is the return an investor would have received had he held an investment for 1 year. Annualized return is determined by multiplying the actual return by an annualization factor. The annualization factor is the number of months in the year divided by the number of months an investment is held. Example. An investor receives $5 on a $100 investment held for 6 months. The annualized return is determined by multiplying the 5% return by the annualization factor of 2, 12 months/6 months equals 2, for an annualized return of 10%. Another investor has a capital gain of 30% from an investment held for 18 months. The annualized return is 20%, calculated as follows: 30 times 12/18 equals 20. Take note. The formula we've shown you is only approximate, the computation has never been asked on the exam. In reality, because of compounding, the annualized return would actually be a bit different. Inflation-adjusted return, real return. Because inflation reduces the buying power of a dollar, investment performance measurements are often adjusted to provide a measure of the buying power earned from a given investment. Returns that have been adjusted for inflation are called real rates of return. This is a frequently required computation on the exam. To determine the inflation-adjusted rate of return of debt security, reduce its nominal return by the inflation rate as reflected in the Consumer Price Index, CPI. To determine the inflation-adjusted rate of return of an equity security, reduce the total return, as taught previously, by the inflation rate as reflected in the CPI. Example. A bond with an 8% coupon has a nominal return of 8%. If inflation, as measured by the CPI, is 3%, then the inflation-adjusted return of the bond investment is 8% to 3% or 5%. Let's revisit the total return example from a couple of pages ago. Example. A common stock purchased for $20 with an annual dividend of $1 is sold after 1 year for $24. The total return on the investment is $5, $1 in dividends plus $4 in capital appreciation. The total return, then, is 25%. $5/$20 equals 25%. If the question asked for the real rate of return and told you that the CPI increase for the period was 6%, you would subtract that from the 25% total return to arrive at an inflation-adjusted return of 19%. Unit 23. Unit 23 Performance Measures 499. S65_LM.in 499 March 15, 2019 10:59 and 9 seconds AM. Example. For fixed income investors, inflation and taxes reduce the buying power of their dollars. For an investor in the 25% tax bracket in a 2.5% inflationary environment, an investment that yields 10% before taxes provides the investor with a 5% inflation-adjusted, after-tax return. To calculate the 5% after-tax inflation-adjusted return, first determine the after-tax return. In this case, 10% less 25% for taxes results in a 7.5% after-tax return. The easiest was to compute the real rate of return is to reduce the return by the amount of inflation during the period. In this case, 7.5% less 2.5% inflation results in a 5% after-tax inflation-adjusted return. Even though a calculation of this type might not be on your exam, you need to understand the concept that your final returns are reduced by both taxes and inflation. Test topic alert. The exam will require you to know how to calculate the approximate inflation-adjusted return by merely subtracting the CPI from the total return. What we've shown you is only an approximation. The correct formula is the sum of 1 plus the nominal rate divided by the sum of 1 plus the inflation rate, which then is subtracted by 1. But we've never heard of that being asked on the exam. After-tax return/yield. Capital gains and income are generally taxable. Thus, taxes reduce the return of an investment. The after-tax return, also known as the adjusted return, is determined by reducing the investment's return by the client's tax rate. Example. The after-tax return of an investment that yields 10% for an investor in the 25% tax bracket is calculated by multiplying the return by 1 minus 0.25 or 0.75. The investor retains 75% of the 10% yield for a 7.5% after-tax return. Likewise, an investment that returns 45% over 3 years provides an after-tax return of 33.75%, 0.75 times 45%. The importance of after-tax return is realizing that any investor's return is going to be reduced by the effects of taxation, whether it is the favorable capital gains tax or the higher ordinary income rate. That is the beauty of programs such as the Roth IRA or Section 529 plan, where it is possible to have totally tax-free returns. Remember, even though the interest on a municipal bond may be tax-free, any capital gains are not. Probable return. Unlike historical or actual rates of returns, probable returns are estimates of the likely returns an investment may yield. To determine the probable return of an investment, the advisor assigns a probability to each return that the investment is likely to earn and then multiplies that return by the probability of it occurring. The sum of those probable returns is the expected return for that investment. The formula is as follows: expected or probable return equals probability of return number 1 times possible return number 1, plus probability of return number 2 times possible return number 2. 500 Unit 23 Performance Measures. S65_LAM.IN 500 March 15, 2019 10:59 and 9 seconds AM. Example. The probable expected return of an investment with a 30% probability of returning 15% and a 70% chance of returning 10% has a total expected return of 11.5%, calculated as follows: 0.30 by 15% equals 4.5%, plus 0.70 by 10% equals 7.0%, or 4.5% plus 7.0% equals 11.5%. In effect, this return reflects the arithmetic, mean, return of the portfolio. When one constructs a portfolio, there are usually securities with different grades of risk and, hence, different expectations of reward. Investors view the portfolio as a whole, looking to maximize for return for each level of risk. This overall view, or mean, of the entire portfolio is the expected or probable return of the portfolio. Test topic alert. Don't be surprised to get a question similar to our previous example, but with one of the possibilities being a negative. Suppose our example had said there was a 30% probability of returning 15%, a 40% chance of returning 10%, and a 30% chance of losing 8%. The expected return would be 0.30 by 15% equals 4.5%, plus 0.40 times 10% equals 4.0%, plus 0.30 by minus 8% equals minus 2.4%, for a total of 6.1% expected return. Risk-adjusted return, Sharpe ratio. Securities practitioners have developed many measures to quantify the risk characteristics of a portfolio. One such measure that may show up on the exam is called the Sharpe ratio, or Sharpe index. The ratio is calculated by subtracting the risk-free rate, example, the 91-day Treasury bill rate, from the overall return of the portfolio. This result, which is the portfolio's risk premium, is then divided by the standard deviation of the portfolio. This ratio measures the amount of return per unit of risk taken. The higher the ratio, the better or more return per unit of risk taken. Test topic alert. The Sharpe ratio measures risk-adjusted return. Test topic alert. You must know that the three components of the Sharpe ratio are the actual return minus the risk-free rate, the 91-day T-bill rate, divided by the standard deviation. Beta is not a part of this ratio. Risk premium. It should be clear that to have a positive Sharpe ratio, our actual return on an investment must exceed the risk-free return. Therefore, any investor would surely expect to achieve that higher return or the investment would not be made. This return is known as the risk premium. The required rate of return on any investment is a combination of the risk-free rate plus a risk premium. For equity investments, the risk premium can be determined by using the Capital Asset Pricing Model, CAPM, discussed in Unit 20. Unit 23. Unit 23 Performance Measures, 501. S65_LAM.IN 501 March 15, 2019 10:59 and 9 seconds AM. Internal Rate of Return, IRR. IRR has been discussed previously in Unit 10. We're just going to list a couple of the points that are important for the exam. IRR is the preferred method of measuring the return on a DPP. IRR takes into consideration the time value of money, and IRR is the way the yield to maturity of a bond is computed. Time-weighted returns. Although time-weighted returns and dollar-weighted returns are both methods of determining a rate of return, they have very different purposes. A time-weighted return is determined without regard to any subsequent cash flows of the investor. As such, it measures the performance of the investment over a period, and not of the investor as in a dollar-weighted approach. Most returns reported on mutual funds are time-weighted because the portfolio manager does not have any control over the future cash flows to the fund with respect to investor dollars. Dollar-weighted returns. In contrast, a dollar-weighted return considers subsequent contributions to and withdrawals from an investment, including sales of, for example, stock. As a result, the dollar-weighted approach focuses on the return of the investor, not the investment, as in the time-weighted approach, over a period, and usually results in a rate of return different than the time-weighted method. Portfolio A. Period investor deposits or withdrawals beginning of period value, end of period value, periodic rate of return 0, $1,000, $1,000, $1,200, 20%, 1, $400, $800, $700 minus 12.50%, 2, $300, $1,000, $1,400, 40%, 3, $200, $1,200, $1,000 minus 16.67%, 4, $1,000. DWR equals 8.2311%. TWR equals 5.2034%. Portfolio B. Period investor deposits or withdrawals beginning of period value, end of period value, periodic rate of return 0, $1,000, $1,000, $1,200, 20%, 1, $400, $1,600, $1,400 minus 12.50%, 2, $400. $1,000, $1,400, 40%, 3, $400, $1,800, $1,500 minus 16.67%, 4, $1,500. DWR equals 2.0245%. TWR equals 5.2034%. 502 Unit 23 Performance Measures. F65_LEM. In 502 March 15, 2019, 10:59 and 9 seconds AM. Test topic alert. The dollar-weighted return reflects the internal rate of return, IRR. The time-weighted return does not. Example 1. If you wanted to evaluate the performance of a portfolio manager, you would calculate the portfolio's A dollar-weighted return, B a holding period return, C portfolio return, D a time-weighted return. Answer D. Because portfolio managers have no control over the deposits and withdrawals made by clients, the time-weighted return, choice D, is a more appropriate measure of performance. Portfolio benchmarks. U23L03 match the appropriate benchmarks for various portfolios. Tens of thousands of stocks trade in the stock markets. Stock indexes, such as the S&P 500 or the utility index, are smaller groups of stocks that serve as a benchmark for measuring the performance of the overall market or sectors of the market. Indexes are generally weighted for the capitalization, number of outstanding shares times the market price per share, of the companies included. Therefore, a large company's stock price changes will have a greater effect on the index. Indexes are often used as benchmark portfolios against which managed portfolios are measured to gauge the performance, or added value, of the fund manager. In addition, index mutual funds and ETFs will invest in the securities that compose an index to specifically mirror the index's performance. Following is a listing of indexes or averages that may appear on the exam. Test topic alert. The exam will want you to know which index serves as the benchmark for which type of portfolio. Large cap S&P 500, mid cap S&P 400, small cap Russell 2000 International Stocks EAFE. Dow Jones Industrial Average. The best known of all of the market indexes are those published by Dow Jones & Company. There are probably two reasons why the Dow Jones Industrial Average, DJIA, is so well known. First, because the 30 industrial stocks are among the 30 best-known corporations in Unit 23. Unit 23 Performance Measures 503. F65_LEM. In 503 March 15, 2019, 10:59 and 9 seconds AM. The world in second, and some would say more important, the Dow Jones & Company also publishes the Wall Street Journal, the nation's leading financial newspaper. Because it is price-weighted, the Dow Jones is truly an average. Originally, it was computed by adding together the prices of one share for each of the 30 different companies and then dividing by 30. That had to be changed as soon as the first one of those 30 companies had a 2:1 stock split. Because a stock split will cause the market price of the stock to drop, that is, the average would be distorted by continuing to divide the 30 current market prices by 30. An adjustment had to be made to the 30, called the divisor. Over the years, stock splits and other distributions have caused that original divisor of 30 to be adjusted. There are three other Dow Jones averages: the 20 transportations, the 15 utilities, and the composite of all 65. On November 1, 1999, history was made when non-NYSE stocks were included in the DJIA for the first time. Added to the average were Microsoft and Intel, which are both listed on NASDAQ. The most recent addition, as of the date of this writing, was Walgreens, which replaced General Electric, an original member back in 1896. Standard & Poor's 500. The composition of the Standard & Poor's 500, S&P 500, composite index includes four main groups of securities: 400 industrials, 20 transportation companies, 40 public utilities, and 40 financial institutions. The S&P 500 is a cap-weighted index using a base period of 1941 to 1943 equal to 10. Although most of the stocks in the S&P 500 are listed on the NYSE, many of the highest-priced issues, Google, Amazon, and Bookings Holdings, formerly known as Priceline, are traded on the NASDAQ stock market. New York Stock Exchange, NYSE, Index. The NYSE publishes a composite index that covers all of the common stocks listed on the NYSE, more than 3,000 different companies. This index provides the most comprehensive measure of market activity on the NYSE. The NYSE index is cap-weighted, similar to the S&P 500, but the base is December 31, 1965, and the index for the base is 50. NASDAQ Composite Index. The OTC market is represented by the NASDAQ Composite Index, which covers more than 3,000 OTC companies. The NASDAQ Composite Index is calculated in a manner similar to those used for the S&P and NYSE indexes, with a base period of February 5, 1971, and an index number of 100. These indexes, their subgroups, and several other popular indexes are quoted daily in the Wall Street Journal. As with the others, except for the Dow Jones, this is also a cap-weighted index. Russell 2000 Index. The Russell 2000 Index measures the performance of the small-cap segment of the U.S. equity universe. It includes approximately 2,000 of the smallest securities based upon their market capitalization, minimum market cap of $300 million. Like most of the others, it is market cap weighted, with the median market cap being something approximating $600 million. 504 Unit 23 Performance Measures. S65_LEM.IM 504 March 15, 2019 10:59 and 9 seconds AM. EAFE. The EAFE, sometimes referred to as the MSCI EAFE, it was developed by Morgan Stanley Capital International, is an index of foreign stocks. The index is market capitalization weighted. The EAFE acronym stands for Europe, Australasia, and Far East. The index includes a selection of stocks from 21 developed countries outside of the U.S. and Canada. The index has been calculated since the end of 1969, making it the oldest truly international stock index. It is probably the most common benchmark for foreign stock funds. The Wilshire 5000. The Wilshire 5000 Total Market Index SM measures the performance of all U.S. equity securities with readily available price data. This is another market or cap-weighted index that, when it was initially created in 1974, did contain approximately 5,000 issues. Now, as of December 31, 2017, the index contained only 3,492 components. Test topic alert if you are asked to identify the index that reflects the broadest coverage of the U.S. stock markets, it is the Wilshire 5000. Example 1. Which of the following is a price-weighted average? A Dow Jones Industrial Average, B. MSCI C. Russell 2000 D. S&P 500. Answer. The only major benchmark that is price-weighted is the Dow Jones, choice A. All of the others are market cap-weighted. Unit 23. Unit 23 Performance Measures 505. S65_LEM.IN 505 March 15, 2019 10:59 and 9 seconds AM. S65_LEM.IN 506 March 15, 2019 10:59 and 9 seconds AM. Retirement plans allow investors to accumulate resources to fund their retirement. Individuals accomplish this through business-sponsored retirement plans, personal plans, or individual and corporate retirement plans. To encourage Americans to save for retirement, Congress has passed legislation that allows investors to invest in certain retirement plans on a tax-deductible and/or tax-deferred basis. Throughout this unit, we give you the contribution limits for all plans described that are current for those filing 2019 tax returns. It is highly unlikely that any of those numbers, other than perhaps the IRA contribution limit, will be asked on the exam. That new limit is $6,000, $7,000 for those age 50 and older, and we will update our bank questions if we learn that the new limits are appearing on the exam. Therefore, you should consider these as included for reference purposes, not for testing. The exam will include approximately 7 questions on the material presented in this unit. Learning objectives. When you have completed this unit, you will be able to accomplish the following. U24L01, recall the features of traditional, Roth, and simplified employee pension plan individual retirement accounts. U24L02, differentiate between the different types of employer-sponsored qualified retirement plans. U24L03, contrast qualified and non-qualified retirement plans. U24L04, identify the tax treatment of distributions from qualified plans. U24L05, identify the purpose of the Employee Retirement Income Security Act of 1974 and its primary features, including the fiduciary obligations under the Uniform Prudent Investor Act. U24L06, compare the differences between the 2 major types of education funding programs. U24L07, contrast UGMA and UTMA accounts. U24L08, recall when health savings accounts, HSAs, may be used. 24. Unit. Retirement plans including ERISA issues and educational. Funding programs. 507. S65_LEM_ Chapter 24.IN 507 October 7, 2019 11:30 and 1 second AM. Introductory note. U24L01, recall the features of traditional, Roth, and simplified employee pension plan individual retirement accounts. As with so much in this course, there are similar terms with sometimes dissimilar meanings. Here is a useful list of terms used in the discussion of retirement plans. Tax deferred: simply, income tax is put off, deferred, to a later time. In most retirement plans, tax on the amount of the contribution is usually deferred until withdrawal. Tax on the earnings is always deferred until withdrawal. Qualified plan and employer-sponsored plan, such as a pension, 401k, 403b, where the contributions are made with pre-tax dollars and earnings in the account grow without any tax, tax deferred, until the funds are withdrawn. Qualified: this term by itself means that contributions are made with pre-tax dollars and earnings in the account are tax deferred until the funds are withdrawn. This can apply to either a qualified plan or an IRA. Unqualified and employer-sponsored plan, such as a deferred compensation plan, where there are no tax advantages other than that the pay is not received until sometime later when the individual should be in a lower tax bracket. Another advantage is that the employer can discriminate between employees. The term can also apply to an annuity purchased on an individual basis outside of a retirement plan as described in Unit 15. Deductible contribution: the contribution made by the individual, whether an employee contribution to a qualified plan such as a 401k plan, or by any individual to an IRA. This means the amount contributed is pre-tax or otherwise deductible on the tax return. Non-deductible contribution: a contribution to a qualified plan or an IRA which is made with after-tax dollars. The funds do grow tax deferred, but there is no tax benefit derived from the contribution. Take note, although individual retirement arrangements is the technical IRS term, not tested, because everyone refers to these as individual retirement accounts, IRAs, we're going to use the common phrase to avoid confusion. 508 Unit 24 Retirement Plans including ERISA issues and educational funding programs. S65_LEM.IN 508 March 15, 2019 10:59 and 10 seconds AM. Individual retirement accounts, IRAs, were created to encourage people to save for their retirement. Most individuals with earned income, CU 21L02, may open and contribute to an IRA. 3 types of IRAs are available, with different contribution, tax, and distribution characteristics: traditional IRAs, Roth IRAs, and simplified employee pension plan, SEP, IRAs. IRAs are not to be confused with qualified plans or non-qualified plans used by businesses. Later in this unit, we will cover topics such as pension plans, 401k plans, and deferred compensation plans. At this point, keep in mind that a qualified plan is employer-sponsored and meets the IRS requirements for the contributions to the plan to be tax-deductible and the earnings to grow tax-deferred. Non-qualified plans do not enjoy most of the tax benefits of qualified plans. Take note, although we may include some actual contribution limits, it is unlikely that you will have to know any other than the IRA and Coverdell numbers. The Coverdell numbers have not changed, but the IRA contribution is up to $6,000 for 2019. Traditional IRAs. The first of the IRAs we'll cover is generally referred to as the traditional IRA, although there is no such term in the IRS regulations. This was the first IRA, and as others have been introduced, this first one acquired its name. A traditional IRA allows a maximum tax-deductible annual contribution of the lesser of $6,000 per individual or $12,000 per couple, or 100% of taxable compensation for the taxable year 2019. The income and capital gains earned in the account are tax-deferred until the funds are withdrawn. Compensation for IRA purposes. For purposes of contributing to an IRA, the IRS considers the following to be compensation: wages, salaries, and tips, commissions and bonuses, self-employment income, alimony from pre-2019 divorce, decrees, non-taxable combat pay. Not compensation for IRA purposes. For purposes of contributing to an IRA, the IRS does not consider the following to be compensation: capital gains, interest and dividend income, pension or annuity income, child support, passive income from DPP's, alimony from post-December 31, 2018, divorces. Unit 24. Unit 24 Retirement Plans including ERISA issues and educational funding programs. 509. S65_LEM_ Chapter 24.IN 509 October 7, 2019 11:30 and 41 seconds AM. Catch-up contributions for older IRA owners. The Economic Growth and Tax Relief Reconciliation Act of 2001, EGTRRA, was the source of the legislation permitting certain individuals to make additional contributions to their IRAs. Individuals aged 50 and older are allowed to make catch-up contributions to their IRAs above the scheduled maximum annual contribution limit, which will enable them to save more for retirement. These catch-up payments can go either to a traditional IRA or to a Roth IRA. Year additional catch-up amount allowed: $2,006 plus $1,000. Test topic alert. The exam may want you to know that EGTRRA is responsible for the catch-up provisions. Any taxpayer younger than age 70 and a half who reports earned income for a given tax year may contribute to a traditional IRA. If one spouse has little or no earned income and a joint tax return is filed, a spousal IRA may be opened for that person and the contribution limits are the same as for any other IRA. Example. 1 member of a married couple in their 30s earns an annual salary of $45,000 while the other earns $2,000 annual from a home-based business. If they file a joint tax return, their maximum IRA contribution for the year is: A. $6,000. B. $8,000. C. $12,000. D. $14,000. Answer. C. When one spouse's annual earnings are less than $6,000, the spousal IRA benefit permits that spouse to contribute the maximum as long as a joint return is filed showing combined income of at least $12,000. In this case, their income exceeds that, so they can each have an IRA with a contribution of $6,000 making for a total of $12,000, choice C. Please note that when using the spousal IRA, the higher earning spouse cannot have more than the maximum contributed to their account, currently $6,000. One can't look at this and say the couple has $12,000 to be split however they wish. If this question had stated the couple was in their 50s, then, because of the catch-up provision, $14,000 would have been the correct choice. IRA contributions for a specific taxable year may be made anytime from January 1st of that year through the required filing date of that year's return, generally April 15th of the next year, unless the 15th falls on a holiday or weekend. If the individual obtains a filing extension, the deadline is still April 15th. 510 Unit 24 retirement plans including ERISA issues and educational funding programs. S65_LEM_ Chapter 24.IND 510 October 7, 2019 11:32 and 23 seconds AM. Test topic alert. The exam may try to trick you into thinking that you can make a contribution later than April 15th if you have received an extension to file your taxes. You can't. You should know that an extension does not give you more time to pay your taxes. It only extends the time that you have to file your return. Excess contributions. Annual IRA contributions exceeding the maximum allowed are subject to a 6% penalty tax if the excess is not removed by the time the taxpayer files a tax return, but no later than April 15th. Roth IRAs. Much of what has been stated about the traditional IRA applies to the Roth IRA. What is important are the differences. The most significant difference relates to the taxation of contributions and withdrawals. Contributions to Roth IRAs, unlike those of traditional IRAs, are not tax deductible. Earnings are not merely tax deferred, they can be tax-free. Earnings accumulated may be withdrawn tax-free 5 years following the initial deposit, provided the account holder is 59.5 or older. Money withdrawn is used for the first-time purchase of a principal residence, up to $10,000, or account holder has died or become disabled. Regular contributions may always be withdrawn tax-free because they are made with non-deductible contributions. Example 1. Among the requirements for accumulated earnings in a Roth IRA to be withdrawn free of tax is that the owner of the account is at least 70.5 B. The money is withdrawn for a first-time purchase of vacation home. C. The initial deposit to a Roth IRA was made at least 5 years ago. D. The owner's spouse is declared disabled. Answer. C. The first requirement for tax-free withdrawals from a Roth IRA is that the initial deposit to a Roth must have been made at least 5 years ago, choice C. The other primary requirement is that the owner must be at least 59.5, not 70.5. If the 5-year requirement is met, then owners under 59.5 can receive distributions of accumulated earnings tax-free. They wish to use up to $10,000 for a first-time purchase of a primary residence, not a vacation home. The disability requirement only applies to the owner of the Roth, not a spouse. Unit 24. Unit 24 retirement plans including ERISA issues and educational funding programs 511. S65_LEM.IN 511 March 15, 2019 10:59 and 10 seconds AM. Contribution limits to Roth IRAs are the same as those for traditional IRAs with one important difference. Unlike a traditional IRA, contributions may be made past age 70.5 as long as the taxpayer has earned income. An individual may contribute to both a traditional and a Roth IRA. However, the maximum combined contribution is $6,000 or $7,000 if 50 or older. Eligibility requirements. Unlike the traditional IRA, there are limits placed on Roth eligibility based on income. Anyone with earned income is eligible to open a Roth IRA provided the person's adjusted gross income, AGI, falls below specified income levels. The following numbers, which are never tested, are effective for those filing a tax return for 2019. A single person with an AGI of less than $122,000 may contribute the full amount to a Roth IRA. The ability to contribute to a Roth IRA is gradually phased out if the taxpayer's AGI is between $122,000 and $137,000. For married taxpayers who file joint tax returns, the AGI limit is $193,000, with the contribution phased out for couples whose income is between $193,000 and $203,000. What is AGI? Adjusted gross income, AGI, adjusted gross income, generally referred to as AGI, is computed on the bottom of the first page of your Form 1040. It might help you to take a look at yours. When you do your taxes, you begin by listing all of your earned income, salary, wages, and bonuses, plus other income such as interest and dividends, capital gains, alimony received, and profits from a business you may own. From that total, you deduct certain items to arrive at the AGI. Among the more testable items that are deductible are traditional IRA contribution, alimony paid if divorce decree was signed prior to January 1, 2019, self-employment tax, and penalties paid on early withdrawal from a savings account. Test topic alert: please note that although tax-exempt income from municipal securities is shown on the Form 1040, it is not included in AGI. Take note these numbers will not be tested because they change every year. It is the concept that is important. Roth conversions: anyone with a traditional IRA is permitted to convert it to a Roth IRA. However, there are income tax consequences. Basically, the entire amount converted is added to the 512 Unit 24 retirement plans, including ERISA issues and educational funding programs. S65_LEM_ Chapter 24.IND 512 October 7, 2019 11:33 and 43 seconds AM. Investors' ordinary income. However, as long as the funds are transferred trustee to trustee, or, if distributed to the owner, are rolled over within 60 days, there will be no 10% early distribution tax penalty for those under age 59.5. If some portion of the contributions to the traditional IRA were made with after-tax money, the IRS uses a proportionate system to determine how much is non-taxable, but that type of computation will not be tested. Conversions may also be done from any qualified employer plan, such as 401k and 403b plans, as well as simple and SAP IRAs. Key points to remember about the Roth IRA. Contributions are not tax-deductible. Distributions are tax-free if taken after age 59.5 and a Roth account has been open for at least 5 years. Contributions can be made after age 70.5 as long as there is earned income. Distributions are not required to begin at age 70.5. If due to death, disability, or first-time home purchase, the distribution is qualified and not subject to tax or the 10% penalty. A minor can be named as beneficiary. Simplified employee pensions, SAP IRAs. The third type of IRA is somewhat different in that it is funded by an employer rather than the individual. Simplified employee pension plans, SAPs, offer self-employed persons and small businesses easy-to-administer pension plans. ISAP is a qualified plan that allows an employer to contribute money directly to an individual retirement account, IRA, set up for each employee, hence the name SEP IRA. Following is a list of the key points of which to be aware. Eligibility. To be eligible, an employee must be at least 21 years of age, have performed services for the employer during at least 3 of the last 5 years, and have received at least $600 for 2019 in compensation from the employer in the current year. The annual compensation figure is indexed for inflation. Participation. SEP rules require the employer allow all eligible employees to participate. Funding. SEP allows the employer to contribute up to 25% of an employee's salary to the employee's SEP IRA each year, up to a maximum of $56,000 per employee per year in 2019. The employer determines the level of contributions each year and must contribute the same percentage for each employee, as well as the employer. Unit 24. Unit 24 retirement plans, including ERISA issues and educational funding programs. 513. S65_LEM_ Chapter 24.IN 513 October 7, 2019 11:34 and 56 seconds AM. Catch-up provision. Unlike the IRA and most qualified plans, there is no catch-up provision for ISAP. However, and this is unlikely to be tested, if the SEP IRA permits non-SEP contributions, they can make regular IRA contributions, including IRA catch-up contributions if they are age 50 and older, to the SEP IRA, up to the maximum annual limit. The vesting participants in a SEP IRA are fully vested immediately, meaning that once the money is deposited in an employee's SEP IRA, it belongs to the employee. Taxation: employer contributions are tax-deductible to the employer. Contributions are not taxable to an employee until withdrawn, and earnings in the account accumulate tax-deferred. Example: 1. SEP IRAs A are used primarily by large corporations. B are used primarily by small businesses. C are set up by non-employees. D cannot be set up by self-employed persons. Answer: B. Small businesses, choice B, and self-employed persons typically establish SEP IRAs because they are easier and less expensive than other plans for an employer to set up and administer. Withdrawals from traditional IRAs and SEP IRAs. Up until this point, we've discussed contributions. Now let's look at taking the money out. When it comes to traditional IRAs and SEP IRAs, distributions without penalty may begin after age 59.5 and must begin by April 1st of the year following the year an individual turns 70.5. Distributions before age 59.5 may be subject to a tax penalty, and withdrawals less than the required minimum distributions, RMDs, after age 70.5 may also incur tax penalties. Take note. When is the deadline for receiving a RMD from an IRA? An account owner must take the first RMD for the year in which the account owner turns 70.5. However, the first RMD payment can be delayed until April 1st of the year following the year in which the account owner turns 70.5. For all subsequent years, including the year in which the first RMD was paid by April 1st, the account owner must take the RMD by December 31st of the year. To the extent withdrawals are from tax-deductible contributions, they are taxable as ordinary income. When there are both deductible and non-deductible contributions, a formula is used whereby a portion of the withdrawal represents a non-taxable return of principal. 514 Unit 24 Retirement Plans, including ERISA issues and educational funding programs. S65_Elium.in 514 March 15, 2019 10:59 and 10 seconds AM. Taxable withdrawals before age 59.5 are also subject to a 10% early withdrawal penalty unless they are due to death, disability, first-time purchase of a primary residence, $10,000 lifetime maximum, qualified higher education expenses for immediate family members, including grandchildren, but not nieces or nephews, or certain medical expenses. These exceptions also apply in the case of a non-qualified, taxable distribution from a Roth IRA. Example 1. Who of the following will not incur a penalty on an IRA withdrawal? A man who has just become totally disabled. B. A woman who turns 59 a month before the withdrawal. C. A woman, age 50, who decides on early retirement. D. A man in his early 40s who uses the money to buy a second home. Answer: on early withdrawals, without penalty, are permitted only in certain situations, such as death or qualifying disability. Choice A. As stated, withdrawals must begin by April 1st of the year following the year in which the account owner reaches age 70.5, and they must meet minimum Internal Revenue Code, IRC, distribution requirements or incur a 50% penalty on the amounts falling short of the minimum required distribution, MRD. One important respect in which the Roth IRA differs from other retirement plans is that the age 70.5 is irrelevant. There are no RMDs, and, as long as the individual has earned income, contributions may be made at any age. There is one other way to tap your IRA before age 59.5 without penalty, through the Substantially Equal Periodic Payment, SEP, exception. The Substantially Equal Periodic Payment exception under IRS Rule 72-T states that if you receive IRA payments at least annually based on your life expectancy, or the joint life expectancies of you and your beneficiary, the withdrawals are not subject to the 10% penalty. The IRS has tables for determining the appropriate amount of each payment at any given age. Take note, for exam purposes, you can postpone beginning distributions until the later of April 1st of the calendar year after you turn age 70.5, or April 1st of the calendar year following your retirement, but only for qualified plans, not an IRA. Example, an IRA owner who reaches age 70 and a half on January 1, 2017, must begin withdrawals by April 1, 2018. However, if this individual is covered by an employer-sponsored plan. Unit 24. Unit 24 retirement plans including ERISA issues and educational funding programs 515. S65_LEM.IM 515 March 15, 2019 10:59 and 11 seconds AM. Other than a SEP IRA, there are no R&Ds from that plan, but there are from any traditional IRAs, until after retirement. Non-deductible capital withdrawals. IRA investors who contribute after-tax dollars to an IRA are not taxed on those funds when they are withdrawn from the account, but taxpayers are taxed at the ordinary income tax rate when they withdraw funds resulting from investment gains or income. As stated previously, if the client is in the middle part of the phase-out range resulting in some of the contribution being pre-tax, deductible, and the rest post-tax, the IRS has a formula to determine how much of the money withdrawn is non-taxable. Example. A client has invested $25,000 in after-tax dollars in an IRA currently worth $75,000. If the client were to withdraw $75,000, only $50,000 would be taxable. Take note. The early withdrawal penalties for all IRAs are waived in the event of death or disability. Test topic alert. Assume questions are about traditional IRAs unless they specifically state otherwise. Test topic alert. Income and capital gains earned from investments in any IRA account are not taxed until the funds are withdrawn and, if a qualified withdrawal, are not taxed at all in the case of a RAF. Characteristics of IRAs. IRA investments. In most cases, IRAs at securities firms are set up as self-directed plans. That means the investment choices are determined by the account holder. Funds in an IRA account may be used to buy stocks, bonds, mutual funds, UITs, limited partnerships, REITs, U.S. government securities, gold or silver coins minted by the U.S. Treasury Department, American Eagles, as well as certain platinum coins and certain gold, silver, palladium, and platinum bullion, annuities, and many other investments. IRA investments should be relatively conservative and should reflect the investor's age and risk tolerance profile. Because an IRA serves as a source of retirement funds, it is important that the account be managed for adequate long-term growth. 516 Unit 24 retirement plans including ERISA issues and educational funding programs. S65_LEM.IM 516 March 15, 2019 10:59 and 11 seconds AM. Ineligible and inappropriate investments. Collectibles, including antiques, gems,